Good morning. It is 9 a.m. on Wednesday, October 13th. This is Yahoo Finance Live. I'm Julie Hyman, along with Brian Sozzi. Take a look at futures here this morning, and we have, again, sort of a mixed picture here as we kick off the morning. We've got the S&P and the Dow indicating very slightly lower opens. The Nasdaq indicating a gain of about 1/5% at the open. You might hear Sparky barking a little bit in the background. Why? Maybe he's excited about earnings season. Today begins a pivotal earnings season. In fact, we'll learn what effect rising costs had on profits last month. Kicking it off today, JPMorgan, BlackRock, and Delta. We're going to get you the numbers in just a bit. Speaking of rising costs, we had year-over-year inflation matching the hottest going back to 2008. Again, on a year-over-year basis, up 5.4% on a month-over-month core basis, matching economist estimates. We'll have the full details in just a moment. And if you need to sweat out all those numbers we've been talking about, we'll take a workout break with home gym system Tonal, which is announcing a new partnership with LeBron James. But first, got to get to what's going on both the macro and the micro front and turn to what happened with those consumer prices, as I mentioned, rising year over year, 5.4%. Our Brian Chung is on the case covering those numbers. We've all been waiting for these inflation numbers, and there were some interesting sort of components within this overall report.
Yeah, Julie, well, Sparky might be right. Woof might be the response to the consumer price index numbers that we got this morning. This coming from the Bureau of Labor Statistics covering the month of September. And the price index showing prices rising by 0.4% on a month-over-month basis when you're looking at the month of September. That was above the street's estimates of 0.3% that we had seen as estimates from the street. Now, on a year-over-year basis, that came in at 5.4%. That was much hotter, not much hotter, but definitely above the street's estimates. They were expecting something closer to 5.3% for the index. Now, when you strip out those more volatile components like food and energy on a month-over-month basis, it came in at 0.2% of an increase. If you're looking at year over year, comparing September 2020 to September 2021, that clocked in at 4%. Now, what's interesting about this report is that those more transitory factors that Fed officials had been talking about have been starting to fall out. Consider some of the reopening trades when you kind of parse out some of the more specific categories in the CPI. Airline fares going down 6.4% on a month-over-month basis. Car and truck rentals going down by 2.9% on a month-over-month basis. And we know that a lot of those in Team Transitory have been pointing to used car and truck prices, that falling by 0.7%. Now, one interesting thing that's worth mentioning is also shelter. Shelter did increase by 0.4%. This could be something that could be a little bit more persistent, so worth watching in future CPI prints. And then I wanted to add this one category for Brian Sozzi. Uncooked beef steaks have been up 4.8% month over month, which might explain the rising price tag for that tomahawk steak that I know you bought earlier in the week, Brian. But again, interesting to see consumer price index on a headline basis beating the street's estimates.
Well, thank you for tuning into Yahoo Finance Live, Brian Chung. Let me ask you, though, this is the last CPI report ahead of the next Fed meeting. Should the bulls be barking up a storm right now in discontent, really under the assumption that the Fed is maybe a little more aggressive with their tapering program?
Well, this is going to certainly be a communication challenge for the Fed. Now, I do want to caution that even though this CPI print was hotter than the street expected, this is still kind of in line with what the Federal Reserve has been saying, which is that we do expect these price pressures to be hot, but that they do expect them to fade over time. The difference is that if you're looking at the Fed communications, say in the earlier part of the summer, they were hoping that would fade by now. What Fed officials are saying now is that they expect these types of pressures to last through the middle of next year. Now, of course, whether or not the Federal Reserve will continue to kind of move that yardstick back and back and back as we continue to get these hot prints remains a question. But even the more dovish members of the Federal Reserve that have insisted that some of these inflationary pressures will likely abate over time have been saying, actually, this is a bit more persistent than I expected, but they still expect it to be transitory over, let's say, that 12 to 18-month period. So again, I think the question is not necessarily, whether we'll get a dip in the CPI or the PCE inflation readings over, let's say, the winter, but whether or not they will stay high through the middle parts of next spring. So if you start to see these hot prints in, say, March or April next year, during that time, the Fed might be wrapped up with its tapering program, depending on when they start it. But maybe that is when they start to have that rates discussion about whether or not they should raise the interest rates from their current target level of near zero, guys.
And yesterday we learned that the Federal Reserve President of the Bank of Atlanta, Raphael Bostic, he said in a speech he has a jar in his office where if you say transitory, you put a dollar. And he did that during the speech, the so-called dirty word right now within these discussions. But let's get to another big story that we are watching, and that has to do with JPMorgan earnings, that company coming out and beating estimates. The real standout here, investment banking fees, which also came in ahead of estimates. Brian, what stands out to you?
Yeah, well, earnings season is here. So Q3 in the books for JPMorgan Chase, the United States' largest bank, as we just flashed the numbers ahead of you, $30.4 billion in revenue on the top line. That beat the street's estimates of $29.9 billion. On the bottom line, they handily beat the street's estimates, clocking in at $3.74 per share compared to the street's estimates of $2.97. Now, a lot of this was because of the credit reserve releases. We know that this is going to be a broad theme for the other banks that are expected to report through the remainder of this week. Obviously, these are reserves that the banks had set aside because they were worried about a lot of defaults on personal and consumer business loans during the depths of the pandemic. Wasn't as bad as the banks expected. So over the past few quarters, they've been steadily letting some of those reserves and credit loss reserves aside to fall off of the net income side of their sheet. Now, in this particular quarter, JPMorgan Chase was able to release about $2.1 billion. But the story for JPMorgan Chase largely remains leaning on its investment banking and asset wealth management side of things. When you take a look at non-interest revenue, this is a key stat for JPMorgan Chase, up by 3% in the quarter. That's a lot because of banking fees, investment management fees. Consider this also, M&A and IPOs were particularly hot, the release noting that. And then commercial banking actually had a record quarter, $1.3 billion in gross revenue. All of these things have been subsidizing really what's been tepid growth in their bread and butter businesses. That's credit card, business lines of credit. Consider that the consumer and community bank average loans were actually down by 2%. This is despite the fact that Jamie Dimon, the CEO, had said last quarter he was hoping that the pump would be primed for the consumer to come back strong soon. And we're not seeing necessarily in this quarter, but it's worth noting the CFO, Jeremy Barnum, saying on an earnings call just about a few minutes ago that, quote, we see some signs of life, and we believe that recovery is strongly underway. Whether or not we start to see that more underlying fundamental growth in, say, the credit card business remains to be seen. We'll see if the fourth quarter earnings in January will kind of tell where that direction is going.
Brian, what caught my attention among many things in this report is equity markets revenue up 30% year over year. And we saw certainly that pickup in volatility late in the quarter, but really it continues that theme, just this generally strong interest by people to be invested in the stock market. And really that has been happening all year long.
Yeah, and when you see, 30%, for example, year-over-year increase, you do have to be careful because these year-over-year comparisons are comparing, in some cases, some of the depths of the pandemic last year. Now, if you look at Q4, where you start to see some of the rebound, that might be a little bit more emblematic of a true underlying growth rate. But again, it is indeed the case that equities and their trading desks were really a big bright point for these investment banks. Now, I do want to note that this inflection point is starting to happen not just at JPMorgan Chase, but the other major banks as well, where during the pandemic, it was the volatility and the counter-cyclicality of their ability to trade in equity and specifically fixed income markets to be able to meet their profit margins for those quarters because of the fact that consumer loans and business loans were obviously in the gutter with everyone sheltered down during the depths of the pandemic last year. Now, it's starting to shift where with the reopening of the economy, all of this demand coming back, the inflation numbers are a big validation of this point, that maybe that's going to start to shift, that reduced volatility in equity markets. Again, volatility is still definitely high right now, but certainly not compared to, say, the summer of 2020 and the spring of 2020, whether or not that's going to kind of shift the balance here where, loan growth in those credit card loans and those small business loans will be the bigger driver of growth and revenue compared to, say, equity underwriting, M&A, IPO, advisory type of things. Now, of course, for the more money center banks like Goldman Sachs, Morgan Stanley, JPMorgan Chase falls into that. That will likely still remain a story. But when you take a look at Wells Fargo, Bank of America, Citigroup, those are banks that are going to be reporting tomorrow. It'll be very interesting to see if that inflection point comes in Q4. JPMorgan Chase's earnings today suggest it hasn't happened this quarter yet. But again, we'll have to see what the trajectory looks like in the next 2 quarters to come.
Yeah, and as you said, that's something that Jamie Dimon has really been waiting for, that inflection, the pickup once again in that loan growth. Thanks so much, Brian Chung. One more note that I wanted to say about JP Morgan as we see the shares down right now, Brian. is that they've been doing very well. And everybody we talk to likes banks seemingly going into these earnings. So we have seen high expectations. The stock, by the way, closed at a record 170.22. Just on October 8th. Let's move on to one other company that was out this morning, and that is Delta Airlines. Its first quarterly profit, if you exclude the effect of federal aid at a major U.S. airline since the start of the pandemic. You can see the numbers beat estimates. Of course, rising jet fuel prices are going to be a challenging issue for the company. The shares are trading a little bit lower here this morning. They came out with a forecast as well. Fourth quarter revenue is going to rise in the low 70% range compared with 2019. And costs for each seat flown a mile, excluding fuel, are going to go up as much as 8% from 2019. So that's interesting as well, that costs are rising even excluding fuel there, Brian.
Yeah, what bothered me here, and we talked a little bit about this in the newsletter to kick off the week on Monday, Julie, and it's something I think you're seeing with JPMorgan come out with better than expected results. The stock selling off, seeing the same thing here with Delta. Delta stock rallied about 10% coming into this report. I think the market was positioned just to hear better commentary about the back half of the year, or the fourth quarter in this case. That didn't appear to happen. Really, two red flags for me. Delta calling out that higher oil prices may mean that it's not profitable in the fourth quarter, big red flag. And the other red flag is them noting corporate demand, or corporate travelers, stabilized, but it did weaken towards the latter part of the quarter here. And if you're out there trading these return to normal type of companies, a Marriott, a Hilton, the hotel chains, you're concerned about the commentary from Delta this morning. And if you're just out there trading the market and you remain upbeat, you should also be concerned about what Delta had you told you this morning. It's another company warning that higher energy prices are going to really impact its bottom line to an extent that many strategists and analysts probably haven't really factored in yet.
Yeah, well, we are going to get some more perspective on those Delta earnings from Ed Bastian, the CEO, or Adam Shapiro had the chance to speak to him. And we'll be getting those comments just a little bit later in the show. So looking forward to hearing what he has to say about all of that. There you see, we're going to hear from him at 9:50 this morning. Right now, though, we're going to take a break. And when we come back, we're going to be talking about a new partnership from Tonal, the at-home workout system. See the gentleman there involved in that partnership. We'll be right back.
Some breaking news that just crossed our desk. At-home fitness player Tonal announcing that NBA great LeBron James is now an investor and brand partner of the company. James will appear in Tonal's new advertising campaign as well. Joining us for our first on Yahoo Finance interview is Tonal's founder and CEO, Ali Oradi. Ali, good to see you again here. Pretty big development for you on LeBron James. How did you score him? Because James is notoriously picky on who he invests with. Ali, I think you're on. There you go. I'm sorry, I thought you were on mute. Go ahead.
No, thanks. It's something we're extremely excited about. The relationship with him started about 18 months ago when he first joined Tonal as an investor. And how it started isn't all too different from other athletes who've invested. We have about 20 to 30 professional athletes who've invested in our business. And the story is always they got a Tonal, they used it, they fell in love, and then they wanted to invest. And over time, we've just built that relationship, and being someone who works with equipment basically his entire career, has been around fitness his entire career. When he sees something like Tonal, adaptive digital weights, something that's incredibly efficient, something that's incredibly data driven, he had to use it, and a partnership made perfect sense. He was excited about it, and we were able to make this happen.
Ali, you see the list of athlete investors you have: Steph Curry, Drew Brees, Serena Williams. Is LeBron now the biggest athlete investor in your company?
LeBron is definitely he's without a doubt one of the greatest athletes of all time. We're really, really proud to have him involved in the business. We're excited. He's excited. And you know, the most important thing that I can say about this is he's been using Tonal to train. He actually believes in the product. It's something that he personally uses. He views strength as a foundation of greatness. And this is something that came up in a lot of our interactions with him. And being able to get stronger with the most advanced piece of equipment ever created is something that he's really, really aligned with. This is something that, of course, we've seen with the likes of Serena Williams and Steph Curry and dozens of other athletes who use the product for that exact same reason. And he's just adding one of the greatest athletes of all time to our roster, and having him be involved with us in this capacity is just a huge, huge step for us.
Hey, Ali, it's Julie. Obviously, when you get these folks sign on as investors, it's something that can potentially prompt more people to sign up and buy the product. How many people have bought the product? How many of these have you sold? And how has your sales growth been?
Well, we have not been talking explicitly about numbers in terms of dollars sales. But what I can tell you is we did last year announce that we grew 8x year over year, which is massive growth. In January of this year, we raised $250 million at a $1.6 billion valuation, and we've seen significant growth since then. And so when you're looking at those valuation numbers and the multiples that you would assume are behind them, you can extrapolate the rate at which we're growing and how many Tonals we're selling. I'm just going to tell you, it's a lot. It's significant.
Ali, do you expect some form of shakeout in this at-home fitness space? I see you guys, very innovative product, Peloton, very innovative product. But I see something like a Mirror, I would say not too innovative, and you see other competing type products out there. Ultimately, over time, is there just two major players in the space?
Well, we are the leaders in connected strength. We're also the leaders in intelligent fitness. One of the things that we did differently from everyone else in the sector is our aim to bring a personal trainer into the home rather than just a group fitness experience. We did that by bringing a lot of data to bear, by building AI and personalization. And we really view that as intelligent fitness, not just connected fitness. So we're forging ahead, and we're leaders in multiple dimensions. We've built all sorts of moats around our business. We filed over 45 patents to date. Of course, there is one business that you mentioned, Peloton, which is significantly larger at this point, but we're growing faster than they historically grew. And then you're right. After that, there's a lot of smaller businesses who are building more point or niche solutions. And I do expect that that's going to shake out over time. I don't believe this is a winner take all market, but I also don't believe it's a market where we're going to have room for a dozen different players.
And Ali, news out today that Apple is having trouble just getting components for its iPhones. I mean, how does your supply chain look in this environment?
I'll just tell you, it's a lot of work to secure supply. We've tripled the size of our manufacturing team just in the past 12 months. And the 12 months prior to that, we 10x our manufacturing capacity. We brought a second factory online last year, bringing another factory, a third factory online in the next few months. And a lot of this is just about securing materials, securing capacity, keeping supply chains moving, and logistics, just moving product around the world and across the country. It's hard work, and it's where we're making a lot of investments. The vast majority of our investments are either going to marketing, brand, operations, or content, where you might have heard, but we recently announced live content on our platform as an addition to the many forms of content that are available to our members.
And Ali, I know you've been asked this before, and I'm going to ask it again, what the IPO plans are. And if you're not ready to IPO now, sort of what you're looking for, what would be the trigger? What would be the thing that would mean that you're ready to go there?
Well, we've been building towards it. In the last 6 months alone, we brought in a number of new executives into the C-suite, and operations, product experience, technology. And a lot of that is about readying the company for an IPO. We still have a lot more building to do in terms of operations, finance, infrastructure, and a lot of the compliance things that you need to be public. But it's something we're working towards every single day. We're going to look for that moment in time where being a public company is beneficial to us and is not a distraction. Being public can often take a lot of management energy, and right now we're growing so fast that we just want to focus on supporting that growth rate. And really supporting our member base, which is incredibly passionate about our product. We have a net promoter score that is pretty stable at 85. We have the highest engagement in the sector. And those are metrics we certainly don't want to lose track of just to become public. We'll become public when we can pull off being public, tap those kind of public capital markets, and make sure that our business is solid throughout the entire process.
Well, we'll see you back on Yahoo Finance when that big day happens. Tonal founder and CEO Ali O'Rady, good to see you.
Thanks for having me.
Earnings season has started, but Apple is stealing the headlines, and it doesn't report earnings for a few more weeks. More on this coming up.
just getting warmed up here with earnings season. We talked about JPMorgan and Delta numbers, but we're not done. BlackRock reported its numbers as well this morning. Assets under management down slightly to $9.46 trillion. As you see there, the company's earnings per share and revenue did beat estimates. And CEO Larry Fink has really emphasized ESG for BlackRock, and that's something he talked about in the company's statement as well. Demand for ESG remains strong, with $31 billion of inflows across our sustainable active and index strategies. Although when you're talking about $31 billion of inflows and the company's overall assets under management are $9.46 trillion, you see there that there's still a long ways to go when it comes to ESG strategies for the company and for the industry more broadly. Nonetheless, you know, this like what we saw to some extent for JPMorgan, even though assets under management fell slightly, still illustrates the sort of robustness of people investing right now, and not just people, but pension funds and asset managers and the like, Brian.
Yeah, we also saw that within JP Morgan's wealth management business. I mean, sales in that business up 21% year over year. But I look at BlackRock's stock price. It's up about 2.5% in the pre-market. JP Morgan a little under pressure, Delta under pressure. So far, to kick off this earnings season, BlackRock is the winner. The market likes what it is hearing from a BlackRock. It is the third trending ticker on the Yahoo Finance platform right now. Now, if I did have to throw any red flag in this quarter, it's on costs, and it's just a drum I will continue to beat this earnings season. Operating margins for BlackRock, 45.8% in the most recent quarter, 47% last year. Whether that's having to pay people more, it costing more to keep the lights on at their various headquarters, whatever it is, there's inflation there in these investment banks and asset managers like a BlackRock, and it showed up in their profit margins.
Yes, although interestingly, to take the other side of it a little bit, yesterday, of course, we talked to an analyst at Jefferies, their head of sustainability strategy, who mentioned that, maybe we should be looking at those kinds of costs as a feature, not a bug. In other words, if you are investing in something with human capital, so-called, as one of your criteria, and it's a firm that not only pays well, but has a broader corporate culture that is good for employees, that could be a sign you actually want to buy something, and you shouldn't be as concerned perhaps about the margin. So just to flip that on its head a little bit, I thought that was a really interesting point that he made yesterday, Brian.
I appreciate your upbeatness. Can't always be Brian the Bear here. I appreciate it.
All right, let's talk about something, though, that maybe is not upbeatness this morning. And that was a report that we got on Apple late yesterday. It was a source by Bloomberg citing people familiar with the matter, saying the company is likely to slash iPhone 13 production targets for 2021 because of the chip shortage. Now, Apple, as we know, has been pretty resistant to that chip shortage, has managed to keep its supply chain pretty intact. That, though, may be changing. Maybe it is not immune to that. So 90 million new iPhones is what the company had projected to manufacture in the last quarter of the year. But again, according to this report, it's now telling some of its partners that the total is going to be lower. Some of its suppliers, like Broadcom, like Texas Instruments, are having trouble delivering the components it needs. What's interesting here, Brian, is you would think that this would be bad news for those Apple shares, but we're not seeing that much of a reaction, perhaps because they've pulled back a decent amount already.
Surprised it's not. You're not seeing a bigger sell-off in Apple, and it did sell off a little bit more when the news hit the wires a couple hours ago, or yesterday afternoon, I believe. Interesting note, though, by Goldman Sachs' Rod Hall, pointing this out that, quote, it remains our belief that Apple will find it increasingly hard to grow revenues and may well experience declining revenues for a period as the company laps positive COVID effects. So I know that the stock is not selling off a ton right now, but even still, I mean, there are concerns, at least for Apple, over the next couple quarters because of these supply chain disruptions.
Yes, most definitely. It's something we should continue to watch, and continue to watch those component suppliers and those manufacturing partners for Apple, like the chip makers I mentioned, and a broader swath of them as well. We got the opening bell here this morning coming up in about 10 seconds, and Ashford is ringing the opening bell this morning. It's a hospitality and travel company, so they're ringing. Maybe we have some of those early indications on some of those chip makers we were talking about to see how they are trading as we get underway here this morning, even if Apple itself was not feeling a big negative effect. I know that yesterday we saw Micron shares, for example, sell off. By the way, our opening bell coverage is brought to you by PIMCO. And then in terms of some of the others, speaking of chip makers, we're also watching Qualcomm, and that's because that company announced a new buyback authorization, $10 billion worth. I know you saw some research about Qualcomm as well this morning.
Yeah, Qualcomm really dropping the hammer here on the stock buyback. Wow. But look, yeah, a good note out of Deutsche Bank talking about this buyback, really voicing their confidence in Qualcomm continuing to focus on diversifying its revenue. You know, we've talked to new CEO Cristiano Amon a few times and really learning about his efforts to push deeper into the car and other lines of business. But the street is liking what it is hearing from Qualcomm, that it can return this type of cash to investors, even while it diversifies out of its core chip business here, is a good positive flag. I wouldn't be surprised to see more positive notes off of this development.
Right, and just looking at some of the chips there, they are not seeing a negative ripple effect from that Apple news, at least not as we get underway this morning. Qualcomm, though, is trading higher by about 2.3%, and we have in general seen pretty good resilience in terms of the chip stocks in the face of what has been going on for shortages in this environment. Before we go to break, just want to quickly check on some of the big earnings reports that we covered at the top of the show, namely JPMorgan and Delta. As we talked about, JPMorgan coming in, beating estimates, as our Brian Chung outlined for us. It was really on the fee side, on the investment banking side, that the company's strength was shown, having to do with a lot of mergers and acquisition advisory fees. On the flip side, the commercial loan growth is still not back in business. And then Delta, that company, you can see trading lower by about 2.8%, even though it posted a profit here, warned about rising jet fuel costs. So that could be weighing on the shares. Again, we're going to hear from our Adam Shapiro's conversation with Ed Bastian coming up in just a little bit. But coming up next, we're going to check in with Jared Blickery and talk about what he is seeing this morning as the trading day kicks off. Stay with us.
Welcome back to Yahoo Finance Live on this earnings day, Wednesday. Let's head down to the New York Stock Exchange and check in with our very own Jared Blickery. Jared.
Well, a few things catching my eye this morning. 10-year T-note yield ticking down a few basis points, and that's coming from rather elevated overbought levels. 1.61% is the recent high, and could be an interim top. So if that's the case, well, today at least it's giving the growth trade a little bit of a boost, and we're seeing that evidenced by some strength in technology shares, also the industry groups of chip stocks and software. So nice to see that coming along, and the mega caps can probably participate too if we get a little bit of a backup in yields. If we continue higher, probably going to see the value trade take over. Is interesting that we're also starting earnings seasons, of course, kicking off with JPMorgan and Delta and the like. So a lot of banks going to be in focus over the next few days. But another thing I'm really watching here too is crude oil. WTI ticking below $80 a barrel. Brian, over the break we were talking about a technical formation. If you look at candlestick charts, kind of have a shooting star candle formation from a couple days ago. So remains to be seen if this is how long this potential top lasts for. But nevertheless, we are seeing energy lag today. Another thing I'm watching is China stocks, and we have KWEB, that's the Chinese Internet ETF that I like to watch. That's up a couple of percentage points. And even the solar ETF I was talking about the other day, TAN, also doing nicely. So energy lagging a little bit, but clean energy on the way up today.
Jared, what do you make, today really marks the unofficial start, or I would say actually the official start of earnings season. What do you make about the negative reactions to earnings reports from Delta and JPMorgan?
I think that's going to be par for the course. I think we're going to have an earnings season where we see where we have reactions skewed to the downside simply because we've gotten expectations very high. I've been reading several reports from the investment bank to sell-side analysts about what to expect, and it's probably going to be an earnings season of disappointment in the forward guidance. The headline numbers are going to beat as they usually do, but you dig into the report, you take a look at what they're expecting. I think there's going to be more storm clouds on the horizon like we saw with Delta today. Higher prices are here to stay, it seems.
Well said, Jared Blickery. Thanks so much. Bring on earnings season. Speaking of just that, despite supply chain problems and inflationary headwinds, third quarter earnings for the S&P 500 are seen rising 27.6% year over year. If that number is met or exceeded, it would mark the third largest year over year earnings growth rate on record, trailing the second quarter of this year and fourth quarter of 2009. Straight ahead, we'll leap into all things earnings season analysis with Schwab's Randy Frederick. Do stay tuned.
This is Yahoo Finance Live. We are digesting some earnings this morning as we look at some overall action in the major averages. That is not much of action, which is not necessarily unusual to kick off earnings season. Let's bring in Randy Frederick, Managing Director of Trading and Derivatives at the Schwab Center for Financial Research. Man, we have been waiting for these earnings numbers, Randy, and as we start to get them, what do you feel like is the tone of the market? I feel like we've sort of been bracing ourselves for this margin pressure. Now that it is starting to perhaps materialize, do you think that the market is going to be alarmed or sort of shake it off?
Well, it's difficult to say. One thing I think we have to keep in mind is that supply chain disruptions, inventory shortages, all those sorts of things are primarily going to affect manufacturers and importers, not necessarily service organizations, which if you slice the market into those two groups, 88% of the companies in this country are service organizations, not manufacturers. So that's a small segment of the overall, but it does tend to sort of lead the rest of the economy. So that's one thing to keep in mind. And we've had some big companies like Nike, like FedEx, and some others that have warned about things like that. But this week specifically, we've got banks, and that's the big thing. We got about 10 big banks announcing this week. I don't know that that's necessarily going to set the tone for the entire earnings season, but it's certainly going to set the tone for the financial sector this week.
Randy, the Delta earnings report bothered me on many different fronts. Chief among them, them calling out the higher or the rise in energy prices and how it might impact them in the fourth quarter. A lot of that we heard similar commentary from FedEx, even heard it from a Nike. Do you think we're one or two bad reports or more reports like Delta away from heading back to those lows we saw a couple weeks ago in the markets?
I don't think so for a couple of reasons. One, we had two really big sort of things out there that were causing us problems, and that is the debt ceiling and the government shutdown. We've now punted both of those things out into December. That's not very far out, but at least gives us some breathing room for at least half, if not three-quarters of this earnings season. But yes, there's no question high energy prices, all these other disruptions are going to continue to cause problems in some areas. But fourth quarter inevitably is a very bullish season. It tends to be the most bullish quarter of all four. We're coming out of about a 5%, almost 5.5% pullback here. So we've got a little bit of upside. I actually think that as this quarter progresses, we might actually trend more back towards the all-time highs rather than back down to the lows. Now, but it may take a little bit of while. Again, you got to get to about a 25% of companies reported into the earnings season to really get a feel for how it's going to play out. But there's no question those that have warned early, there are definitely going to be some disappointments, but keep in mind, the expectations bar was lowered substantially. We had about 90+% earnings growth last quarter. That now is expected to be only about 30%. So it has been lowered. And when you lower the expectations bar, you set up the potential for upside surprises. I actually think we're going to see some of those.
Randy, we've been so excited about earnings, we haven't even talked about CPI this morning, which was also exciting and interesting data to get on a month-over-month basis and on a core basis, actually coming in relatively benign, perhaps surprisingly, even though year over year, to still see that 5.4% gain is an eye-popping kind of number, right? It seems like the Fed is indeed coming around to the idea that inflation is more persistent than they anticipated. How is that going to feed through to rates? And, does that matter as we're going to see it percolate?
Yeah, so the year-over-year number, as you said, was 5.4%, but important to sort of focus on the fact that that is still being compared to a very low number back during the not necessarily the peak, but just past the peak of the pandemic last year. I sent out a tweet this morning that shows that if you sort of ignore the dip that happened in 2020 and do what most corporations are doing, which is compare your numbers to 2019, you'll actually see that we're not too far off of the long-term trend. And if you just do a little bit of an eyeball calculation, you can see that the real year over year, if we hadn't had the pandemic, would be about 3%, which is still fairly high because it's above the 2% Fed target of the Fed. But that's not nearly as sort of eye-popping, as you said, as the 5.4% number. Does this change the calculus for the Fed? And their implicit, though not explicit, plan to start tapering next month? I don't think so. I think they're on plan for that. I think Jay Powell and many of the other members of the committee have been trying to prepare us for this. No one should be surprised by it. I think the tapering starts as expected next month. this will probably take place over the course of maybe 6 to 9 months, which means we're still, 3/4 of a year away from the next interest rate hike. I don't think this number changes that calculus at all. And in fact, you saw the market reacted just a little bit to the negative. And as it often does within the next 5 to 10 minutes, it's gotten right back to where it was before the announcement.
And Randy, if one is upbeat about the stock market in what is usually a seasonally strong quarter, like you mentioned, what are some of the best trades they should be putting on right now?
Well, it depends on what you were looking for. So, like, one thing that, of course, has been floating around for a long time that hasn't yet been resolved, but we'd like to hope that it will be at some point, is an infrastructure bill, right? When you look at infrastructure, the two most logical sectors, and this is not counting other things that many people don't consider infrastructure, but traditional infrastructure type projects, generally industrials and materials, are two that tend to do pretty well. But as you know, people in the market don't wait for those things to happen. They try to front run it. And we've seen very good outperformance from those two sectors, specifically in anticipation of an infrastructure bill finally getting passed. Infrastructure seems like a simple thing. You've always got bipartisan support for it, but yet for 20 years, they haven't been able to get it done. So that may turn out to be a false run, but I think there's some anticipation that maybe that'll happen. Those are two sectors I'd be looking at. The other one, of course, as we were just talking about, is financials. And the reason for that being that interest rates are on the rise again. The yield spread is beginning to widen again, and financials, by and large, tend to benefit a lot from that. So if those rates continue to creep higher, as many bond experts tend to believe that they will, and in fact, we might head back up towards the highs we saw in the spring, that will probably benefit the financial sector as well.
All right, we'll be watching those groups. Good to catch up with you, Randy. Thanks so much. Randy Frederick is Managing Director of Trading and Derivatives at the Schwab Center for Financial Research. We are going to take a quick break. When we come back, the promised commentary from Ed Bastian of Delta following that company's earnings. Stay with us.
Delta is out with its third quarter earnings this morning. Let's go right to Yahoo Finance's Adam Shapiro, who chatted with Delta CEO Ed Bastian about the results. Adam.
Yeah, Mr. Bastian was understandably very proud of his team because they did become the first major carrier to report a quarterly profit since the pandemic began, $216 million. Now, to put that in perspective, if you go back to 2019, the profit in the third quarter was $2 billion. But the trend is in the right direction, and here's more of what he told us.
It was a strong goal of ours to be profitable through the summer. I was optimistic, it's probably a better word, not necessarily confident, but optimistic that we could do it, and the team did it. The variant hurt us a bit on revenue, not a lot, but a bit, as it hit the industry broadly, as a fair bit of business travel, other travel patterns stalled, didn't continue to grow. But the other thing that hit us equally was the rise in fuel prices, which escalated pretty heavily over the course of the quarter that are continuing into the fourth quarter. But the fact that we're profitable while still missing 1/3 of our revenue base, I think is a great statement about the resilience of the business that we've created and our opportunity to continue to improve it into the new year as demand recovers.
If I may, I want to talk to you about international as well as business, especially the strong numbers with Latin America. But very quickly, last question about August and September. Had we not had the surge in cases of the variant, I got to imagine these numbers would have been better, or was it not quite as big a negative impact?
No, it would have been better. We were anticipating a pre-tax margin in the mid-single digits. We delivered a pre-tax margin of 3%, so we were off, a handful of 2 to 4 points from where we could have been. So the variant definitely hurt us some.
So a couple of things if you look towards their guidance. One, they're not promising profitability in the fourth quarter because of the rise in fuel prices, up 60% since the beginning of the year. The other issue is scheduling. They've hired 8,000 people since the beginning of the year. And Mr. Bastian says they've not had trouble hiring people. We hear about the labor shortages at within other industries and other airlines, but Delta says they have that under control. Team?
And it's also interesting because there's a contrast with what's going on at Southwest right now, where there appears to be some dissatisfaction on the part of the pilots. Delta also, maybe not coincidentally, I don't know, is I think the only major airline now that's a holdout in terms of imposing a vaccine mandate. It has done other sort of levers to get its workforce vaccinated. What did Bastian have to say about that?
No mandate. He said that they left it up to the employees. However, employees who did not get a vaccine would have to get tested every week before they could go to work. And they also had to pay an extra $200 every month for their health insurance, because that's what Delta was going to have to pay to cover with health insurance their employees who were not vaccinated. So that seemed to motivate quite a few people, because Delta says 90% of its entire workforce has now been fully vaccinated.
All right, Adam Shapiro, thank you for bringing us that interview. Appreciate it. All right, speaking of travel, all eyes are on 90-year-old Star Trek legend William Shatner as he prepares to head to space for real very soon. There you can see Shatner and his fellow soon-to-be space travelers going to visit space. That flight, I should note, has been delayed for about a little more than 30 minutes, but we'll have live coverage of that expedition coming right up. Good Wednesday morning. Welcome back to Yahoo Finance Live. I'm Brian Sozzi, joined as always by Julie Hyman. Earnings season has officially started with results at a JPMorgan and Delta. Let's see how the markets are taking some of these reports in the early going here. Seeing some increasing moves to the downside. Let's put it that way. The Dow is down now 137 points. The S&P 500 in the red. The Nasdaq slightly in the green. Also worth noting here, we did have somewhat of a hot CPI report, so the market may not like that as well. But again, lots to digest on this Wednesday morning. Now, having said all this, how can we not cut to Captain Kirk right now? Julie, William Shatner, he's off to space. I know the trip is a little delayed, but he will become the oldest person to travel to space. And there you can see Captain Kirk, along with his other fellow space travelers there. Audrey Powers will be on that flight, a Blue Origin vice president. Chris Bosthuizen, I think I got it right, co-founder of Planet Labs, and Glenn DeVries, a CEO and co-founder of Metadata Solutions. So William Shatner in good company here.
Yeah, and that, by the way, is an earlier feed of what was going on. Right now, it's T-minus about 32 minutes until the launch on that new Shepard rocket. And again, provided everything goes smoothly, he's going to be the oldest person ever to have gone to space. He is going with a couple of folks who are scientists and engineers from Blue Origin, as well as from other companies. So we'll be continuing to monitor it. And we'll bring you back to it when it actually happens, which is pretty cool. Jeff Bezos, by the way, on Instagram yesterday showed some drawings he did as a kid of the communicators and such from Star Trek. So obviously he's a fan going way back.
We wish them a very safe travel, and it's a fun time to be in space, no doubt about it. From Captain Kirk to another Titan, Jamie Dimon at JPMorgan, the longtime CEO, is probably feeling pretty good after the much better than expected earnings report out this morning. Yahoo Finance's Brian Chung has been monitoring JPM's earnings call and is here with an update. Brian.
Good transition there, Brian. But yes, as you mentioned, JPMorgan Chase kicking off the third quarter earnings season with some numbers that beat the street's estimates when you consider they clocked in $30.4 billion in revenue on the top line. On the bottom line, they had earnings per share of $3.74, beating the street's estimates of $2.97. This was all really helped by the fact that they released about $2.1 billion in credit reserves that they had set aside to absorb any sort of credit losses during the depths of the pandemic. This is expected to be a running theme for the other banks as well, who have also been slowly releasing those reserves over the past few quarters. And the big story for JPMorgan Chase remains, again, leaning on those investment banking and asset wealth management businesses. Non-interest revenue up by 3%. That's a lot because of a knockout quarter for M&A and IPOs that was massively profitable for the bank, and explains a lot why their commercial banking clocked in at $1.3 billion in gross revenue. That's more than I've ever seen in my lifetime, or also the JPMorgan Chase's lifetime as well. That's a record for the bank. Again, all of this has been subsidizing the more tepid growth in loans in their credit card business lines of credit. Their overall average loans were up by 5%, but their credit card business, which a lot of people have been looking at as a sign of economic health, has actually been down 2% in the quarter. But again, we're hearing from management that they expect that to maybe change soon, with the consumer maybe not repaying down as much in quarters to come, which might fuel a little bit more lines of credit, at least in their consumer credit card business. One other point I want to kind of mention here, we just wrapped up the earnings call from JPMorgan Chase, and CEO Jamie Dimon was talking about inflation. He said that he doesn't necessarily see any sort of tamping down before late 2022. JPMorgan Chase's CFO, Jeremy Barnum, also saying on the call that he's concerned about inflation. All of this coming as the government data this morning showed a CPI on a headline basis increasing by 5.4%. So definitely something worth watching from the not just the vantage point of the nation's largest bank, but also from a macroeconomic standpoint as well, guys.
You, Brian Chung, our Titan. Thank you for that perfect segue to our next segment. We'll check back with you later. Speaking of red-hot inflation, today's CPI report came in a little worse than expected here, a little hot. Let's dive in here. Matthew Lazzetti is Deutsche Bank's chief U.S. economist and joins us now. Matt, top takeaway here.
Sure. Thanks for having me. I think the top takeaway is, inflation is still running hot. It's well above the Fed's target. I think within the details, the most important point was rental inflation was the highest that we've seen since 2001, so in about 2 decades. And so while the print itself was not all that much stronger than expectations, I think from a forward-looking perspective, it is actually telling you that inflation is going to be higher than people anticipated heading into 2022.
And Matt, it's Julie here. You talked about one component. I was also looking at the hourly wages, which actually ticked down. Although if you look at total compensation, including things like how many hours worked, you saw an uptick there. So how are you looking at that particular input as we head into the final months of the year?
Sure, it's been a difficult tug of war, I think, here between nominal wages going higher, and we saw that on Friday with average hourly earnings printing above expectations. But inflation, for the most part, eating away at that and stripping away a lot of those nominal wage gains that we've seen. So if you focus on wage gains minus inflation, they've been negative for a period of time here, given that we've seen inflation picking up, particularly on a headline basis, and energy prices driving a lot of that. I think from the Fed's perspective, that is one reason why they've said that they don't think that this is going to be as persistent, because they would want to see wages running above productivity growth. And real wages running above productivity growth, and we haven't seen that as of yet. But I think today's data, at least on the rental front, does tell you that the rise in inflation is probably going to be a bit more persistent than what the Fed had anticipated previously.
Matt, maybe you could poke a hole in this. There's this thinking, and at least from the folks that I talk to, so when the Fed starts tapering, that will bring inflation down, but it doesn't work that way.
No, so I think even from the Fed's perspective, it wouldn't work that way. What tapering is it's reducing their pace of asset purchases. So they will still be adding to their portfolio. We think likely through the middle of next year. They'll still be actually providing accommodation to the economy. And so we don't think that they're actually going to be removing accommodation by raising interest rates until late next year. Our forecast, which we just changed recently, is that the Fed will raise rates in December of next year and then 3 times in 2023. And I think the data that we've received over the past several days really just supports that. The inflation data this morning, yesterday we got information from the New York Fed, their consumer survey for inflation expectations continue to move higher. And so I think what you've seen from a market response to this data is really bringing forward expectations for the Fed raising rates, with at one point this morning, the market pricing even September of next year for the first rate increase.
Hey, Matt, here's the thing, though. Even if the Fed was going to raise rates tomorrow, rather than just tapering or at its next meeting, would that do anything to inflation? I mean, if the source of inflation in this case is mostly hot demand and supply bottlenecks, the Fed raising rates is not going to help the port delays, right? Or manufacturing delays. So, you know, or maybe I'm wrong here. I mean, maybe it would have an effect.
No, I think you're absolutely right. I mean, from a typical monetary policy perspective, you don't usually respond to something that is explicitly a supply shock, because as you mentioned, the Fed can't help with port delays. They can't help with chip production. Essentially, they're raising interest rates to try to tamp down on demand. What I think you have at this moment is fiscal policy has been obviously very accommodative over the past year. It led to a surge in demand. That surge in demand has met supply constraints. And so is to try to disentangle these two effects, supply versus demand. On certain areas and categories, you know, new vehicles, used cars, that's been a very clear area where I think supply constraints have been binding. On other areas, such as airfares, lodging away hotels, where you've seen a lot of price pressures there as well, that I think has been more demand driven. And so depending on what you're looking at, it's a relative support for supply versus demand. I think from the Fed's perspective, they're worried about two things. One, demand is hot in a number of areas, and two, inflation expectations are moving higher. And so the Fed, by responding to an economy that does look hot, can help to bring back down inflation expectations and hopefully lead to lower inflation over the medium term.
Matt, how many rate hikes are in your expectations for next year? And then off of that, do you think the economy, I mean, how do you think that will impact the economy?
Yeah, we have 1 rate increase next year in December, 3 the following year in 2023, and then 3 more in 2024. So getting up to almost 2% on the Fed funds rate at that time. We do think that it will slow the economy, but I think it's important to keep in mind two things. One, you know, we have estimates of what neutral monetary policy is, and that's kind of the threshold that really begins to impact demand. And in our mind, it's not really until you get closer to 2% on the Fed funds rate. The other thing to keep in mind is that this economy, I think in many ways, is less sensitive to interest rate increases at the moment. It's mostly being driven by the services sector, and it will be mostly driven by these supply constraints easing and production and inventory rebuilds coming back. So I think it is not as much a story about housing, consumer durables, those things that are typically very sensitive to interest rates. So I think you have an economy that will be just less sensitive to interest rates. So we will see the economy slowing as the Fed tightens policy, but perhaps not as much as you would have expected given history.
Matt, finally, I feel like recently I've been contractually obligated to ask all of our economist guests this: stagflation. And I don't think we found anyone who thinks it's happening yet. But what's your view on that word that's been bandied about a lot more lately?
Sure, I think it's certainly out there a lot. And I think what it's referring to in the moment is growth forecasts coming down, supply constraints really clearly hitting production and growth expectations. But at the same time, those supply constraints are lifting inflation. And so it's a clear negative supply shock as we typically think of it. I would not think of it as stagflation at the moment. Our forecast for growth next year is still above 3%, which from a pre-COVID perspective is actually really good. Trend growth or potential growth in the U.S. economy is around 2%. So we still expect growth to be enough to see the labor market tighten over next year. So I think it's it's being spoken of in a word where growth is coming down and forecasts are being downwardly revised and inflation is being revised upward. But I don't think we're in a stagflation world from the perspective of growth actually being negative and the labor market reversing course and actually deteriorating.
Real helpful insight. Matthew Lazzetti, Deutsche Bank Chief U.S. Economist. Thanks for coming on. We'll talk to you soon. All right, on the other side of the break, Julie runs down the biggest business headlines you need to know about. And of course, we also continue to monitor William Shatner going off into space. About 22 minutes away, we'll be following that live. And we'll be right back.
The House of Representatives approved legislation yesterday to temporarily raise the U.S. debt limit, averting a default for about 3 months, possibly more, given the money that they authorized. Next stop for the bill is President Biden's desk. He's expected to sign later this week. And as we've been hearing from guests, this does remove one of the big overhangs for the market for now. International travel may ramp up again right before the holiday season. The U.S. is reopening its Canadian and Mexican land borders for fully vaccinated travelers starting in November. This comes after the country closed its borders for nearly 19 months. Unvaccinated travelers will continue to be banned, and those that have been allowed to cross the whole time, including folks like truck drivers and students, will have to show proof of vaccination starting in January. The Food and Drug Administration has, for the first time, authorized an e-cigarette for sale in the U.S. It's British American Tobacco's e-cig Views. The agency cleared tobacco-flavored products only, saying that these products are less appealing to youth than fruit-flavored ones. The FDA is currently reviewing roughly 6.5 million applications for e-cigs, including from major player Juul. Brian?
All right, let's get a quick market check with Yahoo Finance's Inez Ferre, brought to you by PIMCO. Inez.
And Brian, we're taking a look at a mixed picture for the markets. And NASDAQ slightly in the green. You've got the Dow that's down about 0.7%. You've got the S&P that's down about 0.4%. But I want to take a look at oil because we have been seeing oil slipping this morning on our Wi-Fi interactive board. You can see WTI is down more than 1%. You've got Brent crude that's down more than 1%. The IMF yesterday cutting its global growth forecast because of supply chain concerns and also cost pressures. But you have those higher gas and coal prices that are expected to create more oil demand. And that's why you have seen oil over the last several weeks rallying. If you take a look at a year-to-date chart for WTI, that's up 67%. Brent crude is up 61% year-to-date. We're also checking out the travel stocks this morning because we did see that Delta reported its quarterly results, beating on estimates, but warning about the risk of rising fuel prices, putting pressure perhaps on its bottom line. So that warning is putting pressure on the stock today, down 4%. And you can see UAL also down, American Airlines down as well. Taking a look at the Dow components where we're at, we're watching a JPMorgan down 2% after beating on estimates for its quarterly results. You also have Apple that's down more than 1%. Bloomberg had a report saying that Apple is likely to cut its iPhone 13 production target because of chip shortages. Well, now analysts are coming out to comment on that, saying that this could hurt the holiday quarter, but this issue is seen as temporary, with Evercore saying that this could be transitory, and Wedbush saying that this is a speed bump along the way. And finally, I want to look at the EV space because we are seeing some movers here. We're looking at Plug Power, the hydrogen fuel cell company. That's up more than 9%. It's teaming up with Airbus, looking at hydrogen-powered planes, perhaps. Also, it was raised to overweight at Morgan Stanley with a price target of $40 a share. If we take a look at a 1-month chart, you can see that this stock is up 34%. And finally, checking out a Ride, Lordstown, that's up slightly, just 0.5%, naming a new CFO, Adam Kroll. He'll be replacing the interim CFO. But over the last 6 months, the stock is really down about 52%, Brian.
Good luck with that gig. Inez, hey, you're a big space fan. No question about that. Any thoughts on William Shatner getting ready for blastoff?
Oh, yeah, I think it's fabulous. This is going to be an 11-minute journey about 62 miles away from Earth, the oldest person to be going to space. This is just the beginning of space tourism and this race to get civilians to go into space or to suborbital flights. So an exciting venture, and I'm really looking forward to seeing this liftoff.
Yeah, you and me both. There you see that live shot, William Shatner and his crew getting ready to head off and blast off into space. Very, very interesting watch. Inez Ferre, thanks so much.
Thank you.
All right, climbing for a cause. We're back with the CEO of Land's End, who just hiked up Mount Kilimanjaro in support of his daughter, who is battling breast cancer. Stay tuned for that chat next. It's Breast Cancer Awareness Month, and today we highlight one executive's effort to help find a cure. Land's End CEO Jerome Griffith and his wife recently took a 7-day trek up Mount Kilimanjaro. The expedition was a mission to raise awareness and funds for fighting breast cancer. It was also a personal one. Last December, Griffith's 32-year-old daughter, Samantha, was diagnosed with metastatic breast cancer. Land's End CEO Jerome Griffith joins us now. Jerome, always nice to see you here. So take us through this trip. What was it like, and how did you decide on doing this?
Thanks, Brian. Appreciate it. Right away after Samantha was diagnosed with breast cancer, a few things happened. One was we got in contact with the Breast Cancer Research Foundation, found out a lot about what work it is that they do, and they were extremely helpful in finding the right doctor and the right treatment for the type of breast cancer that my daughter had. So we were very appreciative of that. And Samantha already got involved with them and said, you know, I'll tell my story, I'll be in your ad campaigns, whatever it is that you need in order to increase awareness. At the same time, I had a couple of employees who I work very closely with, both were diagnosed with breast cancer as well, same type as my daughter. And my wife had always had this dream to climb Kilimanjaro. And she said, why don't we do it? And why don't we do it to raise awareness for breast cancer and make it a fundraiser? So we said, okay, let's go do it. Now, everyone tells you it's the hardest thing that you'll ever do in your life. And you're thinking, well, what do you have to do? And they're like, well, put one foot in front of the other. It was that, but it was a lot harder than even that. I was told that you'll be freezing cold and you won't feel your feet and you won't feel your hands and you just won't care because you've got other concerns. And they were correct. But we did make it. My daughter did say, don't come back, Dad, without making it to the top of the mountain. So we did. And it was a great time. I think our employees really enjoyed it as well. We've had several activities going on campus or near campus because we have 42 people in the company right now that either have had or have breast cancer. And it just raises awareness and raises the ability to continue to raise funds for the good work that BCRF does.
Jerome, it's Julie here. As someone who has lost a loved one to cancer, not breast cancer, but still, I know how frustrating it can be, and how frustrating it is that there is still not a cure for most types of cancer. And so as you are going through this journey, and both a literal journey to the top of the mountain and a figurative journey as well, what would you tell other families? What is the message you want to convey to researchers as well as they are on this quest to try to make progress?
You know, the researchers are extremely important. The money that goes through BCRF, 100% goes to research and the researchers themselves. So I think that that's important in itself, that you know where your money is going. Secondly, without the research, you're not going to find a cure, or you're not going to find good treatments. They're even coming up with, better treatments over the course of time to help people live a much longer, more productive life. So it's become, some of these things aren't important to you until it touches you in one way or another. And between work and at home, it really hit home this year, and we wanted to do something about it. I think it's important that people stay focused on getting the research done, because if you don't do that, you're not ever going to cure this. And I have to tell you, with what you go through personally, you don't want any other family to have to go through that.
Jerome, how has this experience changed how you think about leading your company? You mentioned that 42 people inside of Land's End have been battling breast cancer. I would say that a lot of other executives wouldn't know that stat right now.
We work in a business which caters to women, and we work, our executive staff, our board, our workforce is very predominantly women. And I think you have to deal with what the issues are to them. And this is a big issue to our employees, and it's a big issue with our executives. I've gotten a lot of comments that I never thought I would get from the group about what it is that we did. And we're very proud of it. We have the Land's End Comfort Fund, which supports a couple of different charities, this being one. And we try and make it things that are relevant to our employee base and relevant to our customer base as well.
And Jerome, if you would allow me to switch gears, I do want to talk a little bit about the business here. The last time we got a business update from you guys, still seeing strong demand. The dynamics throughout the apparel industry at this point, obviously, is we're mostly seeing strong demand and supply bottlenecks. How is that dynamic looking for you guys right now?
Similar to what you just said, we just went through 3 days of non-deal roadshows and investor conferences, and supply chain was the first thing that we got asked consistently. On the positive side, you sort of knew it was coming. You knew there was going to be a bottleneck because you understand, this isn't the first time we've done this. So you understand that there's bottlenecks coming. It's really, how you end up mitigating what those issues are. And I think everyone has different issues based upon where your manufacturing base might be or where you are in the product life cycle. So, it's a real issue. It's out there. I think it affects everyone. And I think probably your people that knew it earlier on and were trying to take as many mitigating actions as what you possibly could will end up being winners over the holiday season. But the holiday season is long. And, there is high demand out there and customers still love to shop. And this is my 43rd Christmas coming up and 43rd since I've been working. And, everyone's tougher than the one before. So this will be an interesting one.
Well, of course, we're wishing your daughter, Samantha, a speedy recovery. Land's End CEO Jerome Griffith, always good to see you. Have a good rest of the week.
Good to see you guys. Thanks a lot. Bye-bye.
Still to come, corporate America is smack in the middle of trying to build the future of work as we claw our way out of the pandemic. We'll talk more about this with Prudential Financial Vice Chairman Rob Falzon. Straight ahead.
Mixed picture for stocks right now. Let's go right to our Jared Blickery with a check on the action.
And let us check out the Wi-Fi Interactive. There we go. A little bit of weakness to continue what we've seen earlier this week. And let's get a look of a 3-month chart here. I'm also going to put a 50-day moving average. This is a key technical level that was rejected last Thursday, and we've been heading down basically ever since. So want to keep an eye on that as well. As you said, a mixed picture, though, because the NASDAQ is in the green, but only by about 2 basis points here. I do want to check out what's happening in the bond market. So the 10-year T-note yield, that is down another 4 basis points. My theory has been that after reaching 1.6%, 1.61% actually, that we're going to back off potentially, but we have no clue how long this will exactly last. In the meantime, tech and semiconductors and software, they're all getting a boost today, except for Apple. You can see that stock is down about 1.3%. We've been talking about them not being able to manufacture as many iPhones as they had hoped, but we are seeing a pickup in Chinese stocks as well. And let's take a look at that board. I was talking about KWEB, that's the Chinese Internet ETF down at the New York Stock Exchange, and we're seeing Pinduoduo up over 4% today. Now, the travel sector was bid yesterday, despite being a down day, but not today. And that's on the back of those Delta airline, announcements, earnings that we've been talking about. A disappointing outlook for the price picture here. Inflation, especially when it comes to jet fuel, definitely here for a while. I want to check out the sector action. And we do have communication services and tech just barely in the green by a few basis points, followed by consumer discretionary. That is an outperformer, but in the red. And then to the downside, financials, energy, real estate, industrials, the value trade really falling off today, along with that compressed yield curve. And got to take a look at the banks, because we have JPMorgan after beating on earnings, but maybe not delivering the blockbuster results that shareholders had looked for. JPMorgan is down about 2.5%. And here's another name, Capital One. That stock is down 4%. But we have seen bank stocks on a tear lately. You can see Capital One up 62%. And I'll get a longer term chart year to date of JPMorgan Chase, 27%. Just a few days ago, we were talking about record highs, but not today, guys.
Not today, indeed. Look at all that red for the banks. We'll see what happens with them for the rest of the week. Should be quite interesting as we get more reports. Coming up next, we're going to talk about the state of the American workforce. A lot of people there are out looking for jobs. In fact, nearly half of them, according to a new survey. We'll have the details next. nearly half of American workers are either actively looking for new jobs or considering starting a new job search. That's the finding of Pulse of the American Worker, which is a new survey conducted by Prudential with the help of Morning Consult. Rob Falzon is joining us now. He is Prudential Financial's vice chair. Rob, it's great to see you. You know, there has been sort of this central mystery, right, at the center of what's going on in the jobs market here. And I think that this survey gives us a little bit more insight as to into what's going on. I mean, that's an awful lot of people who are thinking about switching jobs here. What do the findings tell us about what's behind it?
Well, first, some confirmation coming out of the labor statistics yesterday, right? So record number of resignations, quits, 4.3 million. And actually, Julie, if you look at that number over the last 6 months, it's like 20 million people have resigned their jobs over that period of time. That's 15% of the total labor force. It's probably closer to 20% of the private sector. And so, what's driving it? Well, first, working in a remote environment has caused something I call disassociation. So individuals are sort of less attached to their jobs, to their companies, to their coworkers than they were when they're actually in the office and able to work with those individuals. And that disassociation has sort of set a stage for them re-examining what they're doing. And as they think about their careers, what's on their minds is, outside of compensation and benefits, which is always important. And frankly, in this environment, the benefits piece of that is probably our earlier survey is showing a higher priority even than the compensation side of it. But beyond that, it's around career development. Many of them are completely rethinking their careers and the direction, thinking about job switching. And flexibility that they want on a go-forward basis. And many of those things they haven't been able to fully achieve in their existing positions during the pandemic.
Rob, 71%, at least according to the survey, 71% of managers with open positions say the applications they are receiving are from workers that don't have the right skills, or the skills gap we continue to focus in on. How can we close this gap?
Well, so it's, I'm calling it a canyon, Brian, as opposed to a gap, because it's, it started out as a skills gap. And what's happened is, as a result of the pandemic, you've seen an increasing widening of that. And our survey showed, 30%, and early in our surveys, 30% of the individuals who responded said, I don't know that I have the skills that I'm going to need for my job. That went to 50% in a survey we did a couple surveys ago. And now the number has gone well north of that in terms of individuals who feel like what's happened on the technology and data front has sort of outstripped where they are. So it's going to require an investment that we make in skilling American workers. And I think we, as I call it, all of the above. It's, corporations have to lead. We have to invest in our talent because the reality is we're not going to be able to hire our way out of this problem. So we're going to need to train our way out of it. But I think it goes beyond that. I think public policy and, institutions, academic institutions and others need to be engaged in creating the opportunity for individuals to do skilling in order to make themselves relevant to the jobs that are getting created today versus the jobs that they had. What's interesting is we have this phenomenon of resignations. At the same time, we've also got almost 10.5 million open positions that are unfilled. And that's, as a result of that 71% not being able to find talent with the right skill set.
And one of the other interesting, relevant findings of the survey is that 58% of the folks who surveyed say it's been harder to learn new skills in a remote environment. Now, I know a lot of companies, even when people are in the office, do sort of virtual trainings and such. And so I wonder if a finding like this might cause them to rethink that a little bit.
Yeah, so you need to make investment in your training because, while a lot of training, Julie, to your point, can be done remotely and online, and in fact, I think the majority of it actually can be done that way. There is an absence of, something that's absent when you don't have the opportunity to engage live with people. Having said that, I think what's really happened, Julie, is that as a result of what we've been going through, both the pandemic and its economic repercussions, that employers have kind of stepped back from their engagement with their employees and their training of the employees. And so if those programs are there, they haven't, employees are having a hard time finding the time to fit them in because they're all working, frankly, longer and harder remotely than they were when they were in the office. And employers have, focused on other important issues and perhaps have not invested in keeping that information, that training as fresh and relevant as it ought to be. And the economy has moved dramatically in the last 24 months. And so if you had training programs that you had stood up 24 months ago, they all need to be, if not brushed off, thrown out. And you need to reorient more toward, what the needs are for, if you look at company by company, we can look at, where we're having challenges filling roles and gear our training to develop skills to fill those roles.
And the survey discusses, Rob, this erosion of corporate culture may be causing more people to leave. Is that one of the biggest risks to a full economic recovery, that companies lose their soul and they're just not as productive?
Yeah, I think that the challenge, I think about it from two perspectives. One is, as employees are less engaged with their organization and the culture, they're less engaged with their work. That's going to lead to lower levels of productivity. That's not a good thing for us. The second part is that if to the extent we're not investing in the skilling of those employees, they're not reaching their potential. If they're not reaching their potential, we're going to have a suboptimal GDP versus what we're able to do with the labor pool that we've got. So again, it's about investing in those individuals. And I think on the first part of that, we need to bring people back into the workplace, but probably bring them back in a way that allows them the flexibility that they've enjoyed while they've been remote, so that they can continue to benefit both from the remote environment and from what you get from being live and in the workplace.
Prudential Financial Vice Chair Rob Falzon, always good to see you. Have a great rest of the week. All right, the battle to manage next-gen money is heating up, with the likes of Coinbase and Robinhood duking it out for pole position. And this is where we find the Yahoo Finance call of the day. Autonomous Research is out initiating coverage of Coinbase with an underperform and Robinhood at outperform. Christian Ballou is the analyst who made these calls, and he joins us now. Christian, good to see you this morning here. Wow, on your call on Coinbase. Couple things here. First up, why do you think they are losing market share?
So I think
Christian,
you need to understand the context.
Oh, go ahead. Sorry, I thought you were on mute. You're good.
Sorry. So again, thanks for having me on. I think you have to understand the context of what's happening here. There is really it might be a structural battle for next generation money, and you're seeing a plethora of money apps coming into the market to try and battle for that share. What you've seen over the last, I would say, 18 months through the pandemic is really massive acceleration of that trend. Huge amount of user growth that has come through to pretty much everyone, Coinbase, Robinhood, and some of the other sort of payment type apps. I think going forward from here, what's really critical is monetization. And from that perspective, who's most able to monetize their clients is probably who wins the battle going forward. The issue with Coinbase essentially is just pricing. I mean, it's just an expensive place to trade crypto, and you can do that in lots of places, right? Robinhood is essentially zero commission, although they make some money out of crypto. But Coinbase is almost 140 basis points, 1.4%. It's a really expensive place, and customers have choice. They can go to lots of places, and we think that's a key reason why they're basically losing market share.
Christian, what caught my attention here, and it should catch the attention of the Coinbase bulls out there, because there are many. You talk about this lack of them not innovating in a lot of different areas. Talk to us about that.
I think that's even more worrying to me, and I think it's a critical point, and thanks for raising it. So remember the context of Coinbase. Essentially, they were the on-ramp for most people into crypto. With the Bitcoin product very early on, they recognized the need for a really easy interface to on-ramp into crypto. They've done a fabulous job there. Since then, quite frankly, on a lot of the innovations that have come through, they've basically lagged. So, in 2017, when you had an explosion of alternative coins from Ethereum to all sorts of other coins, they were really, really slow to come out the gates there. Debatable why that was, maybe it's, regulatory uncertainty or just technology issues. Debatable why that was. But you saw the likes of Binance in Asia, so some Asian competitors come through because Coinbase didn't have the product. Most recently, NFTs. This has been like the second awakening, if you like, of crypto. Really brought crypto into a lot of people that a lot of ordinary folks that they get art, maybe didn't get the financial parts of crypto. Big movement. Coinbase has lagged also here in terms of it having an NFT marketplace. Now, they just announced, I think yesterday, that they will be launching one, but you've had folks like OpenSea who've been around for quite a while. And I think the point that it's critical is, it's not really about the particular product, but I think it's about a company mindset. Crypto is incredibly innovative. In the next 5 years, the industry will look completely different to what it looks today. And if you are not on the bleeding edge of innovation, we think you might struggle as a company to really remain relevant. So I think it's a thanks for raising the point, but I think it's a really important part of our underperform thesis.
Christian, just to put a fine point at this, what made me smile, perhaps, although it's a grim one, is that you compare Coinbase to Netscape. So you're not just saying that it's going to sort of fall behind here. You're saying like this thing's going to fall way behind. How long do you think that's going to take for this process to unfold, where it just becomes really an also-ran in this market?
Yeah, look, we don't know for sure. We're certainly calling for the demise of Coinbase in that sort of way. Look, it's a highly profitable company in a massive and growing addressable market. So in some ways, like they could just benefit from basically, the market just getting bigger. The point we make about Netscape is, competition matters. I think if you go through our notes, we really draw a lot of parallels between the early internet era to the early crypto era, right? There's so many parallels, transformative technology, lots of new companies coming through, lots of derivative companies coming through on the technology. So there's lots of parallels. And we just make the point that, Netscape essentially is how a lot of people first went onto the internet. They figured out that you needed a very simple GUI to log onto the internet and become active there. Coinbase figured out the same thing, but it wasn't a guarantee to success. And I think that's the point, particularly around innovation, that worries us about Coinbase here. So that's kind of the analogy we're drawing. But we're not really saying that they're going out of business anytime soon. This is again a very profitable company. The issue here is market share and marginal growth.
Christian, I have 25 seconds now left in this segment here. What is one reason why you're so bullish on Robinhood?
It's the opposite. It's really monetization. I think there's lots of criticisms about Robinhood that are absolutely fair, but I think the one thing you can say about them is they are the edge, right? They whenever there's an opportunity, they strike. Crypto, they were behind on crypto. They realized it was going to be a big product for the customers. They went all in, and it's made them have pretty meaningful market share over a very short period of time. They're building their own wallet, etc. But I think the simple way to think about it is, today Robinhood's ARPU, so revenue per account, is about $100. That number is more like $1,000 at Coinbase. Our basic thesis is that gap closes. So I really would want to be with the guy with 100 and moving up, rather than with the guy with 1,000 and moving down.
That would make sense if indeed that happens. Christian Bolu of Autonomous, thank you so much. Appreciate it. Hope to catch up with you again soon after that dramatic call. Speaking of drama, we are awaiting the launch of the Blue Origin New Shepard rocket, T-minus 2 minutes right now. Remember, William Shatner, late of Star Trek fame, of course, is aboard that rocket, and at 90 years old will be the oldest person ever to travel to space. With him is Audrey Powers, who's a Blue Origin vice president, Chris Boshuzin, who's co-founder of Planet Labs, and Glenn DeVries, chief executive and co-founder of Metadata Solutions. So there are 4 folks on that rocket. Remember, it is a suborbital rocket. The round trip, I believe, lasts about 11 minutes, and it goes up about 65 miles, allows those folks to experience weightlessness, and then comes back down, Brian Sozzi. And we are less than 90 seconds away from launch right now.
Julia, I should have broke out my pointy Spock ears here for the moment. I totally dropped the ball on that one, but wow. I mean, I guess this all means we're getting just a little bit older here. I remember watching repeats of William Shatner in Star Trek as a kid, but really, I mean, it can't get any cooler than this.
Yes, I have to admit to being a big fan of classic Star Trek episodes as well. The pictures we're looking at, by the way, are southeast of El Paso. That's where the launch site is. And then we are going to see the New Shepard capsule separate from the rocket at an altitude of 250,000 feet. They will then go to the edge of space and then descend under parachute and land again in the Texas desert. And, you know, we've seen a few of these now as we get to T-minus 24 seconds, and it's not becoming more commonplace. I was going to say it's becoming more common. It's
still a little weird.
It's happening more, but the cool factor, I think, safe to say for most of us, is not going away. We are T-minus 7 seconds now to launch. Let's just sit back and watch this rocket take off.
Manage and start. 2, 1.
And there we go. We have launch.
Wow.
Yeah, definitely doesn't lose the cool factor, does it, Brian Sazi?
Looks like a movie.
So again, William Shatner there, AKA Captain James Tiberius Kirk from the show. That's what the T is for. I don't know if you were aware of that, Brian Sazi. In that rocket there, Blue Origin, that's the feed they're providing. People can watch the whole entire launch if they want on the Blue Origin website. But definitely cool stuff here. And you know, obviously this comes back to the commercialization of spaceflight. We don't know exactly how much it costs for regular individuals to get on board these rockets and head to space, but that is the path here. In addition to potentially also doing refueling and other kinds of trips to the International Space Station. Obviously, a big part of the business of space is also satellite launches. And so all of that part of what is effectively a new and burgeoning industry, or not new, satellites have been going up, but commercial spaceflight is certainly a new part of that industry. All right, we are going to take a quick break as we watch that rocket head ever higher. We are going to be right back. Sad news reaching us last night that the CEO of Hasbro, Brian Goldner, had died at the age of 58, just 2 days after going on medical leave. Longtime CEO of Hasbro. And Brian Sozzi, in addition, of course, to being a business leader, you knew Brian. He was one of the early folks who gave you an interview. Talk to us about the reaction to his passing.
Yeah, Julie, I think we tend to get so wrapped up in talking to all these executives, and sometimes we fail to realize that, they are just humans like us. They have family members, they deal with a lot of the same things that we deal with. And, I really spent the whole night last night looking back at really all our my old interviews with him. Brian, going back to my prior place of employment, The Street, and he was one of the first people that gave me an interview, maybe in 2013 or 2014. I was still trying to get my sea legs under myself in this industry, and he said yes, and we met up at the toy fair, and he talked to me, just incredibly kind and generous with his time. It's been a pleasure. It was a pleasure getting to know him all these years, and very much a family man. He was also a member of the board of directors at Viacom CBS, and extremely well respected in the toy industry, and just very generous and kind with his time. I was thinking back to 2017. We were at the toy fair, and we finished wrapping up the segment, and he takes some time out with me, and we're out there shooting Nerf guns in one of the display setups. And then he asked me to go to the movies after, and I look back, and I regret not going to the movies with him because I had to go back to the office. And I look back in hindsight, and what the hell was I thinking? I should have taken that time out, enjoyed the moment, and went to go see a movie trailer with Brian Goldner. And I think moving forward, at least for me, I will not make that mistake again, if another executive asked me to do some of these things. But Brian was a tremendous human, and you could see the outpouring of that with a lot of folks in the industry. I mean, Mattel put out a really nice statement. Mattel CEO Ynon Kreiz put out a very nice, thoughtful statement on LinkedIn. Mattel team put out a nice statement on social media, as did Viacom. But this was tough. Brian was best in class. He transformed Hasbro, and I know I will very much miss talking to him.
right now, looking to potentially a third straight down day here. The Dow down 168 points, the Nasdaq the only one in the green, up 42, and the S&P 500 down 9. And Zach, we want to go straight to these live images we're getting from Blue Origin's New Shepard. Of course, so much attention here on that launch, given who is on board, and we're seeing it landing right now here. William Shatner, of course, of Star Trek fame, the 90-year-old actor becoming the oldest person to travel to space. He's there joined by 3 other passengers, Blue Origin's Vice President of Mission and Flight Operations, Audrey Powers, as well as 2 paying customers, Glenn DeVries and Chris Boshin. I mean, it never gets old. This is only the second flight for Blue Origin, but pretty incredible to see, even the second time around.
Yeah, I guess so, Kiko. Maybe I have to take the other side of this one just to be the foil on our show today. After seeing Bezos go up there and now Shatner this time around, it's strange to think that only 2 of these is ordinary now and kind of boring to watch. But I mean, it went the same way. Success again, which is very good and obviously applause worthy, and everybody's happy with the way that this one's gone, but it's strange to think how mechanical these things have become. The idea of a rocket landing itself back on Earth after going all the way up in space becoming routine. But I guess that's how quickly some of these things are moving and how quickly we're getting to, I guess, the excitement around, instead of watching people go up and do this, the idea of average people getting to strap on their Levi's jeans and go up in space.
And of course, we're watching this in the context of the space race. It's not just Blue Origin, of course. You've got SpaceX, which is really miles ahead of the pack here, as well as Richard Branson's Virgin Galactic. And, you mentioned that this feels like old hat here, but it is pretty incredible. Worth acknowledging that this is really only the second flight for Blue Origin. It was a short trip here, just about 11 minutes or so. But this is kind of the direction that we're going to continue to see space tourism moving in. And of course, there are the long-term goals that we're watching. In the case of Blue Origin, we've heard Jeff Bezos talk a lot about sort of transporting a lot of the emissions or the heaviest emitters to space. To try and clean things up here on Earth. He's got some grand ambitions over there, and SpaceX, obviously, with their ambitions, as well as Virgin Galactic. But worth at least noting here with Captain Kirk finally reaching the final frontier. How many times are we going to hear people say that today?
I've arguably already heard it too much. It's only 11 o'clock.
Yeah. But again, live images there out of West Texas as we see Blue Origin's New Shepard, just its second flight, making a safe landing there. Let's see if we can, we're going to continue to follow the images there live, but want to move on to the markets here as we got some inflation data out this morning. Consumer prices for all items rising 0.4%, more than expected in September. Yahoo Finance's Brian Chung following that story for us today. Brian, there's some good news here. Car prices and airfares down, but gas prices, if you look at the huge spike we've seen over the year, certainly raising concerns about the inflationary pressures building up on that front.
Yeah, Kiko. Well, inflation data from the Bureau of Labor Statistics this morning showing that prices are rising and inflation is hot. When you take a look at the headline number, again, 0.4% was the increase between August and September. That beat estimates of 0.3%. And when you take a look at the headline basis on a year-over-year comparison, you see prices rising by 5.4% year over year. Again, that also beat the street's estimates of 5.3%. So these inflationary readings coming in much hotter than the street had expected. Now, when you do strip out those more volatile components, obviously gasoline prices, oil prices have been catching a lot of attention over the past few weeks. You do get month over month changes of 0.2%. Year over year, 4% was the CPI print for September. But what's really interesting is that this is kind of testing the transitory thesis from the Federal Reserve. When you take a look at a category by category breakdown of the data, you can see airline fares down by 6% Car and truck rentals down by 3%. Used cars and trucks, again, this is one of the big hooks for a lot of these people that are deemed transitory, saying, well, used car and truck prices are constrained by microchips and the shortage in those chips. It's down by 0.7% in that month, but you still see that hot print. So interesting to see on that front. Shelter, which could be a more persistent leading indicator of price increases to come, that came in at 0.4% in the month of September. So again, consumer price index showing a bit of a test for the Federal Reserve, which has insisted that inflationary pressures could be transitory, although a lot of Fed officials admitting these transitory factors could last into the beginning part of next year, guys.
I don't know if it's a stretch to say, Brian, that you're not going to be excited about space travel until those tickets get added to the CPI price basket here. But
that'd be awesome. That would be awesome. I think we're still a few years off from that one. But elsewhere, of course, the big banks are getting us kicked off with earnings, and JPMorgan is one that we got to watch and wet our whistle on, and a beat on both the top and bottom lines here when we think about the way that things are starting to return to normal. Of course, we also saw billions of dollars come off in terms of reserve releases there, too. But what caught your eye in terms of maybe the earliest inkling of how earnings season is going to go this time around? Yeah, well, first of all, we just got a welcome earnings season for the third quarter of 2021. JPMorgan Chase kicking things off with revenue reported $30.4 billion, beating the street's estimates of about $30 billion. On the bottom line, earnings per share of $3.74, beating the street's estimates of $2.97. The big story for JPMorgan Chase was really reserving these, or rather releasing these credit reserves that they had built up during the depths of the pandemic. This is a big story for the other banks as well. They were able to release about $2.1 billion in the quarter, which helped them meet those numbers that they had reported in the third quarter. And the big story for JPMorgan Chase remains kind of leaning on those non-interest sources of income. Non-interest revenue was up by 3%. That's a lot because of high banking fees and management fees. Consider M&A and IPO activity was really hot during the quarter ended September 30th. That's a big reason why they had commercial banking revenues at a record $1.3 billion. But when you take a look at the overall picture for consumer credit and business banking, that's not as good. When you take a look at average loans up 5% across the firm, but when you take a look at community and consumer banking, the average loans were actually down by 2%. So it seems like economic activity, at least on a credit basis, not so good for the banks, which is a big part of their bread and butter revenue stream. So we'll see if that changes in the quarters to come. We did hear Jeremy Barnum, the CFO of JPMorgan Chase, say on the earnings call that he hopes that could really change in the future, and that he's optimistic that there could be some positive headwinds for loan growth in their credit card business specifically. But interesting also note here to kind of transition back to the story of inflation. Inflation came up a number of times on the earnings call with Jamie Dimon that just wrapped up earlier in the morning. Jamie Dimon saying that on the idea of inflation coming down at some point, really he says he expects the next 2 quarters at least to remain high, no inflationary prints year over year basis, at least coming in at less than 4% is what he projects. And he said that he does expect the Federal Reserve to have to respond with higher interest rates, although he doesn't see that happening anytime before late 2022. So the nation's largest central bank opining in on the inflationary numbers as well, guys.
Brian Chung with the breakdown there. Thanks so much for that. Let's turn our attention to Delta Airlines. Shares there just getting punished in the session. It is down nearly 4% right now, despite the airline reporting a higher than expected revenue for Q3. Our very own Adam Shapiro speaking to Delta Airlines CEO Ed Bastian. He's here with that conversation. Adam, it feels like the airlines just can't catch a break. Certainly we've seen the travel demand pick back up, but we did hear that warning from Delta saying that higher fuel prices are going to now start to weigh on the bottom line.
Yeah, in fact, they're not even able to say if they will be profitable in the fourth quarter, Akiko, and they're considering raising ticket prices. You talk about the revenue number. If you take out revenue from refinery operations, remember they do have that refinery part of the business, then they actually were a little bit lower than the street had expected, at least the adjusted revenue picture, just looking at the airline business. But here's what Ed Bastian told us about how the COVID-19 variant, which put a damper on ticket sales in August and September, which that's now stabilized. But here's what he told us about the impact from that.
It was a strong goal of ours to be profitable through the summer. I was optimistic. It's probably a better word, not necessarily confident, but optimistic that we could do it, and the team did it. The variant hurt us a bit on revenue, not a lot, but a bit. as it hit the industry broadly, as a fair bit of business travel, other travel patterns stalled, didn't continue to grow. But the other thing that hit us equally was the rise in fuel prices, which escalated pretty heavily over the course of the quarter that are continuing into the fourth quarter. But the fact that we're profitable while still missing 1/3 of our revenue base, I think is a great statement about the resilience of the business that we've created and our opportunity to continue to improve it into the new year as demand recovers.
If I may, I want to talk to you about international as well as business, especially the strong numbers with Latin America. But very quickly, last question about August and September. Had we not had the surge in cases of the variant, I got to imagine these numbers would have been better, or was it not quite as big a negative impact?
No, it would have been better. We were anticipating a pre-tax margin in the mid-single digits. We delivered a pre-tax margin of 3%, so we were off, a handful of 2 to 4 points from where we could have been. So the variant definitely hurt us some.
So when you think about Delta, a couple things in the background that you should be aware of. They have hired, are you ready for this? 8,000 people since the beginning of the year. So the staffing problems at other airlines, Bastian says, not a major issue at Delta. It's just one of the things that they're confronting. But the thing that we all need to pay attention to is international travel ticket sales. You heard him say after the U.S. announced it was going to change the procedures and anybody across the globe can come to the United States if they can prove they're vaccinated. Ticket sales went up by 10x, according to Bastian after that. So they're big on international. They're also big on holiday travel. They're waiting to see how many of us are going to fly for Thanksgiving and Christmas. But already they're seeing leisure demand recovering and full recovery in revenue 2023. Not next year, but 2023.
Yeah, that's certainly the positive. I mean, airlines taking any welcome news after the year they had. Adam Shapiro, thanks so much for bringing us that interview. Let's bring in Helene Becker, Cowen Senior Research Analyst. And Helene, you were just listening to Adam's conversation with Ed Bastian. Fuel prices certainly going to be a significant headwind, not just for Delta, but all the airlines moving forward. How are you looking at that factor in the context of travel demand largely starting to tick up higher?
Yeah, thanks for having me on the show this morning. Fuel costs are going to be a major negative going into the fourth quarter, and then depending on what happens into the first quarter as well. So it takes about 4 to 6 months for airlines to start to recoup fuel cost increases in their revenue. They don't have fuel surcharges the way FedEx or UPS do, or truckers that would allow immediate recovery. So that is definitely a major issue for the industry, and it will forestall a return to profitability. We have Delta losing money in the fourth quarter again. And in large part, it's a combination of higher staffing costs. You heard Adam say that they did say on the call this morning also they were hiring 8,000 or had hired 8,000 people. They had 17,000 people retire at this time last year, by this time last year, owing to the pandemic. So when you think about that, that should be a positive on the labor cost side, but starting salaries are going up in order to attract, and then in order to retain, they're having to give people salary increases as well. So you have both of those things as well as fuel, and then maintenance costs. Nobody's really talked about the fact that Delta's bringing back about 150 aircraft into the network over the next 6 months to be ready for the summer, because what they said is, yes, the US borders are reopening at some point in November, but Europe-US traffic is not a big winter thing. It's a summer thing. And so to get ready for next summer, they're bringing these roughly 150 aircraft back into the network, and that's going to cost money as well. So you see a lot of cost pressure, and you don't really have the revenue offsets yet. And you're not going to get those revenue offsets because even though demand is very strong, demand is really strong because fares are relatively low. And we think that those fares will be low except for the week around Thanksgiving and from about December 15th to about January 4th. And then fares will come down again.
Yeah, ain't that always how it is? But Helene, good to chat with you again on the show today. I mean, when we're talking about the holiday season, earlier in the pandemic last year, we're talking about how important that was, right, to keep this going, and how important it was for all the airlines looking forward to an opportunity to raise prices. This time around, as you're kind of laying through the costs that are going to be hitting all the airlines, I mean, which ones are still your favorites to kind of lean in on here? I know we're going to get the updates more closely as earnings season rolls on, but I mean, which ones are you looking at to maybe benefit around the holidays, or maybe have a little bit more pricing pressure, shall we say?
Yeah, no, well, I think from a revenue perspective around the holidays, I think the industry benefits in general, because I think people might have been willing to give up one holiday which is last year, but they're not willing to give up 2 Christmases or 2 Thanksgivings with family. So I think you're going to see that demand, and I think it's going to be beneficial to revenue. But really, for the fourth quarter, we're talking about 5 good weeks, 4 good weeks, and the rest of it, because you don't have that business traffic back, and you don't have really international except for maybe 6 weeks. We're really not going to get that benefit on the revenue side. No, so that would argue right into year end. Investors should be focused on domestic leisure airlines still. So that would argue for Allegiant, Spirit, Frontier as our buy rated stocks. And then as you think about going into 2022 and the market kind of thinks ahead 6 months at a time, then you really want to start thinking about pivoting to United, American, and Delta, because you are going to get that strong, what we've called a jailbreak, the whole strong pent-up demand. People are tired and they want to go places. And as things people are tired of being cooped up, locked up, whatever. and as you think about that recovery, we think we're going to have a really good summer 2022. As people return to office, they'll have to come back from wherever they've been living. And if they don't want to move back to the, New York area or Chicago or wherever they're living, they want to stay where they are, they're going to still have to commute back a few days a month. So you'll see that hybrid kind of traffic. That's kind of a hybrid business traffic. We've said business traffic comes back 80 to 90% of the way to pre-pandemic levels. I think there's a group of people who probably won't travel. I think there's conferences, when you think about, instead of sending 4 or 5 people or 7 people, they'll send 2 to 4 people. I think young people who don't have a network yet will continue to travel, because that's how you build your network. And in industry, you go to conferences, but I think people will be more judicious about what conferences they attend. And I think all in the back of their minds is, I think at this point, COVID is endemic rather than pandemic. And I think we just have to say, this is going to be with us. We have to live with it, and we have to get back to our lives and move on from some of these rules and regulations that may have made sense when things were really bleak, but may not make so much sense right now.
Helene, I know that Southwest is one of those airlines you've been watching closely. I know you've liked that as a stock specifically, but I wonder what you make of what has played out recently with the cancellations across the board. Initially seemed to be it was about the pilots union. Now it's not necessarily. But is that what we saw? Is that specific to Southwest, or you think this just shows just how tight things are within the airlines industry, whether that's on the labor side or just the operational side?
Yeah, that's a great question. So I think you're right. You have just hit the nail on the head. It's an operational issue. The airlines have to think about how much they can exactly support, what the network can support. Southwest says, the pilots say that their sick rates were normal and weren't excessive, and it was not about the vaccine, as has been reported, that it was just pilots being out of place. Management says it was a combination of poor staffing at air traffic control towers and weather in Florida. So whatever the underlying reason was, the issue for Southwest and other airlines is they've cut back so much capacity because of the pandemic and because demand was slower to recover. And then you had recovery in the summer, then you had the Delta variant that caused a decline in traffic again. You don't have the excess, and you're flying relatively high load factor. So you don't have that excess capacity on the network. When things go wrong, you don't have capacity to backfill. And then when crews get out of place, that's really the big issue, that because Southwest doesn't run a hub and spoke, it runs a point-to-point network. It winds up having a lot of crews in places where they don't have a lot of flexibility. So you have to wait for the crews to retime. They need to have, the rule is 16, 13, 10, 16 hours of during the day, 13 hours of overnight, and then 10 hours of rest between those shifts. So if you're at a place and you've only rested for 8 hours, you have to wait 2 more hours before you can take the flight. I think Southwest ran 400 or 500 actually empty aircraft to position, what we would call positioning aircraft in on Sunday and Monday in an effort to get the network back up and running. And we've seen this with other airlines. When you run low numbers of flights, but supply is low, but demand is high, as it's been. I mean, I think that's if you could find a silver lining, it's that demand has been so strong that it displaced all these people that were trying to get to where they were going over the weekend. So, but to your point, they need to think about, the industry in general just needs to think about what's the level of slack they can afford to fly to recover from things like this.
Helene Becker, Cowen Senior Research Analyst. Always good to get your insight. Appreciate the time. We're off for a quick break here, but we want to bring you those live images out of West Texas from the Blue Origin crew, which includes actor William Shatner chatting with Jeff Bezos a short time ago. All smiles here as they complete the second mission for Blue Origin's New Shepard. We'll be right back. Welcome back to Yahoo Finance Live. Shares of JPMorgan getting hit today in the session, down about 2.5% right now, despite exceeding expectations on profit in its most recent quarter. Earnings came in at $3.74 a share on revenue of $30 billion. The bank getting a lift from better than expected loan losses. Let's bring in Gerard Cassidy, RBC Capital Markets, head of U.S. Bank Equity Strategy and Large Cap Bank. He's an analyst there. And Gerard, let's start with the price action today. The sector overall, financials down nearly 1% right now. JPMorgan getting hit despite those strong numbers that they posted in the quarter. What do you think's happening?
Thank you for having me on, Akiko. I would say that the primary driver right now in the bank stocks is what I would refer to as the macro trade. We saw at the beginning of this year, from January through April, a massive inflow into the banks because of the rise in the 10-year government bond yield to about 1.7% back in the spring. Then, as you recall, the 10-year fell to about 1.16% in July, early August, and the flows came out. Well, the flows came back in the second half of August and into September as the 10-year government bond yield recently reached 160 basis points. It's now backed off for 3 or 4 days in a row. And I would say this weakness today is more the macro trade of investors, hedge funds in particular, who have purchased the banks in anticipation of higher interest rates. And now that the 10-year is coming down, even though JP Morgan's numbers were good, as you pointed out, the macro trade is overriding the fundamentals of the company.
Yeah, and I guess we've seen that kind of back and forth when it comes to expectations on the 10-year, you know, what the curve's going to look like moving forward. The Fed, all of that's been playing out here in 2021, so maybe not new. But when you dig into these numbers and look ahead to some of the earnings we're going to get from other banks, it seems like it's always been the case that some of these things that generally aren't that strong have been making up for weaknesses elsewhere at these banks. I mean, when you look at the results from JPMorgan and try and extrapolate out to the other banks you cover, I mean, how long can that go on for before maybe some of these worries that investors might have begin to get a little bit louder?
It's going to be interesting because one of the outstanding areas of the quarter's results for JPMorgan Chase was their capital markets business. Investment banking results were very strong, led by the advisory business. Those are the M&A fees. I think they were up 3 times where they were a year ago. In addition to that, the ECM business, that's equity capital markets, that was favorably impacted by the IPOs in the quarter, particularly in the month of September. So other players in that space, of course, Goldman Sachs, Morgan Stanley, should post really good numbers. So days like today, when stocks are trading down, buying them in anticipation of them posting good numbers is a way to trade around these types of announcements. We also have Bank of America and Citi. They too will post strong capital market numbers. The other thing about JP Morgan was that the credit quality shows up once again as being very strong. So when you look at some of the consumer lenders, such as the card companies, Synchrony, Discover, as well as Capital One, they should also put up good numbers because the credit inside the credit card company at JP Morgan was very strong. They're starting to see growth in receivables. So that's a real positive for the outlook for the core fundamentals. But to your point, you know, the macro is still there, and there are traders that use that as the driver rather than the fundamentals.
Gerard, the bank's certainly not immune to the wage growth that we have seen across sectors. Certainly a lot of concern here, especially with the job openings that are out there, the wages having to be increased to incentivize hiring. How are you looking at that specific part of this with expenses going up as a result of the wage growth?
No, you put your finger on an issue that has not been an issue for the banks in a number of years, and maybe for other sectors as well, and that is wage inflation. The numbers that came out today on inflation were discouraging. When you look at the real wage growth, that takes into account in inflation. And when you look at those numbers, the real wage growth was negative once again. I believe that's the 7th consecutive month. So individuals, employees, even though they may get a pay raise, they certainly are still falling further behind in that purchasing power, which would then, I think, encourage them to step up and ask for increases further in wages. But in the banking space specifically, what's interesting is the banks are raising the wages for the entry-level employees fairly aggressively. Bank America has a program right now, 25 and 25. Their minimum wage or entry-level wage will be $25 an hour by the year 2025. Last week, they raised those wages up to $21 an hour. Bank of Montreal, in their U.S. operations, just raised their entry-level wages by 20%. So this is a real factor in the banks. We're going to see higher expenses when it comes to wages, not just at the entry level, because when you think about it, if a teller is going to see their salary pushed up 20%, then the branch manager is going to demand an increase. Then the regional vice president of that region will demand an increase. So it moves its way up the food chain. So I think this is an issue that will rear its head a little higher as we enter the end of the year and into 22. Hopefully they'll be able to offset that with higher revenue growth driven by loan growth in 2022.
Gerard Cassidy, RBC Capital Markets, head of U.S. Bank Equity Strategy and also large cap bank analyst. Good to talk to you today. Appreciate the time. We're off for another break here, but time for a quick market check brought to you by PIMCO. We are seeing the Dow off of the lows of the session, but it is still down 180 points. S&P 500 down 9, and the NASDAQ, the only one in the green, up 43. As we said, on a sector by sector basis, we are seeing financials as the biggest laggards right now. Oil also pulling back in the session here after the big run up that we have seen. We'll be right back. President Biden is unveiling a plan to ease port delays on the West Coast. The White House announcing the Port of Los Angeles will now move to a 24-hour operation with help from key retailers and logistics providers. Let's bring in Yahoo Finance's Jessica Smith, who's tracking the story for us. Jess, the Port of Long Beach also involved. They already have a 24-hour operation going. How quickly are they looking to ramp this up?
Well, the White House is calling this a 90-day sprint to get to the end of the year and solve as many of the supply chain problems as they can. The White House is bringing the stakeholders together today to talk about the bottlenecks, to talk about all the delays and the congestion that we're seeing, especially at the ports, and ways that all of these players can help solve the problem. So at the meeting today, the Port of Los Angeles will be there, the Port of Long Beach, along with other companies like FedEx, UPS, Samsung, Home Depot, Target, along with other unions and other trade groups. The administration, as you mentioned, is announcing today that the Port of LA will start operating 24/7, as the Port of Long Beach has already started doing. They started that earlier this year. The union there has also agreed to work those extra shifts, and the other companies are committing to work extra hours, to work more nighttime hours in order to get more cargo off the docks, which will allow more ships to come to shore faster and really just speed the whole process up. Companies like FedEx, UPS, Walmart, all those companies I mentioned that will be at the meeting today have agreed to increase their nighttime hours, work other peak hours, and the White House says those companies, those 6 companies, will be able to move an extra 3,500 containers per week at night through the end of the year. The White House says companies are able to move faster at night than they typically are during the day. And a senior administration official said that the White House brokered this deal, this agreement between these companies. It started with that supply chain task force that the president announced at the earlier this year, and then as they worked with these stakeholders, they came up with this plan. The task force says it will continue working on this issue. They're going to address other stakeholders. They want to move the entire supply chain to a 24/7 operation. So they said next they'd like to see trucking and freight also expand their hours to try and solve some of these problems. They acknowledge that this is not something that can be solved overnight, but they hope increasing these hours will help in the short term. They say in the long term, the answer is investing in infrastructure to accommodate more goods that are coming into the ports. Zach and Akiko.
Yeah, Jess, it's going to be interesting to see how they can ramp up workers, too, especially at a time when we're seeing such a labor shortage. But we will continue to watch that story. A lot of people watching it to see if they're going to get all of their goods in time for the holiday season. We've got a quick break here. We'll be right back. In our worldview today, U.S. Embassy staff in Colombia have come down with a neurological condition known as Havana syndrome. The Wall Street Journal reports 5 Americans experienced symptoms consistent with the mysterious condition, including dizziness, memory loss, and ringing in the head. The Journal reports one family has been flown out of the country to seek additional treatment. The development comes as Secretary of State Antony Blinken prepares to visit Colombia this month. The condition was first detected among U.S. intelligence officials in Cuba 5 years ago, but since then, the attacks have been reported in half a dozen countries. Just a few months ago, Vice President Kamala Harris delayed her visit to Vietnam after a staffer at the U.S. mission experienced Havana syndrome. The U.S. is reopening its northern and southern borders to non-essential travel next month following a 19-month freeze. The borders with Canada and Mexico have largely been restricted during the pandemic to control COVID infections. New rules in place will allow fully vaccinated travelers to visit starting next month. That'll coincide with the lifting of restrictions for international air travel coming into the U.S. And Squid Game has officially become the biggest series of all time for Netflix. The South Korean thriller reached 111 million homes since debuting in September, according to Netflix. That surpasses the previous record holder, Bridgerton, which reached 82 million households in the first 28 days. The 9-episode series is #1 on Netflix in 94 countries now. It's also the first Korean series to get top billing in the U.S. on the platform. If you haven't watched it yet, no spoilers here, but the show does involve around hundreds of people who are in debt. They compete against each other in children's games to win prize money. Much more than that, but that's the basic version of the story. All right, coming up, hospitals facing labor shortages with the healthcare sector shedding roughly 500,000 jobs during the pandemic. After the break, we're taking a look at a new report out from Moody's that looks at the impact on the industry. We'll be right back. The healthcare sector has lost more than 500,000 jobs since the start of the pandemic. The most recent data from the Labor Department pointing to the biggest losses coming in nursing, residential care facilities, and hospitals. And Moody's is out with a new report taking a look at the impact this is likely to have on the makeup of the workforce in the sector. Let's bring in Lisa Goldstein, Moody's Associate Managing Director. We've also got Yahoo Finance's Anjali Kamlani joining in on the conversation. Lisa, it's great to talk to you today. I think a lot of people are surprised when they hear these headlines saying, well, look, this is at the height of the pandemic. The demand should be there for hospitals. Why are we seeing so many losses in jobs? What are hospitals now doing to try and make up for the shortage?
Great question, Akiko. Thanks for having me today. Yes, indeed. One would think with COVID, Delta surges happening, and individuals, patients returning to the hospital for care, there'd be no problem finding labor. But even since before COVID and now, we are in the midst of a very pronounced national labor shortage across the country, especially for nurses, but I'll talk more later. It extends to all type of workers. So as a result, many hospitals are turning to temporary labor or what's called traveler nurses, very expensive. And we do expect this will curb margins for the remainder of 2021 for most not-for-profit hospitals and continuing into 2022. So it is a real problem financially that will lead to lower margins over the near term.
Lisa, I know that there's been a lot of coverage for this and a lot of discussion about why the reasons behind it, some of it coming from complaints about workplace safety, as well as the resources that are available, generally speaking, to them. But I want to just move a little bit out of that to what the spillover effect is for businesses. How is this going to affect, say, insurance premiums, et cetera, for the coming year?
Well, it will undoubtedly lead to higher costs for everyone seeking health care. So we may see a rise in premiums, a rise in our hospital healthcare bills. But what's very different from this nursing shortage, say pre-COVID, and we've seen nursing shortages over the decades. This is not new, but there was a nursing shortage actually heading into the pandemic. What's new this go round is two factors. One is part of the nursing shortage is due to burnout. So we've had resignations of nurses. They're at the end of the career. It's time to resign. Now we're seeing a different driver, and that driver is burnout, given the intensity of the shutdown last March through April, May, et cetera. So it's become a very different, intense workplace for nurses. So burnout has now entered into the lexicon. The other issue that makes it very different from the past is that not only is it nurses leaving the field, but it's other healthcare workers as well, non-clinical healthcare workers. So think housekeeping, dietary, environmental services, security. There's even a run on cyber individuals, cyber expertise, cyber skilled individuals. So the labor shortage is much broader and much deeper now than in the past. And we've seen, according to our data, salaries and bennies represents at least half of any not-for-profit hospital's expense base. So we expect that's going to continue to grow, and it may grow faster than other expenses like pharma or supplies or debt-related expenses. So it's a very different go-round right now than other nursing shortages or labor shortages we've seen.
Yeah, and Lisa, I mean, when you add all that up, obviously, as you said, we were dealing with a nurse shortage, labor shortage there in hospitals for a while. But if you add on top of that burnout from COVID-19 and think about the pipeline for new labor coming in, I have a lot of nurses or friends who are nurses here who look at it and just say, I'm not sure if that's the career I would advise maybe my mentees or people I know, younger people, to go into. So how does that maybe build on it moving forward?
Right. Well, there is some recent data that nursing school enrollment, at least going into 2020, was increasing. So this is a call to arms, a call to action for new people just starting their career. But it will be a pressure point forward, and hospitals, not-for-profit hospitals, will have to throw a lot of resources to not only recruit and be competitive in their salaries, but as we talked about, they've also got financial strategies to retain the workforce, to keep nurses there, to keep employees there. And that's going to lead to wage inflation as competitive salaries, are all over in other sectors. So for example, a hospital may need to hire people for their dietary food services, but so is the fast food industry. So all of a sudden you have different sectors providing competition for the workforce. That's a very different feel and point that we're in than ever before.
Lisa, I'm so glad you brought that up, because I wanted to draw comparisons to what we're seeing sort of in the restaurant industry as well. It seems like there is a lot of concern about wages as well as the resources and just how businesses are functioning through the pandemic. I wonder, with this conversation about the pipeline building up and sort of the exacerbation of what was happening pre-pandemic, we've also seen a lot of push into alternate healthcare services such as telehealth. And it seems like there's a lot more interest to build up the forces there. Are we going to see some of that loss, through the buildings and in-person healthcare services trickle into sort of the telehealth or digital health form?
It will to a lesser extent. We saw during the pandemic a rush to digital healthcare. It exploded, exponentially. But that's starting, our data show it's starting to tamp down. But you bring up an excellent point. If nurses are leaving the hospital setting, it's too intense, it's too risky, but they want to stay in healthcare, they could easily perhaps go to the outpatient setting, ambulatory, clinic. Many are leaving, we hear, to become a traveler nurse. So leaving their home base to go elsewhere in the country, it can be very lucrative. So there's a great shifting of the clinical care to all different types of healthcare settings. And that's exactly what we're seeing right now. You brought up the restaurant industry. Here's an important point about healthcare. Costs may rise, and undoubtedly they will, but in not-for-profit healthcare, where over half of their revenue base is Medicare or Medicaid, and the rates are set, there's no negotiating, there's very limited flexibility, unlike, say, the restaurant business. Costs go up, you raise the price of everything on the menu. Hospitals, it's not so easy to do. There's very limited pricing flexibility. So not-for-profits will have to absorb the higher costs from the labor shortage and getting us back to where we started, resulting in curbed or limited margins over the near term. There's no doubt about it.
Lisa, bottom line, what does this mean for patients at hospitals? Are we seeing some of the procedures, the elective procedures, being delayed as a result of the shortage?
We're seeing it in a few spots around the country. Some of the overnight electives are being suspended. This is not mandated by any government. Hospitals are choosing to do this when they look at their staffing, they look at their resources. It may be a suspension for a few days or a week or so. But hospitals are quite adept at managing through this. They're quite used to various financial shocks happening over the years. This is a health crisis like no other that we've ever seen before, but they're quite adept at responding and moving through it.
Lisa Goldstein, Moody's Associate Managing Director. Great insight. Good to have you on the show today. And our thanks to Anjali Kamlani as well for joining in on the conversation. We'll be right back. Welcome back to Yahoo Finance Live. The Nasdaq, the only one in the green right now as we head to the afternoon session. It is up 58 points. The S&P 500 and the Dow in the red. And we are watching oil here taking a bit of a breather in the session today. Inflation fears adding to the pullback that we saw yesterday too, with prices for coal and natural gas rising globally. Brent crude at $83 a barrel and WTI at $80 a barrel. We'll be right back.
Welcome in to Yahoo Finance Live as we hit the noon Eastern Time trading hour here. Happy Wednesday, everybody. I'm Zach Guzman alongside Akiko Fujita as we're seeing the S&P 500 flirt with a potential fourth straight day of losses right now, pretty much exactly at that break-even point as we're seeing the Dow off by about 1/3 of 1%, the Nasdaq, the lone index in the green for now, as investors digest the latest inflation numbers coming in above expectations once again. Plus, IPO is looking to keep the momentum going in Q4 with the Peter Thiel-backed Avid exchange pricing above its initial range in its debut. We're going to chat with the CEO of that payment software giant in just a bit. And speaking of momentum, non-fungible tokens, NFTs, all the rage and then some, with sales exploding eightfold in the last quarter, why wearable fashion collectibles could be the next big thing in the space. With high fashion names like Dolce & Gabbana getting involved now, the team building out the DressX fashion platform will bring us a reality-bending chat about fashion in the metaverse a bit later on in the show. But first, I want to talk more markets here as we got those CPI numbers coming in above expectations, this time showing a 5.4% climb in prices for the month of September. Comparing against the prior year, that was above what analysts were expecting in a Bloomberg poll showing 5.3% expectations through August. Month over month, so about a 0.4% rise. And for more on what we're seeing play out after that report in the markets, I want to bring on Yahoo Finance's Jared Blickery to walk us through the big movers we're seeing today. Jared?
Yeah, the stock futures took a little bit of a dip after those numbers dropped, but CPI, typically not a really big market moving report, but worth underscoring some of the items in there because the word transitory might be wiped out of the central bankers' vocabulary, at least short term. I like Brian Chung's story of how at least one of the Fed presidents of one of the Fed banks has created the equivalent of a swear jar. Every time somebody says transient, they got to put $1 in. And I'll tell you what, used cars, those are down 0.7%. Also seeing drops in airfare and apparel. So those were the reopening items, right? And if inflation is still persistently high, even higher than expected on the headline number, then guess what? We can't say it's transitory. Anyway, let's take a look at the Wi-Fi Interactive to see what's moving inside the market. And inside the NASDAQ 100, we're seeing Apple under a little bit of pressure. Bloomberg reporting that they might not be able to sell or produce as many iPhones by a factor of 10 million. But most of the other mega caps, in fact, all of them in the green right now. Microsoft, Alphabet, each up about 0.5%, Amazon up 0.75%. This is on the back of a drop in the 10-year yields, and so we're seeing the growth trade outperforming today. CrowdStrike in the upper left, that is the greatest performer in the NASDAQ, up over 5%, Moderna 4%, Zoom, remember that one, up 4%, hasn't been the greatest year for Zoom, down 20%, well off, even more off those highs, but nevertheless, that's what's jumping today. What's not? The airlines, Delta, warning about higher fuel costs. That's going to pinch their margins in the coming quarters. That stock is down 5%. And we can see the other airlines following suit here. United, American, those are each down 3%. Before I go here, I just want to show the banking sector after JPMorgan earnings, down 2%. We'll have a bunch more earnings tomorrow morning, guys.
All right, Jared Blickery walking us through those moves there. Appreciate that. In the meantime, I want to shift over to take a gander at Bitcoin prices here as that crypto is still maintaining its moves north of $55,000 right there. As you can see, north of $56,000. Still 91% gain on the year, down a bit today. As of course, investors have been having to digest quite a bit on the regulatory front. When it comes to that, we have seen about a month of time since the SEC took issue with plans at major crypto exchange Coinbase. They sought to set up a way for investors to earn 4% interest on their crypto assets. Of course, since that decision, other companies who have already been offering yield on crypto have continued doing so, even extended their services. One of those companies, BlockFi, which offers 8% interest on stablecoins, since added a Bitcoin rewards credit card in partnership with Visa, even filed for what could potentially be one of the first approved Bitcoin ETFs. And for more on all of those developments over there at BlockFi, happy to welcome on the show BlockFi's co-founder, Flory Marquez, joining us once again here on the show. And Flory, I mean, when we're talking about this one, it's interesting because, you know, the SEC seems to be stepping up pressure. State regulators seem to be stepping up pressure. You guys, in all that, even updated and increased the interest rate that you guys are paying to customers. So from that standpoint, I mean, does it seem like regulators here are getting a better sense of how the lending space is evolving when it comes to crypto?
It's great to see you again, Zach. And I think everything that you were just talking about, including some of the returns that we're seeing in traditional stocks, it's all tied together. So I think it's really important when we think about all of the attention on crypto that's happening at the moment to think about the stats. Over the last year, Bitcoin has given people a return of 380% year over year. And when you compare that to the S&P that we were just talking about, that's only given people a return of 24%. So obviously, having something give investors such an incredible return is going to garner attention from everybody, from investors, from consumers, and lastly, from regulators. So today, we have an incredible amount of regulatory engagement. And I can tell you that from 4 years ago, when I first started building BlockFi, it was actually pretty difficult to get attention and clarity from regulators to understand how some of these products should be built. And our mission is ultimately to bridge traditional finance and crypto. So we do see this moment in time of regulatory attention as an opportunity to get that clarity that builders like BlockFi need to be able to continue to build in the US and ensure that the US becomes and continues to be a central hub for innovation for crypto.
Yeah, and I guess, a piece of that could be seen through New Jersey's cease and desist, right? That came earlier this year, and they keep postponing it as they kind of learn more about that. I mean, is that kind of a piece of it? You're talking about maybe regulators having some interest here. Is it the case that they're really wrapping their heads around what this works? I mean, it seemed like there was a security issue, the definition of what a security is around when Coinbase wanted to lend. Of course, you guys and other ones continue doing so and allowing that. So, I mean, I guess it seems like there's a little bit of confusion there, or not so much when it comes to you guys running the company.
Yeah, so I can't speak to exactly the intention or the thought process behind regulators, but what I can say is that I think we're just in the beginning of the story. And I think we're definitely in a learning period where there is this asset class, crypto and Bitcoin and companies like BlockFi that have built around it. And we've had exponential growth over the past few years. And I think that the regulators are really looking to engage with us at this moment in time and work with companies like us to truly understand what is this asset class? How are consumers engaging with it? And I think that over the next few months, I'm hoping that we can get to a point where we can build thoughtful regulation in the US that gives us clarity for how to move going forward.
Flori, I wonder if you can
go for it,
share more data on the rewards card, the Visa card that you've launched. Obviously, you're well into this venture here, but where are people spending their money? Where are they using the card specifically? What are you finding?
Yeah, I think that in light of everything that's going on, this past summer, we did launch a credit card, and today we have over 50,000 cardholders in the US. And what's really exciting about this card is that we're seeing spending on things like groceries, utilities, home improvement, and even things like engagement rings. And with every single purchase, people are earning crypto as a reward instead of airline miles. And what's really incredible about this card is that we're kind of breaking the statistics when you compare it to other traditional credit cards. As of today, we're seeing 4.5 times the average spend on cards that you see in traditional credit cards like Amex and MasterCard and Visa. So all of this is part of this momentum that we're talking about. People are passionate about crypto, consumers are engaged, regulators are engaged, and an interesting asset class that I think engages consumers in a new way that we haven't seen before for years in the fintech space.
Yeah, and I guess there's the case to be made that, when we talk about Bitcoin rewards credit cards, and you guys have had this one in the works for a bit, that there might be a lack of excitement when it comes to maybe seeing that 3.5% interest rate effectively go up to 4.25 because, people are thinking Bitcoin might spike and they get much more than that. But I think it kind of speaks more to, where we're at in the evolution of Bitcoin and the lack of volatility, right? I mean, we talk about this being a thing that people should see maybe more as a store of value, and that kind of proves it. I mean, as you see it, as it's evolved, talk to me about what that means for customers looking at it as maybe a benefit over airline miles or cash back as a slow and steady appreciating asset.
Yeah, that's exactly the value prop that our customers see. So when you think about getting a reward in airline miles, that reward actually may be worth less next year than it was today. And when you're earning Bitcoin instead, you're earning an asset that can accrue value and be worth more, as our consumers that have been using this for the past 2 months have experienced. So what ends up happening is that we're giving people access to an asset that can actually be worth more over time. And the credit card is an amazing way, especially for people who have been hesitant to get into Bitcoin, to get in for the first time, because they're doing the same activity that they already know how to do, which is spend a credit card on a monthly basis in traditional dollars, but at the same time, get exposure to this new exciting asset class passively just by earning a reward.
Yeah, let's talk about a more active way to get exposure here that you guys filed for in terms of one of those companies chasing a Bitcoin ETF, one of the futures attached applications, of course, also ProShares, Valkyrie, VanEck, Galaxy, among the other names, seeking one. As you guys look to add that, I mean, what are maybe some of the things you're looking for? You got the rewards card now. You've got, of course, the asset earning accounts there, interest earning accounts, I should say, when it comes to crypto. and now this futures application. I mean, what does the future of BlockFi look like as maybe you start to build out all of these things and bring them together?
So ultimately, there's two separate goals, right? There's the company goal, and then there's our mission. And from a company perspective, all of the activities that we've done over the past few years, so launching the credit card, we also launched BlockFi Prime, which enables institutional clients to execute billions of dollars of trades at tight spreads and manage financing directly on a platform, and then filing for a Bitcoin ETF. All of these things are looking to give retail consumers and institutional investors easier access into this space. And ultimately, that ties into our mission, which is bridging the worlds of traditional finance and crypto, while at the same time looking to make strategic investments as a company that diversifies our sources of revenue.
Flory Marquez, BlockFi co-founder and SVP of Operations. Appreciate you stopping by today. Hope to have you back on the show again soon. Let's turn our attention to one stock that is seeing a big move here. Plug Power, up nearly 12% ahead of its investor event tomorrow. The hydrogen tech company is seeing gains for a 6th straight day now. A few catalysts we're looking at right now. Number one, some key partnerships announced, including the firm announcing a deal with Airbus to explore the use of green hydrogen in air travel. Morgan Stanley analyst Stephen Bird also upgrading the stock from hold to buy. He raised its price target from $35 to $40 a share, citing its balance sheet as one. The firm has $4 billion in cash on hand right now. We should point out Plug has gotten a big lift over the last month, up nearly 25%, but it is still down roughly 12% year to date.
Well, coming up, the IPO train continues to roll with some pretty important momentum behind it, and Q4 not going to be any different here. We're seeing shares of AvidXchange drop in their debut, a bit surprising considering they sold shares above the initial marketed range there. We're going to be chatting with the CEO and co-founder of AvidXchange, the Peter Thiel-backed software payments giant, on the other side of the break. Stay with us. We're back in 2 minutes' time. back to Yahoo Finance Live. Right now, we are continuing to track the biggest moves in the IPO space. Today, AvidXchange making its debut, seeing shares drop as of right now by about 5.5%. The company, though, priced shares above its marketed range, bringing in about $660 million in its IPO. Shares selling for $25 a pop, 22 million of them after marketing them in a range of 23 to 25. So still something to show off there. And want to bring on the CEO and co-founder of AvidXchange here to discuss a little bit more about what the company does. Mike Prager joins us right now. And Mike, I mean, when we look at this, it's interesting. You got MasterCard among one of your investors here, the bigger named investors. As you guys, of course, have been an operator in the software space that automates payments, invoicing for small businesses for quite some time. But talk to me about what investors listening to this might need to know about AvidXchange.
Yeah, so first of all, Zach, thanks for having me. Excited to be here. So AvidXchange, we're a software company, and we're really purpose-built to help middle market companies automate their accounts payable and their payment process. So simply speaking, we eliminate the paper invoice and the paper check for our middle market customers. Today in the North American market, we have over 7,000 buyer customers that use our software to manage their accounts payable and payment process, along with over 700,000 supplier customers that rely on the AvidPay network to submit invoices and receive their payments and the remittance data related to those payments.
Mike, it's a good reminder as you explain your business that there's still a lot of companies that are filing paperwork. Not everything is happening digitally. Obviously, that's where you come into play. How do you think the pandemic and the way in which the shift has happened in terms of how we work, how's that accelerated the digital transformation that you have positioned yourself to help spur along?
Yeah, Kiefer, that's a great question. And obviously, in March of last year, the world changed very quickly related to how CFOs and controllers thought about executing their key back office processes. And very quickly, they realized that if they don't have their core financial systems in a cloud-based software as a service environment, it's really difficult to execute a work from home model. And so that's certainly been a catalyst. Overall in the industry today, here we are in 2021, and across the broader entire market, being enterprise, middle market, and small business, still over 40% of all payment transactions are paper checks, and we expect in the middle market it's even over 60%. So that's the business problem that we're trying to solve, and really excited to help these middle market companies on their journey of automating for the first time.
Let's talk a little bit about what investors should expect when it comes to profitability here, because if we have seen a trend, I think some of the stocks that have traded lower on their debuts have shown growing net losses. You guys would be in that bucket as well. A net loss of $92 million for the first 6 months of the year versus $51 million a year prior. I mean, revenues have also grown over that time period. So maybe talk to me about how you kind of pair those and what it looks like moving forward.
Yeah, that's a really good question. It's really about strategy. Our strategy today is we have a tremendous, white space or open market, opportunity within our middle market segment. Of our last, 1,000 new customers that we added, over 95% of those customers were actually automating their business process for the first time. So they're moving from, paper to electronic for the first time. And so our focus has been, is really, aggressively to take advantage of that market opportunity, along with focused on, really healthy, gross margin and gross margin expansion. So we think that's kind of the right barometer in terms of, certainly in the short term, taking advantage of the market opportunity is, measuring growth along with, that gross margin expansion.
You guys are out there now as a publicly traded company. Day one, shares off just a bit here. But Mike Prager, AvidXchange co-founder and CEO, appreciate you coming on here to chat about what lies in store moving forward. Congrats again on the debut. Going to take another quick break here on the show, but when we return, digging into the largely growing, dare I say, exploding NFT space and a new way that NFTs are being used in fashion. We'll chat with one of the platforms, tech startup DressX out there, an investor, about what they're seeing and working with some high names in fashion to bring that to the public in the metaverse. Stay tuned. We're back in 2 minutes' time. Welcome back to Yahoo Finance Live. In today's Crypto Corner, non-fungible tokens, or NFTs, are continuing to explode in popularity. Sales of NFTs, in fact, notched a new record in the third quarter to hit more than $10 billion in total sales. That was up eightfold from the prior quarter, according to a tally from DApp Radar. Some of that might be pure speculation on random digital collectibles, but some of it is coming from some big-name brands working on wearable products being sold in the metaverse. The latest examples of just that are coming from the fashion world, with the likes of Dolce & Gabbana, their physical crown coupled with a digital version selling for more than $1.4 million at a recent auction. And for more on the potential upside of NFTs in the fashion space, happy to welcome back into the show Megan Casper, Magnetic Managing Director and member of the group who won that Dolce & Gabbana crown, alongside Natalia Mladenova, the co-founder of DressX, a digital startup helping major fashion names offer 3D wearable NFTs for customers through their app and elsewhere around the metaverse. And guys, appreciate you coming on here to chat with us today. And when we look at this one, Megan, I should kick this off with you and note that you are an investor in DressX, hence why we have you both on the show today. But talk to me about why you're so bullish on 3D fashion, wearable fashion, particularly in the NFT space, and the future prospects it offers in the metaverse.
Well, for one, Zach, the fashion industry alone is $2.7 trillion. And we foresee that at least doubling over the next 2 decades because of digital fashion. Digital fashion wearables give a new utility to fashion in general, and it takes fashion to a sustainability level where all of the fashion that you're wearing, kind of like the earrings I have on in the digital world, are not produced physically. So it becomes a very large ESG investment. And these NFTs, the majority of NFTs right now are all in the Ethereum ecosystem. So that's another proponent that's propelling the Ethereum market cap. But we're going to see more NFTs proliferate, I think, just in specifically fashion. So there's 12 large categories in NFTs, but fashion alone has the largest potential for disruption.
Yeah, I mean, this is the first time we're showing NFT. Thank you for sporting them on the interview today. This is the first time, certainly at Yahoo Finance, I think the first time in a few places. And Natalia, I mean, when we look at the opportunities here, you guys are working with names that people recognize in fashion to build these things and offer them out to the public. I mean, talk to me about the demand you're now seeing from those companies that may not be used to doing this and kind of their excitement in joining in the wave.
Sure. So our goal at DressX to open up the new domain for fashion brands and to open up the new category for fashion brands, which is digital fashion. And there is a space for luxury digital fashion and mass market digital fashion. Of course, sustainability aspect is very important for us from the day one, because a digital item emits on average 97% less of the carbon footprint than the physical one. So we believe that in many, many use cases, it is viable and worth it to switch into wearing digital fashion. And it's also democratization of fashion. But with NFTs, we open up the opportunity of having a luxury category for digital, because with NFTs, it is unique and it is possible to open up the secondary market and resell opportunity. Resale models are growing, and this is something that driving the traditional market. So we know about companies like StockX, RealReal, and all this model, it's growing. And now fashion industry recognizes that, but definitely in digital fashion, this is something that is going to be a big market as well. There is a data that 9% of clothing is purchased for the sake of content creation. And if we turn this 9% on consumption of digital fashion, fashion, that's already a big market. And gaming industry and the rise of the virtual worlds also open up this big opportunity. And recently, we finished the auction with Balmain, where the unique fire flame dress was sold for $10,000, and only the owner of this NFT, it was only digital, and only the owner of the NFT will be able to wear it in AR, in augmented reality, just the way that I'm wearing this hat right now. And this is a great new universe for NFTs and wearing and actually using digital assets that you're owning.
So what kind of price range are we talking about? I mean, I realize that the case for digital use, but at the end of the day, people also spend money to step outside their homes and use in real life. So I'm wondering who you're appealing to. How broad do you think the market is?
The market is pretty broad. Because the AR technology opens up the possibility to democratize fashion, we can actually address the audience who would wear something like a mass market and would be in a like middle and lower price category, also because it's just on the tips of your fingers. And at the same time, with the possibility of implementation of NFTs, we open up this higher price category where digital only items can be priced hundreds, thousands of dollars. And that's an example of what actually like Meghan is wearing the crown now. And this is something that is unique and it only exists in one copy. And that's like her NFT, and that's why she can wear it. And that can go in the prices similar to the price of the physical item and up. So there is a big opportunity.
Yeah, and I mean, I don't know if you knew I was a sucker for bucket hats, so to bring one on here, an NFT that has flowers growing out of it, I also enjoy what we're seeing here on the show today. But Meghan, I mean, when we talk about the long-term growth potential, right, obviously DressX has shown a lot of the potential here in being the first to move on this space and a leader in the e-commerce digital NFT space. When you look at kind of the mainstream consumer, right, we're talking about clothes I'm wearing right now. I think, I don't know, this might be from Banana Republic. But when we're talking about the opportunities for mainstream fashion to offer some of these things to more maybe applicable prices for mainstream purchasers of clothes, I mean, talk to me about the opportunity there, or if you're looking at this investment space as strictly maybe on the higher end.
Well, you have both. So you have platforms like DressX that can offer a wide range of items. I see DressX as sort of the Net-a-Porter 2.0 of the metaverse. And then you'll have a whole category of higher end luxury items, similar to what we bought. The crown from Dolce & Gabbana, like you said, was over $1 million, and a few of their other items, which were jackets. These are couture pieces. So the industry can span from median to lower dollar apparel all the way up to higher price items like the Doge crown.
And lastly, I mean, Antonio, when we think about kind of how it all works together, right? You know, it's fun to be able to wear wherever you are, right? And that's going to take, I suppose, AR technology coming along a little bit more if you wanted to see it around town. But for now, you guys are using this right now on our video call, so there are real, and we've all been working from home, so there are real use cases right now. But I mean, talk to me about working across those. I know I was just playing around with DressX. It seems like it's integrated with Snapchat as well. The technology in that. In terms of being an important piece that DressX and others are working on too. I mean, how far off is that technology from becoming something that I know young people might be using it now, but everybody might be using it?
So I would say that AR implementation and AR use case for fashion NFTs is something that has a biggest potential so far at the moment, just because we all have our own bodies and we don't need any kind of 3D avatars to appear on the screen. We all have some kind of device which will help us to show ourselves on the screen. And that's why it opens up the biggest market and the biggest opportunity. And that's why we are focusing now on developing the AR fashion NFTs and launching the marketplace where all the items, all the NFTs will be wearable in AR. Of course, the other use cases will follow, and they are already popping up when you can wear some of the items in the gaming environment and virtual world, but it is way more limited compared to AR use case at the moment. Of course, virtual and VR use will be more widespread moving forward. That's the biggest opportunity now for sure in augmented reality. That's why DressX is developing and pioneering in this direction.
Or we're gonna have to talk with my team here and figure out how I can get a flower growing bucket hat for the next time we have both you guys on. But appreciate you coming on to chat. The opportunity is there. It's exciting times. Natalia Mladenova, DressX co-founder, alongside Megan Casper, Magnetic managing director. Thanks again for chatting with us today, guys. Going to take another quick break here on the show. And when we return, discussing the hotel space with the incoming BWH Hotel Group CEO on the other side. Stay with us.
Well, the Best Western Hotel Group is tapping a longtime veteran of the company to step in as new CEO. Larry Kukulik is most recently served as Senior VP and General Counsel for the BWH Group. He spent 12 years with the company and steps into his new role starting December 1st. Let's bring in the man himself, Larry, joining us for a first on Yahoo Finance interview. Larry, it's good to talk to you today. You've got a pretty tough act to follow here. David Kong spending 17 years at the helm with Best Western. As you look to your new role, what do you see as the key priorities, especially with this sector coming out of recovery or on the road to recovery?
Thank you. And thank you for the invitation to speak. Best Western is a tremendously unique organization, and our mission is to drive revenue to our members. And that has to be our priority and our focus as we move forward, successfully coming out of the pandemic. And we have done that. We have had a tremendous year so far. Best Western in this past, I'll call it 3 or 4 months, have had a terrific summer. And although the season was strong, it's a rebound from the slower start of the year as we came out of the pandemic. But travelers want to travel. And we were the first company to put in place health, well-being, and safety protocols. And as a result of that, we found guests wanting to stay at Best Western hotels. And as a result of that, we had a terrific summer, and our hoteliers welcomed travelers back and did very, very well.
We have seen record quit rates across sectors. Best Western certainly not immune to that. And I know when I spoke with David Kong last, he had mentioned that it's not just that you're competing with other hotels now when there's a very tight labor market. You're also competing with tech companies, for example, for those who have been in the hotel industry for a very long time. They see higher wages over there, better benefits, different opportunities. How do you compete with something like that?
First, I've got to note that Best Western hotels are independently owned and operated and generally small business owners. And what's so important for them is they are foundational and bedrock members of their communities. And as a result, they can establish a working culture where people want to work as strong members of those communities. The hospitality industry is different than working in an Amazon warehouse or working for an online business. What's different is working in a hotel is all about caring for the guests that walk into your doors and treating them as if they're walking into your home and ensuring they're having a stay that meets their expectations, making sure that you're taking care of their health and well-being. But mostly it's about caring for those guests. And our hoteliers do a great job in that regard. And as a result, if they can build that caring culture, I'm very hopeful that the labor force will recognize it's consistent with who those employees are, and they want to be a part of that culture so that they can interact with guests on a daily basis and make sure that they know that they're welcome into our hotels. So it's about becoming an employer of choice in those communities. And we've done a lot to help our hoteliers in that regard. Published best practices. At our recent convention, we held multiple seminars and workshops with regard to employment matters, because it's not always about, and it is not about just attracting new talent. It's also about retaining the talent you have. And so we're very, very passionate about helping our hoteliers establish a culture where people want to work.
Yeah, and Larry, let's talk about, I mean, we were talking earlier on the show about a return to travel and return to kind of getting back to normal. I mean, that was something we talked about with your predecessor here on the show and what he's seeing. What are you seeing now when it comes to kind of different travelers getting back to staying with you guys?
Well, the pent-up demand really was with, I'll call them the family travelers that came back to our hotels over the summer season. We're now hopeful with regard to the last quarter of the year that business travel will pick back up as the vaccination programs, of course, are more and more successful. Additionally, the recent activity by our government opening our borders from Mexico and Canada, I think is going to have a significant impact on travel as we complete calendar year 2021. Especially with regard to those hotels that are on or near the border that can see a tremendous increase in stays as a result of those borders opening back up. And I applaud the government for taking that action, which will happen really, I think, near term November.
We're going to have to come back on to keep us posted on those numbers as we see travel resume. But Larry Kukulik, incoming BWH Hotel Group CEO and President. Appreciate you taking the time here to chat with us today. Be well. We're going to take another quick break here on the show, but when we return, discussing the big bright spot in the buy now, pay later space, at least according to Bank of America, the analyst behind a new report looking in on what's going well for them, including a pretty serious increase in the price target there on shares of Affirm. We're going to chat with him on the other side of the break. Stay with us. Welcome back to Yahoo Finance Live. If there has been one trend as of late, it has been the emphasis and enthusiasm around companies in the buy now, pay later space, the potential there to replace an entire generation's use of credit cards as they increase online purchases. Of course, we've talked a lot about Affirm, and that is the subject of a big price upgrade at Bank of America, where analysts there have pointed out Affirm is a bright spot in what is already a very hot spot in the buy now, pay later world. And for more on that, happy to bring on the analyst behind the report here. Jason Kupferberg joins us, senior payments analyst at Bank of America Securities, alongside Yahoo Finance's RT Swaminathan. And Jason, I mean, when we look at it, you upped your price target here on Affirm from $119 a share to $160 a share. Talk to me about what you like so much. We already know it's a hot space, but why Affirm?
Thanks for having me back today. So a couple of points to make here. First, let me start with the enthusiasm we have around the whole buy now, pay later category. We do think that there's still a big penetration story here to be had. Only about 2 to 3% of the US e-commerce market is currently buy now, pay later. So lots of room to go there. And then within this category, we are particularly bullish on Affirm. We see a number of positive characteristics here. First of all, we believe that they are offering a much broader range of loan products for their merchant customers to offer to their consumers. Second of all, they operate across a much broader range of average order value, average ticket size categories, a broader range of merchant verticals. And third, they've clearly distinguished themselves as the buy now, pay later provider of choice among particularly large merchants. Walmart is a customer, Target is a partner. They've recently announced a relationship with Amazon, which will be launching over the next couple of quarters or so. we believe. So they have all those factors going in their favor. We also just had some recent survey work where they fared quite well. And on top of that, they recently had a really bullish analyst day about 2 weeks ago, talking about a robust product map here in the coming years. So for all those reasons, we did increase the valuation multiple and our price target to a street high level.
Jason, during an earnings call today with JPMorgan, Jamie Dimon actually called out a firm and said that, when you saw a firm come out, it's no longer about buy now, pay later. They're going to have a debit card and a cash banking account. And this is the interesting one. We will spend whatever we have to spend to compete with all these folks in our space. So with more traditional banks coming in, do you worry about, in terms of market share, just this entire space getting too crowded and maybe a firm falling behind?
Well, there are a lot of fintechs that are sort of chasing this space, if you will. You've seen companies like Square and PayPal broaden out their offerings, right, into areas like crypto, for example. PayPal just announced their new digital wallet 2.0. They're going to have a high yield savings account as part of that. Their Venmo platform offers both a debit card and a credit card. So you are seeing the blurring of the lines increasingly between traditional banks and these fintechs. And Affirm, to your point, is absolutely moving in that direction as well. They did unveil what they dubbed their super app strategy at this analyst day a couple of weeks ago. So they too have a high yield savings account. They are on the verge of introducing what they're calling their Debit Plus card. They will also have crypto services. They will have rewards programs. And so I think the challenge potentially for the traditional banks will simply be pace of innovation. And certainly they have big balance sheets and lots of dollars to spend, but a lot of these fintechs do have a bit of a head start.
Is there enough demand, you think, in the market to support all of these services? I mean, to Artie's point, you've got names like an Affirm, like a Klarna, and then you've got the more traditional players who are now jumping in as well. Does this seem like it's all leading towards consolidation?
For sure. I completely agree with that. Over the medium to long term, I think there does need to be, and there will be, more consolidation in the BNPL space. We certainly believe that there will be multiple winners, but we don't think there'll be 10 or 12. There'll probably be 3 or 4. And so in our view, the BNPL providers that are primarily concentrated in what we would call the pay in 4 part of the market, which is simply 0% APR transactions, 4 equal installments over 6 weeks. That's the area of the market that feels to us is kind of getting the most crowded. And Afterpay obviously recently decided to sell to Square. And we do think that there will be more consolidation over time. We do think Affirm will certainly be on the short list of long-term winners here in the BNPL space.
Yeah, I mean, I guess when it comes to all this, right, we talked about winners, losers, potential acquisition targets here, but from the consumer perspective, when I try and describe why this is different than a credit card or what really changes for them in purchasing this stuff, it seems very similar. So maybe for the skeptics out there, why is it a game changer?
So it depends on the particular consumer we're talking about. Buy now, pay later is not targeted at the affluent consumer who's trying to max out their rewards, on a premium credit card. It's really targeted to more the low to middle part of the demographic spectrum, consumers who either have trouble getting a traditional credit card approved for them, or they've had a traditional credit card in the past and they've had difficulties managing the product. It's a lot easier to get in trouble as a consumer with a traditional credit card than a buy now, pay later service. There is deferred interest, there are late fees, it's a more complex product. And so people who need kind of more of almost a budgeting tool from their credit provider, if you will, are really the perfect fit for buy now, pay later. When you look at the most common model, the pay in 4 model, it's easy to understand. It's 4 installments over 6 weeks. There's no interest, and it really does help these consumers from a budgeting perspective because those payments will typically align with their pay period. So from the perspective of that slice of the consumer base, it really is different than a traditional credit card, and that's where the BNPL service is resonating. Plus, a lot of these consumers tend to be younger. and the younger consumers are looking for more tech-centric type solutions, and certainly the buy now, pay later services fit that mold with their ease of use, given all of the direct merchant integrations that they have with easy-to-use buttons on websites and apps.
Jason, just very quickly, in your survey, you said 24% of the respondents said they turned to buy now, pay later because they maxed out on their credit cards. Just very quickly, if you can, does this behavior pose as a risk to the industry?
I do think it's very important for the buy now, pay later providers to continue to be quite vigilant as it relates to credit decisioning and monitoring delinquency rates. None of these businesses have been sort of fully tested through a traditional down cycle in credit. So in theory, that is a longer term risk. We believe that these providers have pretty effective algorithms that will help them to avoid any major downside from those risks. But certainly we are cognizant of that. These are credit intensive products.
Jason Kupferberg, Senior Payments Analyst at Bank of America Securities. Appreciate you coming on alongside Yahoo Finance's RT Swaminathan. Appreciate the time. We're going to take another quick break. We'll be right back after this. Well, we said the S&P 500 was fighting to avoid its fourth straight day of losses, and still, as we started the show, close to break even. Their financials off nearly 1% as we got the earnings update from JPMorgan. Of course, kicking off earnings season, we got much more for you here on Yahoo Finance Live. Stay tuned. We're back in 2.
Hello, everyone, and welcome to Yahoo Finance Live. I'm Alexis Christoforous, and here's what's happening. The White House steps in to ease the supply chain crunch. President Biden is expected to announce that the Port of Los Angeles will work 24/7 to get goods to stores in time for the holiday shopping season. We'll bring you that announcement when it happens. And more proof today that supply chain bottlenecks and pandemic-related labor shortages are pushing prices higher. A new government report finds inflation surged by the most in 13 years in September. So if prices peaked, and what does it all mean for the economic recovery? And I guess call it a small silver lining amid all this rising inflation. Americans receiving Social Security benefits will see a nearly 6% pop in their payments next year to help offset those surging consumer prices during the pandemic. As for stocks, they are struggling today. We've got ourselves a mixed picture right now. The S&P also on track for its fourth losing day in a row. Investors trying to digest that inflation news and some better than expected quarterly results from JPMorgan Chase, which kicked off our earnings season today. We've got the Dow down more than 86, the S&P hugging the flat line, but the NASDAQ finding some takers there among the high-tech names, up now 52 points. Want to check in with Jared Blickery for more on today's action. I know, Jared, you have more on this inflation data and also financials, which despite that strong report from JP Morgan are among the losers in today's session.
Yeah, investors are fickle, and we're going to get to those reports in a second. First, want to tackle those headline inflation numbers, 5.4%, really just maintaining those high levels, and 4% if you take out food and energy. Digging into the report, I think it's notable that used cars, which were hugely contributing to some of those numbers in inflation that we were getting a few months ago, that component actually shrank by about 0.7%. So did apparel, so did airline flights, and so you put it all together, the reopening is not making as much of a dent in inflation, isn't contributing as much as it was. So it's other factors, which means that we can't necessarily pass this off as transitory. I think that's the bottom line from this report. Now, let's dig into the market action to see what's happening today. Really interesting on a sector basis. If we take a look at the Wi-Fi Interactive here, we have utilities. That is the biggest outperformer, followed by materials, and then consumer discretionary, and then healthcare. We are seeing the 10-year T-note yield back off of those recent highs, and so that is fueling the growth trade at the expense of the value trade. And value is indeed the worst component here. Energy down 10, looks like 11 basis points right now. Financials off more than 1%. And we got to go to our financials heat map. JP Morgan beat on all the top line and bottom line key statistics. However, their forecast for loan growth and their loan growth for the reporting quarter a little bit soft, and investors have such high expectations coming into these earnings seasons recently. May not be what the doctor ordered here, at least as far as investors are concerned. We're going to see Bank of America, Wells Fargo earnings tomorrow. You can see those stocks down about 1% and 2% respectively. But just getting back to JP Morgan's numbers, they were solid all around for the most part. Mergers and acquisitions really took the cake. And then, of course, trading wasn't as great as it was the year prior in the same quarter because volatility is ebbed. But nevertheless, I think we're seeing that investors have very high standards here that are going to have to be met. Same for Delta. We can see airlines under pressure here. Delta's down about 5%, United 4%. And inside the Delta announcement, I think their forecast for jet fuel prices kind of spooking investors. That's going to weigh on their margins going forward. And a lot of companies in this earnings season are going to be talking about price inflation and also their supply chain constraints. The latter really not affecting the airlines so much. But I want to stick with the transports and cover one more story here. We just got a report that Amazon is seeking to use long-range cargo jets that are able to fly from China. So this could definitely eat into some of the market share that we're seeing from FedEx and UPS. And here's an intraday chart. On the news, we saw a little bit of a dip there in FedEx and a little bit of a dip also in UPS, but you can see the stock has recovered those temporary losses here. Just taking a look at what Amazon is doing, we're going to look at the NASDAQ 100. Amazon up 0.7% today. And a standout here is Apple. In the upper left, we've been talking about how they, according to a Bloomberg report, are going to be producing 10 million fewer iPhone 13s than expected, Alexis.
Yeah, and again, it's all because of the computer chip shortage. At least that's what Apple is saying. All right, Jared, thanks so much. We'll see you a little later on. Smoothie King is one of the world's largest smoothie brands, and the company is coming off an impressive third quarter where same-store sales jumped 18%. Well, now the president of that company is sharing some fresh ideas on how they were able to keep workers off the sidelines and avoid the labor shortages that have been plaguing much of the restaurant industry throughout this pandemic. Joining me now is Dan Harmon, COO and president of Smoothie King, and Yahoo Finance's Danny Romero. Thanks so much for joining us, Dan. Good to have you here. So what's the secret sauce? How were you able to retain your workers during this time?
Well, thank you for having me, and I appreciate your asking. I don't know that it's secret sauce. I've been in the food industry, retail industry my entire life, my entire career. And it comes down to how you take care of your people. And I'm not going to sit here and tell you that we haven't had opportunities, because we have, but we've been able to minimize that by what we call hire them right, train them right, treat them right. And we want to make sure that we're bringing in the right people, because we're a special brand. We believe we're really special, and we're really excited about what it is that we do with helping people live a healthy and active lifestyle. And so we want to attract people that have a passion for that. And so that's what we're looking for. And when we find people that are able to do that and they have a passion for that, and we train them, we have to make sure that they understand our business. They get really excited about being here, and they do a really nice job of taking care of our guests. And so, those are some of the things as we think about it. It's never easy to bring people on. You're always taking a chance, but you certainly see some bright stars. And many of our managers and some of our franchisees started at the team member level. And so there's a real nice career path for those that are looking for it.
And Dan, I was reading your blog earlier, and we've seen a lot of companies offer incentives, also bonuses for employees. What is your take on that, and is it effective?
I'll tell you, I've seen some of those bonuses, and they're just, they're shocking what's going on out there. We have had to, in some areas, offer to compete to offer some level of a signing bonus. We like to more think of it a retention bonus. And so if we can get people to stick around for a period of time, we'll give them a bonus on top of what they're doing. But we're really focused on how do we take care of them, and how do we set them up for success and make their jobs easier. We're not the typical fast food or QSR. We don't have the fryers. We don't have the grease. We are fresh, and we have great products that they can be proud of to serve. And when we find those people, I think, the added bonus of being able, from a retention bonus or a signing bonus is just, it's good and it's helpful, but I don't think it's the key to getting the right people in the stores.
And so I guess a question to that is, how many employees have you been able to retain during the pandemic? And also, what's the feedback that you have received from workers in what they are specifically looking for in a company?
So our goal this year was to reduce our turnover by 20%. We haven't quite hit that goal, but here's what I will tell you. And I just left a meeting with our team members in the Dallas area. And we started talking about what is difficult about their role and responsibility. And people obviously came up. And the things that we're doing, making sure that people are going through the right training, that we're being kind, and we're saying please and thank you and we appreciate you. We do regular performance appraisals so that they have something to look forward to. And so in doing that, I think that has set us up and put us ahead. But and that's the feedback I'm getting from the team members. It really will come down to the end of the year number and how does it actually work all the way through. And again, I want to say we're not perfect. We have our opportunities. We have areas where we need to work on, but I truly believe, and I know the team that's working with me, we believe that if we hire them, take care of them, train them, they're going to stick around much longer. And they certainly, when that happens, it makes our guests happier. They see that smiling face coming in the store on a regular basis. We know them by name, and we're really excited to have them. So Again, I don't think it's a secret sauce. I think it's about, doing the right thing is really what it comes down to.
So Dan, it's my understanding that Smoothie King is a franchised business. So you have franchisees across the country. I'm curious what you've been hearing from them, as they are local small businesses in their communities. Have they had a difficult time staying open? And how are you able to get a handle on quality control when you have these franchisees?
Yeah, great question. I'll tell you, we have, first of all, we have 60 stores that we're operating. And so we have a real good understanding of what they're going through. And so because of that, we've been able to share best practices. We've been able to hold webinars and share with them what is working for us and not working. There are markets where it is definitely much more competitive, and we're all chasing after the same people. And so we have to be a step above, or one more reason why, give them reasons why they would want to join us. We've had franchisees that had to go on limited hours. And, it's not something that we want to do. But, if we'll do that for a period of time. I'm really proud to say that, that's not something that we've had to employ or use as a tactic across the entire system. And I see that in other QSRs and or food service establishments, and that's got to be tough. From a quality perspective, we have a team of folks out there that are working shoulder to shoulder with our franchisees. Their goal and their bonus on how do they help them drive top line sales and their bottom line profitability. And so they're invested in making sure that they're successful. And we have a great group of franchisees. I mean, we're successful because of our franchisees and the work that they do. And they're committed to the product that we're serving to our guests as well, and want to make sure that it's right. So yes, there is some that we have to go in there and check, but I'll tell you, I'm really thrilled and proud of our franchise community and how they embrace the brand and what it is that we do.
All right, Dan Harmon, President and COO of Smoothie King, thanks for making time for us today. On the other side of the break here on Yahoo Finance Live, the White House reveals how many Americans have already received their COVID-19 booster shot. Now, for the latest on the coronavirus, the White House says 7 million vaccinated Americans have already received a COVID-19 booster. Meantime, Florida has slapped a $3.5 million fine on one of its counties for enforcing vaccine passports. Joining us now is Dr. Rishi Desai, Chief Medical Officer at Osmosis and former Center for Disease Control and Prevention Epidemic Intelligence Officer. We're also joined by Yahoo Finance's Karina Mitchell. Doctor, thanks so much for being with us. I want to start with the action there by Governor DeSantis in Florida. Now, he is citing freedom and privacy concerns as the primary basis for his a ban on vaccine passports. As a medical professional, what's your response to that?
Well, I think the key is that we're in a very unique situation, right? We're in the middle of a pandemic. This isn't a time when we can evaluate this without that context. So when you have, hundreds of thousands of deaths in your country, you have to weigh that against concerns that he's bringing up. And I would say that the biggest imperative we have right now is to get our country back on track, to get our jobs back on track. We need to get past this pandemic. And the best way to do that, we're not here like we were 18 months ago with no vaccine. We have a vaccine. We have a way to prevent this that's extremely impressive, very effective. We need to make sure people get it, and that those that get it start getting their freedoms back. So it's an imperative for their freedoms to make sure that everyone gets vaccinated and that information is displayed very loudly and proudly, and so that we can get this country back on track. And so that's what I would say to him.
And Dr. Desai, thanks so much for being here. Quick question for you. So if you're traveling into this country by air, you need to get a negative COVID test, right? 72 hours beforehand. But in this case, coming in from Canada or Mexico, that isn't required. So you could have proof of vaccination. You could come into this country and you could actually be infected. Let's say you have a breakthrough case of the Delta variant or something. There is no quarantine mandate, so you could go out public freely and potentially spread the virus. So my question to you is this the best method of opening up? Or is somewhere like China, where there's a COVID zero policy, or New Zealand, where, restrictions are much more stringent? You come into the country, you must quarantine at an authorized facility for 21 days, unless you're someone like Nicole Kidman in Hong Kong shooting for, a Netflix show or something. Which is the best method for opening up?
So that's a great question. The best method is the most conservative method. Like if your goal is to minimize COVID risks, then you're right. You'd make sure people are vaccinated. You'd want to test them. Maybe you test them within 72 hours, or if you want to be more stringent, maybe test them in 48 hours, or even more stringent, maybe test them the day of their flight, right? Like you can kind of cramp it down if you wanted to. The fact is, Mexico and Canada have lower rates of COVID than we do in the United States. In other words, the risk of a Mexican person or a Canadian person or an American person having COVID is not equal. The chances are highest if you're American. Our rates are the highest. We are the most risky of those three countries. And so to really kind of come down hard on people that are lower risk is a little bit odd, Having said that, you're right. If you wanted to kind of minimize the risk, you do all those things, but you'd probably start with Americans themselves, right? Like you'd want Americans to be tested frequently. You'd want Americans to make sure they're vaccinated. In fact, if anything, the risk is for the visitor coming into this country. That risk is higher than the person that is already here and receiving the visitor.
Doctor, I want to ask you about something playing out in the sports world. We've got the Brooklyn Nets deciding to bench Kyrie Irving until he's vaccinated. It could cost the All-Star guard $15 million if he decides to not get vaccinated. On the other side, you got Andrew Wiggins of the Golden State Warriors. He didn't want to get vaccinated. He finally did. He said it was a tough decision, but he said it came down to playing for the NBA or not. One of the arguments here is that, look, why do I need to get vaccinated if I said I would agree to be tested as many times a week as you want me to? And we're hearing this play out not just in sports, but among healthcare workers as well. Is it enough if people don't get vaccinated to substitute that, if you will, with frequent testing?
Look, the NBA is trying to comply with the laws that govern the states of California and New York. New York and California have made these rules that apply to every citizen in those states. Andrew Wiggins, Kyrie Irving, they're phenomenal basketball players. They're still They're still not above the law. They still have to comply with the laws of those states. And so in those states, it is not feasible to test every person living in California, every person living in New York and New Jersey. Like, it's just not feasible to do those things. And so it is much more feasible, it's much more reasonable to have a requirement to show that someone is vaccinated. And so if you want to comply with those laws in those states, the NBA is trying to play along with that, which makes sense to me. That's why they're doing this. And I get it. I get that Andrew Wiggins and Kyrie have their own personal take on this, and I appreciate that. They're also ambassadors, like it or not. They're role models for young kids. So they have that kind of dual responsibility. And I think that it's great that they're thinking through this in a public way. And I hope that they, at the end of the day, come to realize that the body of science is on the side of vaccines.
And Doctor, I just want to tag on to what Alexis says, because, 2 New York court rulings went in really different directions. So teachers are not exempt, right, from getting the vaccination. They have to get it. But healthcare workers, temporarily at least, are exempt based on religious reasons. Now, I know you just said that you sort of favor everyone sort of doing the right thing and moving forward. But don't you think that having these sort of 2 different rulings sort of confuses people and creates a sense of apathy, if you will? Why should I get this vaccine? The red line keeps changing. And do you personally feel that healthcare workers should be vaccinated? And if not, should they lose their jobs?
We live in a very messy democracy. And in a messy democracy, you're right. Judges make this ruling and that ruling, and it can be confusing. And you're right. Some people hear that and they get confused, and then that confusion leads to apathy. Absolutely true. Now, you asked about my personal take. My personal take is that if you're a healthcare worker, you agreed to first do no harm. Part of that is getting yourself protected as best you can, and part of that is getting vaccinated. So yes, I do believe that a healthcare worker ought to get vaccinated. Now, having said that, there is another value in this country, and that value is personal choice and freedom, and part of that freedom is religious freedom. And so as we weigh these different values, it will get messy, and my hope, my fervent hope, is that very soon all of the judges will sort of have a body of law to fall back on, and that body will be grounded more in science than in any other kind of value, and that scientific principles will win out at the end of the day, given that we're still in this pandemic. And I hope that all these rulings will then kind of favor getting vaccinated. But it's not going to happen overnight. And so while we're in the thick of it, we have to be patient and recognize that confusion and apathy can set in for some people.
Yeah, and we certainly are still in the thick of it. Dr. Rishi Desai, thanks so much for being with us. Coming up next, we're going to hear from the founder and CEO of the at-home exercise company, Tonal. So don't go away. welcome back. At-home fitness player Tonal announced earlier on Yahoo Finance that NBA great LeBron James is now an investor and brand partner. Tonal's founder and CEO, Ali O'Reilly, gave us a deeper look into that partnership. Here's what he had to say.
It's something we're extremely excited about. The relationship with him started about 18 months ago when he first joined Tonal as an investor. And how it started isn't all too different from other athletes who've invested. We have about 20 to 30 professional athletes who've invested in our business. And the story is always they got a Tonal, they used it, they fell in love, and then they wanted to invest. And over time, we've just built that relationship. And being someone who works with equipment basically his entire career, has been around fitness his entire career. When he sees something like Tonal, adaptive digital weights, something that's incredibly efficient, something that's incredibly data driven, he had to use it, and a partnership made perfect sense. He was excited about it, and we were able to make this happen.
Ali, you see the list of athlete investors you have: Steph Curry, Drew Brees, Serena Williams. Is LeBron now the biggest athlete investor in your company?
LeBron is definitely he's without a doubt one of the greatest athletes of all time. We're really, really proud to have him involved in the business. We're excited. He's excited. And you know, the most important thing that I can say about this is he's been using Tonal to train. He actually believes in the product. It's something that he personally uses. He views strength as a foundation of greatness. And this is something that came up in a lot of our interactions with him. And being able to get stronger with the most advanced piece of equipment ever created is something that he's really, really aligned with. This is something that, of course, we've seen with the likes of Serena Williams and Steph Curry and dozens of other athletes who use the product for that exact same reason. And he's just adding one of the greatest athletes of all time to our roster, and having him be involved with us in this capacity is just a huge, huge step for us.
Hey, Ali, it's Julie. Obviously, when you get these folks sign on as investors, it's something that can potentially prompt more people to sign up and buy the product. How many people have bought the product? How many of these have you sold? And how has your sales growth been?
Well, we have not been talking explicitly about numbers in terms of dollars sales. But what I can tell you is we did last year announce that we grew 8x year over year, which is massive growth. In January of this year, we raised $250 million at a $1.6 billion valuation, and we've seen significant growth since then. And so when you're looking at those valuation numbers and the multiples that you would assume are behind them, you can extrapolate the rate at which we're growing and how many Tonals we're selling. I'm just going to tell you, it's a lot. It's significant.
Ali, do you expect some form of shakeout in this at-home fitness space? I see you guys, very innovative product, Peloton, very innovative product. But I see something like a Mirror, I would say not too innovative, and you see other competing type products out there. Ultimately, over time, is there just two major players in the space?
Well, we are the leaders in connected strength. We're also the leaders in intelligent fitness. One of the things that we did differently from everyone else in the sector is our aim to bring a personal trainer into the home rather than just a group fitness experience. We did that by bringing a lot of data to bear, by building AI and personalization. And we really view that as intelligent fitness, not just connected fitness. So we're forging ahead, and we're leaders in multiple dimensions. We've built all sorts of moats around our business. We filed over 45 patents to date. Of course, there is one business that you mentioned, Peloton, which is significantly larger at this point, but we're growing faster than they historically grew. And then you're right. After that, there's a lot of smaller businesses who are building more point or niche solutions. And I do expect that that's going to shake out over time. I don't believe this is a winner-take-all market, but I also don't believe it's a market where we're going to have room for a dozen different players.
And Ali, news out today that Apple is having trouble just getting components for its iPhones. I mean, how does your supply chain look in this environment?
I'll just tell you, it's a lot of work to secure supply. We've tripled the size of our manufacturing team just in the past 12 months. And the 12 months prior to that, we 10x our manufacturing capacity. We brought a second factory online last year, bringing another factory, a third factory online in the next few months. And a lot of this is just about securing materials, securing capacity, keeping supply chains moving, and logistics, just moving product around the world and across the country. It's hard work, and it's where we're making a lot of investments. The vast majority of our investments are either going to marketing, brand, operations, or content, where you might have heard, but we recently announced live content on our platform as an addition to the many forms of content that are available to our members.
And Ali, I know you've been asked this before, and I'm going to ask it again, what the IPO plans are. And if you're not ready to IPO now, sort of what you're looking for, what would be the trigger? What would be the thing that would mean that you're ready to go there?
Well, we've been building towards it. In the last 6 months alone, we've brought in a number of new executives into the C-suite, and operations, product experience, technology. And a lot of that is about readying the company for an IPO. We still have a lot more building to do in terms of operations, finance, infrastructure, and a lot of the compliance things that you need to be public. But it's something we're working towards every single day. We're going to look for that moment in time where being a public company is beneficial to us and is not a distraction. Being public can often take a lot of management energy, and right now we're growing so fast that we just want to focus on supporting that growth rate. And really supporting our member base, which is incredibly passionate about our product. We have a net promoter score that is pretty stable at 85. We have the highest engagement in the sector. And those are metrics we certainly don't want to lose track of just to become public. We'll become public when we can pull off being public, tap those kind of public capital markets, and make sure that our business is solid throughout the entire process.
All right, you have been watching the CEO of Tonal, Ali O'Rady. Coming up here on Yahoo Finance Live, 6 lies women are told about the gender pay gap. We're back right after this. The gender gap in pay, it's remained relatively stable in the U.S. over the past 15 years or so. Actually, in 2020, women earned 84% of what men earned. That's according to a Pew Research report. And based on that estimate, it would take an extra 42 days of work for women to earn what men did in 2020. Joining us now to break down the 6 lies women are told about the gender pay gap is Yahoo Finance contributor Mandy Woodruff-Santos, who we know is also co-host of Brown Ambition podcast, and Yahoo Finance's Karina Mitchell along for the ride on this one. So great to see you as always, Mandy. I want to start with the number one lie you outline. You say that college is the great equalizer. Not so much. Talk to us about it.
Yeah, let's just set aside the fact that there's incredible student loan debt holding so many college graduates down today. But for women, studies have shown that even when we get college degrees, and by the way, women are more likely to go to college, graduate from college, and get better grades than men. And still we are plagued by the same pesky wage gap. So the fact that people think if you go to college, it'll solve all of your issues as a woman in this country, it's completely false. Hate to break it to you.
And also, so we have a graphic up on the screen right now. Your second one is choose a high-paying STEM job and you'll be fine. You know, pay is equal there. Don't worry about it.
You know, it is lonely being a female engineer, and that can hurt you when it comes to your pay as well, as researchers have found with other STEM careers. Even if you choose the so-called right area of study or industry to get into, the pay gap will follow you as a woman in a lot of cases. And we haven't even mentioned the pay gap for Black women and women of color. I know at the top of the story, you know, you're talking about 84% is what women earn compared to men, but for Black and brown women, it is even worse. It'll take us even longer to reach pay parity. And that brings me to my third point, which is childcare. And this is really going out to all the dual income households, you know, with moms and dads. If you think that your partner is going to split childcare 50-50, and believe me, I'm a modern feminist woman who just launched a business. I have a toddler son and an amazing husband who's always supported me. And even we do not master that elusive 50-50 childcare split. Your baby, honestly, babies don't care about gender pay inequality. They want mama when they want mama. And if that means mom has to stay home from work to be with them when they're sick or stay home from work, you know, just to take on childcare, especially during a pandemic, that is often falling on the shoulders of women. And that can truly help proliferate this gender wage gap.
And then I want to go on to, I know we have another full screen coming up as well, but the fourth point is paid parental leave is the answer, which is surprising to me because don't women take more parental leave anyway?
Yeah, absolutely. You know, only 1 in 4 Americans actually gets paid parental leave. So I can honestly see why people may think, oh, well, if we just give more families paid time off, then won't that help women, you know, feel like they've got the support and stay in the workforce? When actually, if you look at countries like Denmark, where they have 12 months of paid parental leave for their families, there is still almost as large of a gender wage gap as there is in the US. So what's going on there? And my point that I'm making here is the fact that when you actually give paid parental time off, it is the women who are more likely to take it, which means women are more likely to take time off from their careers to be that childcare provider in the home. And that can hurt them long term. I mean, even if it's available to you, can you imagine what taking a year out of your career can do to your job prospects, jumping back into the workforce? And even if you're working for the same company, they may think you're not ready for a promotion. They may hold back a raise. So there's other ways that you can still be penalized, even if you're given additional paid parental leave.
And then the next point that you mentioned is that the gap doesn't exist for people with the same jobs and qualifications.
Yeah, so this is something I've found. It's true. It's true. When you actually look and control for things like location, job experience, qualifications, research has shown that the gender wage gap almost disappears. Almost, but it still exists. Even if a woman is earning 98 cents to every man's dollar, why are we okay with that? You know, that may sound like just a couple of cents, but honestly, when you look at a lifetime of earnings, it may mean that a woman has to work a full year longer than a man before she retires, and I find that completely unacceptable. Why are we okay with that?
And the final point, which is the most galling to me, is that all we have to do is ask for more. Like, we don't do that.
Yeah, exactly. You know, the reason I wrote this article and why I'm so passionate about it is because I really feel like it's taking down all of the reasons why. It's taking down all of those usual arguments that put the onus on women to fix the problem. Go to school, find a supportive spouse, find a job that gives you maternity leave. All of those things put the onus on our shoulders. And with this last one, the point that I'm making is that even if women ask for more, research has shown that we are less likely to get the raise. And that goes doubly so for Black women, women of color. So all of the things that we're supposed to do to help ourselves get paid what we're worth don't actually work. And what really will help close the wage gap is when companies and when managers and the people who really have the power recognize that they have a contribution to make here, recognize that they need to take these things seriously, put systems and processes in place so that you're paying women equitably and fairly, and actually show that you care about wage equality. It cannot just be solved by women ourselves.
All right, Mandy Woodruff-Santos, Yahoo Finance contributor. Good stuff as always. Nice to see you. Coming up next, how the luxury retail market is holding up under the weight of higher prices and tighter supply. We're back after this. Welcome back. Consumer prices inched up slightly in September, climbing 0.4%. And despite the inflationary pressures, LVMH, which owns luxury brands including Louis Vuitton and Christian Dior, posted strong third quarter sales. Here with a closer look at the luxury market is Pauline Brown, former chairman at LVMH of North America and also the author of Aesthetic Intelligence. Karina Mitchell is with us as well. So good to see you. Thanks so much for joining us. I want to start with why we're seeing strength right now in the luxury market. Who is it that's buying these goods at elevated prices?
Well, first of all, the top line shows enormous strength. If you peel the onion, there are areas of weakness, so it isn't a very consistent level of strength. Your answer, or the answer to your question about who is buying, it continues to be the Chinese. That is also, in my mind, the biggest vulnerability for companies like LVMH and its chief competitors.
And how about the supply chain issues? I mean, I have to believe that these luxury goods companies are not immune to that. What are you hearing about supply chain issues for that segment of retail? And are they also experiencing a tough time with labor shortages?
So on the supply chain, it's not hitting them like it hits mass market companies. For one, the bigger categories of luxury, like fashion and accessories, are made predominantly in Europe. And the gateways that seem to be most disrupted are generally between the U.S. and Asia, and so that hasn't been as big a factor. There are some segments of luxury, like watches and jewelry, where there's some parts scarcity, but that's a different supply chain challenge than the one that we're seeing hitting toys and other mass manufactured goods.
Mm-hmm. And what are some of the? Oh, go ahead, Karina.
Oh, sure. I was just going to say that sales actually jumped 20% in the quarter to almost 18 billion, and fashion and leather continued to outperform. But what other categories do well for this, for LVMH? And were domestic sales stronger compared to international sales?
So a few things. Number one, 20% was the top line, and it's a very, very healthy number for such a big company. It's actually pretty dramatic slowdown from the second quarter. So if you look at where the growth was number one in Asia, and LVMH is defining Asia minus Japan, but China is a huge part of that. That was actually up 26% over 2019 levels, which is the baseline they're using. But if you look at Q2, growth in Asia was 34%, so pretty dramatic slowdown. The second fastest region by far was the US. Growth here was up 22%. But again, in Q2, it was 31%. So you see a general softening. With regards to the categories, you're right. Fashion and accessories were a stellar segment for the company. That was really driven by their two largest brands, Vuitton and Dior. Dior especially has almost doubled in size in the last year over 2019. So they're investing a lot in the Dior brand. But the other one that's worth talking about, because it really is moving the mark for the company, is watches and jewelry. Watches and jewelry this last quarter was up 18%. That is not because the core business was up so strong. In fact, the core business was actually only 1% up. It's because they had closed on the acquisition of Tiffany. And Tiffany accounted for the lion's share of that growth. Tiffany actually doubled LVMH's position in watches and jewelry.
Do you have any insight, though, on labor shortages in this segment, especially as we move closer to the holidays and these businesses want to be ramped up and ready for customers?
Yeah. So on the production side, I don't think they're encountering the kind of labor shortages that we see in many other businesses. On the retail side, in terms of people working in the stores, that's a real challenge. That's a challenge for any retailer. Again, it probably not as acute as what we're seeing in restaurants and hospitality, but it's still a challenge. The other challenge that LVMH and many other luxury companies have is attracting millennials. So if you think about the next generation of workers, both white collar and blue collar, they're not that inclined to go into retail. They're not inclined to go into products. They're going to technology. They're going into finance. So they have a bit of a generational gap, which is why some of the strategies they've employed are very much geared toward attracting a next generation employee into the group.
And Pauline, you touched on this a little bit earlier on, but I want a little bit more insight if you can. So LVMH is a bellwether stock for luxury brands, right? And so the stock dropped 9% when China came out with that statement about common prosperity and that it wants to redistribute wealth and make things more equal. So I know Asia had a strong performance, but it did ease, as you say. Going forward, how does the brand deal with that sort of component? Because Asia is such a huge market. And, talking about luxury products like watches and jewelry, we've seen an easing. People are pulling back right now in Asia from buying those sort of items.
Mm-hmm. Well, short to midterm, that's going to be a huge challenge, arguably the biggest challenge for the group, especially as the effects of the pandemic are leveling off. Longer term, what we may see is that there's a bolstering of purchases by Asians who are traveling. So they're going to be less inclined to buy at home, which has been most of where the sales have happened in the last 18 months. But they will reinvest when they get back into Europe, back into the States. And in terms of an appetite for luxury goods, I think that on the one hand, there'll be, I don't think it's demand to buy nice things, especially as there's general prosperity that hasn't existed for all that long in places like China. There's still enormous interest and appetite for better products and for designer products. The issue people will have is the displays of wealth that have been so prominent these last 10 years or so. And so I think the kind of luxury products that they'll buy will be quieter in nature, probably less likely to buy the big, heavily labeled, belts and bags and over-the-top watches, and more luxury goods that will hold their value, that are a bit less obvious. But wealth will still look for quality in their lives and in their homes.
Pauline, when people are going out to buy these luxury goods and they are willing to spend a pretty penny to do it, are they still choosing to do it in person at the brick and mortar store, or have you seen a real growth in people's willingness to buy these luxury goods online?
You don't see nearly the adoption rates that you see in other categories, and that is especially true in fashion. I also sit on the board of Neiman Marcus, and while Neiman Marcus has a very large and fast-growing online presence, there's no replacing buying things in store, discovering things that you wouldn't have had either the interest or the capability of discovering just by surfing the web. And then, of course, trying things on. One of the major impediments to selling high-end ready-to-wear in a digital format is sizing. It's just very, very hard to know not only how things will fit until you've actually put it on your body, but also how things will look, how they drape, how they feel. And for that reason, offline sales for high-end ready-to-wear will continue to be, I think, the main source of where people will buy. There are other categories like handbags that will migrate much more easily online, especially for those brands that are already well trusted and have the kind of desirability that drives luxury in general.
Mm-hmm. Good point. It is tough, though, to buy some of those fashion items without trying them on. Pauline Brown, former chair at LVMH North America, thanks so much for being with us. And we've got a check of the markets on the other side of the break. Well, it is another volatile one on Wall Street. We now have stocks moving mostly higher. You know, earlier the Dow was down pretty sharply, but it's turned things around, managing a gain here of about 3 points. We've got the S&P 500 now up 13, trying to snap that four-day losing streak, and the Nasdaq gaining strength here as we head closer to the close, now up nearly 100 points as investors feel comfortable getting back into some of those high-tech names. Taking a look at the winners here for the Dow, helping the Dow to climb out of its hole earlier. Nike having a nice day. That stock up nearly 2% right now. Also Salesforce, 3M, Amgen, and J&J actually announcing today that its booster for the COVID-19 vaccine gave patients a lot more coverage than just the regular vaccine boost. And also, we've got some of the losers here for the Dow. Amex, JPMorgan, despite that better than expected profit report, also lower. Visa and Dow Inc. as well. We've got much more ahead here on Yahoo Finance Live. We're back right after this break. It's 2 p.m. on the East Coast. Welcome back, everybody, to Yahoo Finance Live. I'm Alexis Christoforous. Taking a look at the markets, another volatile one. Choppy trading session, stocks wavering after a hotter than expected read on inflation. That's boosting the view that the Federal Reserve might move up its timeline for those interest rate hikes. We've now got the Dow down 27. It was up just moments ago. The S&P 500 gaining 10. NASDAQ Composite trying to hold on to a pretty decent rally, up now about 88 points. Fresh consumer price data today showing U.S. inflation accelerated slightly in September. Labor shortages and supply chain bottlenecks continuing to push prices higher across the board for consumers. And many economists now expect those higher prices to linger and not be as temporary as the Fed first thought. Let's check in with Jared Blickery now for a closer look at some stocks that are trending today. And Jared, we know the banks now out or starting to come out with their earnings reports. JPMorgan Chase among the first. On its face, the report was very strong and beat estimates, yet the stock is getting punished. Why? I think you're muted, Jared.
We got those CPI prints this morning. Jamie Dimon was kind of dismissive of the inflation story, saying that the consumer is strong and just kind of emphasizing some of the better aspects of the economy and really the economy's growth, which he said is a good thing. Also, investment banking was really a bright spot for them. We know that we're in a mergers and acquisition boom. Their trading was a little bit weaker given the same period last year, and that's because of the lower volatility in the market. Now, there was some focus on his acquisition strategy. This is Jamie Dimon outlining a 10-year plan, basically, to acquire fintech and other things to enhance their digital offerings to customers. And with respect to the pandemic, Dimon and his CFO, they both said they're hopeful that the pandemic will become endemic by next year. I think everybody hopes that it will be a no-demic. And I do have some analyst commentary from the street. First is Baird, and here's a quote. Overall, we felt that JPMorgan posted a solid quarter with slightly better than expected revenue and favorable credit trends, saying that the stock may see muted gains today as expectations were already riding high heading earnings. That was before the stock is posting the losses that we're now seeing before us. Finally, Credit Suisse saying JPMorgan has kicked off reporting season, setting a clearly positive tone for what a bank that executes can deliver. But nevertheless, even after coming off of record highs only last week, or perhaps even Monday, this stock is down about 2.5% today and just kind of leading the entire banking sector lower, as you can see on your screen.
Yeah, lots of red there. You know, I talked earlier about a bounce back in big tech, but Apple's not participating in that. What's behind that stock moving lower today?
That's right. Not as many iPhones are going to be able to produce as we thought before, going from 90 million to 80 million, and that is a material drop of 10 million. You can see on the NASDAQ 100 in the upper left, Apple is quite the standout, down 0.5%, although it had been down a bit more today. You can see off of the lows from about 11:30 a.m. And I do have some notes from the street on this. Credit Suisse saying the fact that Apple is having issues procuring enough semiconductors is meaningful, as it should underline the extent of supply shortages and perhaps provides some comfort that the semi cycle is not at risk of an abrupt and despite what is clearly some restocking across the supply chain. But taking an opposite, or I guess a different little take here, is Truist Securities. They're saying news of more shortages are, quote, completely unsurprising and confirms our extended peak cycle view. That Apple is seeing shortages is somewhat surprising, as it is the biggest customer in the supply chain, and it, quote, operates in the consumer end market with very short product cycles where missed shipments result in demand destruction. So nevertheless, Apple down about 0.5% today. They did in the Bloomberg report that dropped the story, they did signal that Broadcom and also Texas Instruments were some of the causes of those supply deficits. And we can see those two stocks down as well on our semiconductor board. Texas Instruments down about 1/3%, and Broadcom down just about 18 basis points at the lower end of your screen.
All right, and finally, we have got the Yahoo Finance Plus investment idea of the day, a bullish call on Fastenal. I know they're out with their third quarter results, and I guess the street likes what they're hearing.
That's right. This is from Argus Research, and let's check out the Wi-Fi Interactive here. I'm going to pull up a chart. This is going to be over the last 2 years. You can see Fastenal up about 48% over that time period, and over the last year or so, just really in a pretty steady uptrend. And I believe Argus has a price target of, yes, $60, and that would be right up here. So perhaps at the upper end of this trend channel. And I'll just give you some of their reasoning in their investment report. They're saying that reasonable price, the subject line is there is a reasonable price for a consistent grower. Fastenal shares have traded in line with the market over the past quarter with a flat performance. The company recently reported third quarter EPS rising 10% from the prior year and matching consensus forecast. Fastenal generates lots of cash and the balance sheet is strong. Management has signaled confidence in its long-term outlook with a series of dividend increases and a special dividend over the past 2 years. So once again, checking out the year-to-date performance here, we're seeing it up about 10.7%, Alexis.
All right, Jared, thanks so much. Just about a moment ago, the Federal Reserve released the minutes from its most recent meeting. Our Fed correspondent, Brian Chung, has been looking them over. He joins us now. What are the big takeaways there, Brian?
Well, the big takeaway, Alexis, is that the plans to taper asset purchases, again referring to the Fed's pace of $120 billion a month of purchases per month, it really kind of appears to be fleshed out. This is according to the minutes detailing the deliberations that were done in that September 21st and 22nd meeting. So again, this is backwards looking. So any sort of inflation data, employment data that we've gotten since then does not seem to reflect or would not reflect any sort of commentary that we got here. But the details of the FOMC, noting that, quote, participants noted that if a decision to begin tapering purchases occurred at the next meeting, and again, the next meeting is going to be November 2nd and 3rd, the process of tapering could commence with the monthly purchase calendars beginning in either mid-November or mid-December. So the Fed kind of illustrating in these minutes that whenever they do announce that taper, the actual process of slowing its purchases will begin pretty shortly thereafter, in a matter of weeks, perhaps. And we're also getting a little bit more detail on how the Fed might do that. It appears to be the case that the preferred path is a $10 billion a month reduction for U.S. Treasuries, $5 billion a month reduction for mortgage-backed securities. But interestingly, they want to leave the option on the table to, quote, adjust the pace of the moderation of its purchases if economic developments were to differ substantially from what they expected. And several of the FOMC members said they would prefer to move faster on slowing its asset purchases. And again, one more reminder to kind of draw the distinction here between slowing its purchases and then reducing its overall purchases. What it's describing here in that $10 billion, $5 billion pace is slowing the current purchases that they have. So ultimately, the balance sheet will still be increasing in size, but rather the pace by which it's increasing will slow when they do ultimately commence. That hasn't happened yet. But again, all signs pointing to the Federal Reserve announcing something as soon as that November meeting. On inflation expectations, interestingly, the Federal Reserve at the time appeared to say that the broad measures that they look at didn't appear to point to anything outside of range. Again, that's before that hot CPI print that we got this morning. So we'll see if Fed officials change their tone on that as they head into the next meeting. But it seems like for all intents and purposes, Alexis, all for a green light in that November meeting, barring any sort of other type of change there. But again, Federal Reserve offering a little bit more detail on how they might taper in these FOMC minutes from September. Not sure we can hear you, Alexis.
Hey, Brian, here, I'm back with you. Sorry. I was just looking at the markets and checking to see if there's any kind of a reaction here to those minutes. Doesn't seem to be, and even taking a look at the bond market, we've got the yield on the 10-year now at 1.55%. Are you surprised that the market's not reacting at all here to what they're hearing coming out of these Fed minutes?
Not necessarily. I think, again, the idea here was for the Federal Reserve to clearly communicate to the markets exactly what they were doing. And actually, if you look at the text of what the minutes say, they describe this as an illustrative path. And the reason why is because they wanted to signal to markets with plenty of lead time exactly how they would do that. They said they wanted it to be simple to communicate and entail a gradual reduction in the pace of net asset purchases. So the Fed doing exactly what it's been doing, essentially tiring the markets out with the talk of tapering, the talking about tapering, just to get the point really home that this is exactly how we're going to do it. This is when we're going to do it so that markets don't spiral out of control. And then just one separate thing I wanted to mention here that's off topic but is relevant. No notes in these meeting minutes with regards to the ethics issue that the Federal Reserve was facing that has engulfed at least 3 senior Fed officials. But at the very bottom of the minutes, notable that says, quote, this deliberate and thoughtful review, referring to the review of its ethics rules that Fed Chair Jerome Powell launched shortly after the episode, quote, will focus on strengthening Federal Reserve rules and standards in ways that will help guard against even the appearance of conflicts of interest or any other improprieties. So worth watching as the Federal Reserve tries to embark on that review to make sure they clean up that PR mess that they've had with those big trades made by those 3 Fed officials.
All right. Thanks a lot for breaking down those Fed minutes for us, Brian Chung. We've been talking about it all day long. The latest consumer price index showing that inflation rose 5.4% 4% from a year ago in the month of September, matching a 13-year high. And one of the places we're all feeling this is food prices and beverage prices. They are going up, up, up. Joining us now to talk more about it is Brian Spillane. He is a food and beverage analyst at BofA Global Research. He is the senior food and beverage analyst there. Brian, good to have you here. So tell us what areas of the food and beverage industry these higher prices are impacting. I have to think it's pretty broad-based.
Yeah. Hi, Alexis. It's really running the gamut, but the most extreme right now are prices in protein. So thinking about like chicken, pork, bacon prices, for instance, beef prices to a certain degree are all moving higher. And some of this is supply shortages, some of it's supply chain disruption. So there you're seeing, in some instances, double-digit price increases. But even when you look across kind of the middle of the store, we're seeing the packaged food and beverage companies now pushing prices up in anywhere between 4% and 6%. And that's really the highest level of pricing that we've seen in one instance from these companies in a very long time. And it's a reflection of the inflation that they're seeing.
What is happening at some of the large grocery chains across this country right now, Albertsons, Kroger's, Walmart, in terms of keeping their shelves stocked? Because I made a trip recently to the market, and I have to tell you, they were not very stocked, and I'm wondering how much longer that may go on.
Yeah, it's still an issue. And from the supplier issue, so from the food and beverage manufacturers, there's shortages in all kinds of odd things. That it's hard to get a hold of food cans, glass jars, Gatorade bottles. There's just a lot of different pieces in the supply chain. And then also the other two variables are because demand is still so strong, being pulled out of the grocery store, these companies are all having to run extra shifts, overtime, and they're running into some resistance from workers not wanting to work as much overtime. And then there's also, logistics, freight shortages. So that all adds up to service levels, into the grocery stores lower than normal. And I think there's two things that are happening. One, especially as we move into the holidays, retailers looking to build a little safety stock. So take a little extra inventory, and also the merchandising levels. So, this period from October through New Year's is one of the most heavily merchandised and promoted times of the year for the food and beverage industry. And you're still going to see an end cap, you're still going to see an aisle display, but you're going to see very little, if any, depth of promotion, because the risk of promoting it is you're just going to be out of stock.
We saw the reports this week that Walmart, Costco, among the companies who are now getting their own cargo ships to deal with the supply chain. Is there one company out there better positioned than another right now to weather this storm?
The companies that have direct distribution, so you think about Pepsi, Coke, Keurig Dr. Pepper, Nabisco, which is owned by Mondelez. These companies have a lot more control over what happens to their product from the time it comes off the manufacturing line until it gets into the store. So I think from an advantage in logistics, the beer companies as well have that direct model, and I think are a little bit better advantaged in terms of having more surety, I guess, on logistics and getting products shipped to where they need to go. And I think also, we're seeing within the food companies, especially, it's things that go in cans that have been kind of tight in supply, but packaging that's like candy, for instance, or resin-based, even though the prices are higher, there's at least been more availability of supply.
And just in the few seconds we have left, when people start thinking about ways to save money at the grocery store, it might be, buying those cupcakes or, that snack that they crave because they've got to deal with the major components of dinner or lunch. Do you see some vulnerabilities there for some of the food manufacturers as people have to make those hard decisions when they go to the market?
Yeah, it's a good question. We're not seeing it yet. And I think part of the reason for that is that food away from home, buying food in a restaurant or at a QSR has also inflated. So there's the relative price gaps are attractive. I think also we're still in a period where consumers have they're not spending on all the other items that they may spend on. So there's a little bit more household budget for the food budget. So it's something to watch, but as of now, we've been very surprised at how little volume elasticity there has been related to the price increases we've seen recently.
All right, Brian Spillane of B of A, thanks so much for joining us and for sharing your insights. Coming up next, William Shatner reaches the final frontier on a Blue Origin rocket. We've got details straight ahead. At 90 years old, William Shatner became the oldest person to reach space today. The Star Trek actor and 3 others completed a Blue Origin flight this morning, and Yahoo Finance's Inez Ferre here with all the details. Sort of brings new meaning to beam me up, Scotty, Inez.
It sure does, Alexis. We're really watching the infancy, the baby steps of the start of space tourism with this mission and the recent ones that we've seen. So this is the second mission for Blue Origin's New Shepard that had passengers on it. You saw the first one in July with Jeff Bezos, the founder of Blue Origin and also the founder of Amazon. This flight was fully autonomous, no pilot. It's a suborbital flight going beyond more than 60 miles above Earth. Bezos greeted the passengers when they landed. There was champagne flowing. Shatner going into space is truly significant, not just because William Shatner was the oldest person to go into space, but because he's also an icon for space enthusiasts. His reaction after the flight was so compelling, so emotional, saying that everyone in the world needs to do this. Take a listen.
This comforter of blue that we have around us. We think, oh, that's blue sky. And then suddenly you shoot through it all of a sudden, as though you whip off a sheet off you when you're asleep, and you're looking into blackness, into black ugliness. And you look down, there's the blue down there, and the black up there, and it's just, there is Mother earth and comfort. And is there death? I don't know. Is that death? Is that the way death is? Whoop, and it's gone. Jesus.
And Alexis, I mean, I got to think that as more people go on these suborbital missions, on these space flights, that their descriptions of what they experience will really sort of increase that enthusiasm that people have for space exploration. Right now, we don't know how much the tickets are for Blue Origin. So William Shatner did not pay for his ticket, and Audrey Powers, who's a VP of Blue Origin, she did not pay for to go on the mission. But the other two passengers did pay, and we don't know how much those tickets are. We do know that Virgin Galactic's tickets are $450,000 a piece. In some areas of the country, that's worth 2 homes. But those ticket prices need to come down in order for people like you and me to be able to go on those flights. So the question is, how long will it take for that cost to come down, for this to become something regular so that more people can take part in space tourism? Because right now it's millionaires, it's billionaires that get to go, but when will you and I be able to go on these flights? And that remains to be seen. We did do a Twitter poll on Yahoo Finance asking people when they thought that those tickets would become more affordable. And about 38% said anywhere between 10 and 20 years from now. 44% said not in this lifetime. So not a lot of people think that they'll be able to go on one of those flights. But the fact that William Shatner was on it, I think this also raised a lot of visibility for the mission as well.
Yeah, I think we have to live vicariously through William Shatner. Hard to believe he's 90 years old. He's getting around just great. May we all be able to do that and live such a charmed life. Thanks so much for bringing us that report, Ines Ferre. Coming up next, we're going to hear from the CEO of Best Western about the continuing recovery in the hotel industry. We're back after this. Incoming BWH Hotel Group CEO and President Larry Kukulik speaks with Yahoo Finance Live to discuss the company's key priorities amid the hotel industry's road to recovery and competition amid a tight labor market.
You know, Best Western is a tremendously unique organization, and our mission is to drive revenue to our members. And that has to be our priority and our focus as we move forward, successfully coming out of the pandemic. And we have done that. We have had a tremendous year so far. Best Western in this past, I'll call 3 or 4 months, have had a terrific summer. And although the season was strong, yet it's a rebound from the slower start of the year as we came out of the pandemic. But travelers want to travel. And we were the first company to put in place health, well-being, and safety protocols. And as a result of that, we found guests wanting to stay at Best Western hotels. And as a result of that, we had a terrific summer, and our hoteliers welcomed travelers back and did very, very well.
We have seen record quit rates across sectors. Best Western certainly not immune to that. And I know when I spoke with David Kong last, he had mentioned that it's not just that you're competing with other hotels now when there's a very tight labor market. You're also competing with tech companies, for example, for those who have been in the hotel industry for a very long time. They see higher wages over there, better benefits, different opportunities. How do you compete with something like that?
First, I've got to note that Best Western hotels are independently owned and operated, and generally small business owners. And what's so important for them is they are foundational and bedrock members of their communities. And as a result, they can establish a working culture where people want to work as strong members of those communities. The hospitality industry is different than working in an Amazon warehouse or working for an online business. What's different is working in a hotel is all about caring for the guests that walk into your doors and treating them as if they're walking into your home and ensuring they're having a stay that meets their expectations, making sure that you're taking care of their health and well-being. But mostly it's about caring for those guests. And our hoteliers do a great job in that regard. And as a result, if they can build that caring culture, I'm very hopeful that the labor force will recognize it's consistent with who those employees are, and they want to be a part of that culture so that they can interact with guests on a daily basis and make sure that they know that they're welcome into our hotels. So it's about becoming an employer of choice in those communities. And we've done a lot to help our hoteliers in that regard. Published best practices. At our recent convention, we held multiple seminars and workshops with regard to employment matters, because it's not always about, and it is not about just attracting new talent. It's also about retaining the talent you have. And so we're very, very passionate about helping our hoteliers establish a culture where people want to work.
Yeah, and Larry, let's talk about, I mean, we were talking earlier on the show about a return to travel and return to kind of getting back to normal. I mean, that was something we talked about with your predecessor here on the show, what he's seeing. What are you seeing now when it comes to kind of different travelers getting back to staying with you guys?
Well, the pent-up demand really was with, I'll call them the family travelers that came back to our hotels over the summer season. We're now hopeful with regard to the last quarter of the year that business travel will pick back up as the vaccination programs, of course, are more and more successful. Additionally, the recent activity by our government opening our borders from Mexico and Canada, I think is going to have a significant impact on travel as we complete calendar year 2021. Especially with regard to those hotels that are on or near the border that can see a tremendous increase in stays as a result of those borders opening back up. And I applaud the government for taking that action, which will happen really, I think, near term November.
Welcome back. Crude oil holding above $80 a barrel here to end the day. Jared Blickery joining us now for a recap of the day in oil. Jared?
Yeah, let's take a look at the Wi-Fi Interactive so we can see the latest quotes and price action in crude oil. And there we go, $80.48. Looks like it just settled minutes ago, $80.44 per barrel, still trading in the electronic market. And I do have a note here. This is from the Energy Information Association Administration, a subset of the Department of Energy. They're raising their forecast for next year for WTI and Brent prices by nearly $6 per barrel. So going from $68.24 all the way up to $71.91. And that's a range for WTI and Brent prices in 2022. You might note that's about $10 lower than the current prices, but nevertheless, there you go. Checking in on the price action, and here is an intraday look, kind of choppy right there. We'll just take a longer term view. Here's a 2-month chart where you can see still the gains pretty substantial for crude, up 17.6%, and that trend very much intact from the lower left to the upper right, Alexis.
All right, thanks so much, Jared. Want to stick with energy now and bring in Cynthia Murphy. She is managing editor of ETF.com. It's part of our ETF report brought to you by Invesco QQQ. So, Cynthia, we know that energy has been the best performing sector this year. Quite a different story than what we saw last year during the throes of the pandemic. First off, are you seeing investors pushing their money into this sector in new and different ways here as we look ahead to 2022?
Hi, Alexis. Yes, we have. I mean, energy has been an underdog for so long. And if you look at all the S&P 500 sectors since really 2008, that, when this year we saw investors for the first time take a much closer look at your, value cyclical rotation, energy played front and center in that. And it's been finding all sorts of assets coming into some of these funds because it was the value opportunity. It is, the underdog that has much more upside potential than some of these more richly valued sectors that have been so popular in recent years. And so the money has been following a lot of these types of funds. Now, in the ETF space, the benchmark fund, if you will, for the conversation on energy is XLE, which is the sector spider, which is your S&P 500 energy stocks, which if you think about energy as part of the S&P 500, before the financial crisis, it was, double digits, 18% maybe of the S&P 500. Today is under 3%. So it's a sector that really, really had a lot of upside room potential relative to the other sectors because of such a long time of underperformance.
What about the volatility that goes along with investing in this space? Are you feeling that that's keeping some investors away? Because I would imagine volatility is going to stick around for the foreseeable future.
Absolutely. And I think in energy, the volatility has that extra twist of just the idea of what's the future of energy. Internally, we've been talking a lot about that in the sense that, the future, as we expect to be, will be clean energy, not fossil fuels. But fossil fuels today is the way we still do business today. So you start to see like a lack of investment in your classic fossil fuel infrastructure, but we still depend on it heavily. So you start to see shortfalls there. So it causes volatility that's not really demand driven as much as more of an infrastructure issue. Is how is that all going to unfold as we switch to more clean energy as time goes on? And volatility has to be the name of the game in that context, because it's a give and take that we're going to have to balance out as all industries and businesses and our technology really transitions into clean energy.
Some industry analysts are saying that these soaring, energy prices are just a stark reminder of just how dependent Europe especially is on fossil fuels. Are you seeing investors being choosy about where they're putting their money in the energy space? And is it geographic as well? Are there more opportunities that investors are taking advantage of in the U.S., say, versus Europe or elsewhere?
Yeah, we're seeing some money go into energy small caps, for example, which is something we haven't really seen in a long time. So it just compounding that whole value cyclical rotation play. Energy small caps, it's talk about a risky spot. That has been an interesting place. Funds like PSCE, and even an XOP fund, because it's equal weighted, it tilts a little bit smaller. These are all funds that have been interesting plays this year. Now in 2021, generally across all sectors really, but energy is included in that, we've seen investor demand for international exposure in a way we also have not seen in recent history. Of all the money that has come into ETFs in 2021, more than 26% have gone specifically into international equity plays, which is much higher a percentage than any previous year in recent memory. So there's definitely an appetite, there's a look for that value opportunity outside of the US because things have run up so much over here. So there's a more welcoming appetite to global exposure for sure, energy included.
Cynthia, what's one headwind that you see perhaps derailing the rally we've been enjoying in energy as we head into the holidays and into winter?
I think, winter is always a tough month for energy costs from a consumer perspective. I mean, if you look at natural gas, it gets colder. I live in Chicago, so we expect those heaters to be running constantly. But I think it always going to hinge on inflation. For the first time today, we saw, I think it was the Atlanta Fed president that started, questioning this notion of transitory inflation. So there's a little bit of a cracking of this confidence that this is just transitory. And I think inflation really can change the conversation on all of these sectors, but energy specifically, because there has been a perception that some of these prices, gas prices, have kind of peaked. But if inflation really picks up, it could, starts to dent consumer confidence. It starts to hurt businesses and eventually hurts demand. And none of that is good for the companies that operate in the segment. So I think keeping an eye on inflation, what happens next, would be key.
For sure. All right, Cynthia Murphy of ETF.com. Thanks for being with us. And coming up next, how higher prices might impact your next Social Security check. We're back right after this. Welcome back. Social Security recipients will receive an annual cost of living adjustment of nearly 6% next year. It's the largest increase since 1982. Joining me now to talk about it is Don Cravens. He is Executive Vice President and Chief Operating Officer at National Urban League. Don, good to see you. Explain to folks why these Social Security payments are going to get a boost beginning next year.
Well, Alexis, thank you so much for having me on. As you said, right now the projection is that people who do receive Social Security are going to see this nearly 6%. And as you said, it's the first time in a long time that people are receiving these benefits, this adjustment, and it's based because of inflation, because of the economic stimulus packages that we've seen from our federal government during the pandemic. People received money and they want to spend that money, and as a result, there's a lot of need and desire to spend that money. But as we know, goods have been hard to come by in many sectors. And so that has created this inflation. And as a result, we're going to see people getting higher checks, bigger checks next year for 2022 in Social Security. That could be a good thing. It sounds, you'd think more money is always a good thing, but not necessarily. If we continue to see inflation rise and the cost of food and services continue to rise and rise, then many people who lived on a fixed income unfortunately going to continue to have to fight to make ends meet.
Right. So really, it becomes a wash. I mean, they're going to be getting a slightly higher payment, but when everything else is going up in price, it's not like they're going to have any sort of discretionary money to play with. I also want to talk about something the National Urban League is out with, and that is this annual State of Black America report. It's entitled The New Normal, Diverse, Equitable, and Inclusive. Share with us, what did this year's report show as it relates to how African Americans fared during this pandemic?
Well, Alexis, we've been doing the State of Black America report since 1976. And Vernon Jordan, who recently passed away, was our chairman and CEO at that time. And he started the report so that we could track as a nation the strides that African Americans had made during the 1960s. Because even back in 1976, he was starting to be concerned that we were losing some of the momentum that we had gained in the 1960 civil rights movement. And so we've been tracking it since 1976. And as to your question, what did this year's report show? It showed that African Americans have suffered 3 pandemics over the past 2 years. We suffered the pandemic of COVID-19, and that there was disproportionate health inequities, health impacts on African Americans as it relates to the pandemic. We saw that there were disparities when it came to the other pandemic that struck African America, which was the economic downturn as a result of the pandemic. And then, unfortunately, we continue to suffer, people of color, African Americans, Latinos, continue to suffer this pandemic of racism that we saw stem from the death of George Floyd in the hands of police officers. And so we continue to see that as well in voting suppression laws that occurred right after the election by state legislators and legislatures who didn't agree with the results of the election, as well as other racism, bouts of racism that our country continues to endure. So what the State of Black America for 2021 showed is that African Americans continue to lag behind disproportionately. The racial wealth gap in this country is growing wider and wider, despite the fact that African Americans are more educated now than ever in the history of our country. We have more and more African Americans who've graduated from colleges and universities and trade schools, and yet the racial wealth gap continues to grow. The income network between white Americans and African Americans, African Americans, we continue to lag behind. When you look at the State of Black America report in 1976 and the State of Black America report in 2021, unfortunately, Alexis,
I think we may have lost you. Don, are you with us? All right.
Yes, I am sorry about that.
Oh, no worries, Don, no worry.
What I was saying is when you look at the State of Black America report in 1976 and the State of Black America report now in 2021, unfortunately, many of the issues we were dealing with in 1976, we continue to deal with today.
You know, when you look at corporate America over the past year or so, there have been a lot of promises made, promises of big commitments to the civil rights community, especially in the wake of the death of George Floyd. From where you sit, how have those companies done in terms of living up to those promises?
Well, there were a lot of commitments, and we saw it at the National Urban League as well as other civil rights organizations where companies came in, many of whom were companies we've partnered with in the past, where they've been partners with the Urban League, philanthropic partners with the Urban League, and they came in and said, look, we want to do more. We want to do more in the communities that need help. We see the racial disparities that exist. We also saw companies who had not engaged in that way in the past. And we welcomed those companies with open arms and said, hey, where have you been? We absolutely have a lot of work to do in this country. What we are hopeful is that this is not a flash in the pan, one-time gift to the National Urban League because people are feeling bad about something that has just happened. We're hoping that this is an end to corporate philanthropic redlining, that people understand that the wealth of this country that has been built by all Americans, we need to look down sometimes and look backwards and extend a helping hand to those Americans who may need an extra hand. And so that's what we're hoping, that the corporate philanthropy that we're seeing as a result of George Floyd and some of the other things that have happened in this country, we're hopeful that these companies are in for the long haul, and they really want to see us make some long-lasting change in America.
And Don, finally, as the Biden administration looks to solve problems related to the pandemic, what are some of the important components of the infrastructure legislation still trying to make its way through Congress and in that reconciliation package that can assist the African American community in particular?
Well, Alexis, we're hopeful that they will pass an infrastructure bill and then move to a reconciliation package. As you know, there's a lot of money, a lot of resources in that bill to help all Americans, but will help African Americans as well. Jobs is a big issue, as you've shown on your program time and time again, that the racial wealth gap and the jobs that people of color, we're still looking for those jobs and those opportunities. We think the infrastructure package can provide some help, some much needed help. It can also benefit the country as a whole by building new bridges and roads and infrastructure, providing universal broadband services so that all Americans and their children have access to broadband. We saw during the COVID pandemic, when we all went to a virtual society, that many Americans, their children were left behind when they had to go to the entire virtual classroom. And so we're hopeful that the Democrats and the Republicans in Congress will pass an infrastructure-led piece of legislation. They'll also look at the reconciliation. And all I would suggest to them is, if there's anything missing from this legislation, it has great intention, but someone or some agency needs to also ensure that the equity, the principles behind the legislation, that this is supposed to go to all Americans. It's supposed to be shared equitably, that jobs are being shared equitably, that someone is tasked with ensuring that equitable outcomes are a result of the infrastructure. I would hate for us to look back 5 years from now and say, great intent, we spent a lot of money to change things, but we missed the mark because we didn't invest in all of America's people. And so I'm hopeful that the administration, as well as our leadership in Congress, will not only pass it and get it into the streets, literally and figuratively, in America, but will also ensure that all Americans have a fair share to participate in the benefits of the infrastructure and the recovery package.
Don, part of what you're talking about is the fact that a lot of Black households, 17%, actually lack basic financial services or the access to banks that many whites have access to. What can the government do in particular to help change that scenario?
I think the government can help educate people. I think the government can also work with banks to ask why that is. You make a great point, Alexis. There's a large number of African Americans who have no credit score. They are not even on the radar of the credit agencies because they don't even participate or can't qualify for a credit score. And so a lot of that is going to come from education. A lot of that is going to come from exposure. And all of it is going to have to come from an intentional effort to bridge that gap from the banks and the people. We believe organizations like the National Urban League and others, we can help bridge that gap. We have credibility with the sector, the industry, but also credibility with the people in the neighborhoods. And so we've got to do something. You cannot achieve the American dream of buying a home or owning a car, transportation to get around, to go to work, if you have no credit score, if you don't have a bank account. Things are becoming more and more automated. So cash is not the way to do it. And so if people don't have bank accounts, they don't know how to bank virtually or electronically, then they continue to fall behind. And so if you're wondering, if your viewers are wondering, why does this racial wealth gap continue to widen when more and more people are going to college and becoming more educated? It's because a large group of people in this country, many of whom are African American, are just being left behind. And that's not good for the country. It's not good for the country.
All right, Don Cravens of the National Urban League, thanks so much for spending time with us today. I'm going to make a hard turn here now. Thanks, Don. And talk about French fries, because isn't it just horrible when you get those fries at a restaurant or a fast food chain and they come to you soggy and cold? Well, Wendy's is trying to change that, and they have got a new initiative out called the Hot and Crispy Fry Guarantee. And Brooke DePalma here now with today's Brooke's Bites to fill us in. Brooke?
Alexis, that's right. If you're not happy or satisfied with your French fries at Wendy's, they will actually give you a free new package for free. So I spoke to Kurt Kane. He's the Wendy's US president and chief commercial officer. And he told me over the phone that if a customer gets an order of fries and they don't think that they're hot and crispy enough, then they should hand them back to us, and we should be happy to give them a brand new French fry in exchange. Now, beginning today, all franchisees will have brand new packaging outlining that guarantee. And this is part of an introduction of the newly updated French fry recipe that launched back in September, which took the fast food giant nearly 4 years and over 20 different cuts and shapes just to get right. Now, once again, this is the brand new packaging. It says on the back, fries should be both hot and crispy. So really putting a lot into this. I did get these about 30 minutes ago, but let's see if they are still warm. Relatively still warm, Alexis. I am pretty surprised, actually. They're still crispy as well. Now, Kane did tell us that the fast food giant really hit the mark on this, with the largest support that he's seen from franchisees since he began his tenure at Wendy's back in 2015. Now, the amount in which Wendy's is putting into this investment was kept close to the vest, he said. However, in our phone call, he did take a jab at competitor McDonald's, noting that Wendy's is putting the fries as a star of the show, whereas competitors, they love to say, would you like fries with that? They think about it as a second or a third tier option. They don't put it as number one in their heart.
All right. I don't know if the fry is number one over the burger, but all right, I get it. Wendy's also announced a new deal with Google Cloud to help efficiency at its drive-thrus. What about that?
Yeah, Alexis, they're keeping a lot of the amount of how much they're investing in this AI technology and new recipes, once again, close to the vest. But Wendy's chief information officer did tell the Wall Street Journal that the company really wants to take the customer convenience to the next step and use all the data they collected during the COVID-19 pandemic to really create a new and, alter and more convenient customer experience. Examples of that include allowing customers or employees rather to know if there's a long line of customers waiting on the drive-thru in order to put in that next fry, letting employees know when it's time to flip the burgers, also voice recognition and its drive-ins. So there's no more shouting at the drive-thru, but rather this AI technology taking what customers say and transcribing it, allowing it for customers and employees to have a more easy, more seamless experience. Now, from July to October 2020, app downloads did jump by 15%. And Kurt Kane told Yahoo Finance that there are now more than 18 million reward members, but it is a long road ahead for Wendy's as they continue to gain competition. Shake Shack rising the trend. Chipotle shares of Wendy's are down nearly 2% year to date, and compared to a year ago, they're down more than 9%. So lots happening at Wendy's. We'll see if it pays off on Wall Street.
All right, Brooke DePalma of Brooke's Bites, thanks so much. And coming up in the next hour, we're waiting to hear from President Biden, who will address the nation regarding the supply chain issues and how the White House is going to get involved to try to ease some of those bottlenecks, which continue to push prices higher. We're back right after this.
An important announcement that will get things you buy to the shelves faster. I'm joined by the Executive Director of the Ports of Los Angeles and Long Beach, Gene Soroka, and Mario Cordono. I apologize, Mario. And the President of the International Longshoremen's Union, Willie Adams. Los Angeles and Long Beach are home to two of the largest ports in America, and together these ports are among the largest in the world. And the best way to make that point is that 40% of shipping containers that we import into this country come through these two ports. And today we have some good news. They're going to help speed up the delivery of goods all across America. After weeks of negotiation and working with my team and with the major union retailers and freight movers, the Port of Los Angeles announced today that it's going to begin operating 24 hours a day, 7 days a week. This follows the Port of Long Beach's commitment to 24/7 that it announced just weeks ago. 24/7 system, what most of the leading countries in the world already operate on now, except us, until now. This is the first key step toward moving our entire freight, transportation, and logistical supply chain nationwide to a 24/7 system. And here's why it matters. Traditionally, our ports have only been open during the week, Monday through Friday, and they're generally closed down at nights and on weekends. By staying open 7 days a week through the night and on the weekends, the Port of Los Angeles will open over 60 extra hours a week will be open. In total, that will almost double the number of hours that the port is open for business from earlier this year. That means an increase in the hours for workers to be moving cargo off ships onto trucks and rail cars to get to their destination. And more than that, the night hours are critical for increasing the movement of goods because highways are less crowded at night. In fact, during off-peak hours in Los Angeles, cargo leaves the port at a 25% faster pace than during the day shift. So by increasing the number of late night hours of operation and opening up for less crowded hours when the goods can move faster, today's announcement has the potential to be a game changer. I say potential because all of these goods won't move by themselves. For the positive impact to be felt all across the country and by all of you at home, we need major retailers who order the goods and the freight movers who take the goods from the ships to factories and to stores to step up as well. These private sector companies are the ones that hire the trucks and rail cars and move the goods. On this score, we have some good news to report as well. Today, Walmart, our nation's largest retailer, is committing to go all in on moving its products 24/7 from the ports to their stores nationwide. Specifically, Walmart is committing as much as a 50% increase in the use of off-peak hours over the next several weeks. Additionally, FedEx and UPS, two of our nation's biggest freight movers, are committing today to significantly increase the amount of goods they're moving at night. FedEx and UPS are the shippers for some of our nation's largest stores, but they also ship for tens of thousands of small businesses all across America. Their commitment to go all in on 24/7 operations means that businesses of all sizes will get their goods on shelves faster and more reliably. According to one estimate, together, FedEx and UPS alone move up to 40% of packages in America, up to 40%. And other companies are stepping up as well. They include Target, Home Depot, and Samsung that have all committed to ramp up their activities to utilize off-peak hours at the ports. So, the commitments being made today are a sign of major progress in moving goods from manufacturers to a store or to your front door. I want to thank my Supply Chain Disruption Task Force, which we set up in June, led by Secretaries Buttigieg, Raimondo, and Vilsack, and by my Director of National Economic Council, Brian Deese. I want to thank them for their leadership. And I especially want to thank Joe Procari. I think Joe's done one heck of a job, my special envoy specifically on ports, who's been working this issue with all the stakeholders for the past several weeks. I also want to thank the port directors. I want to thank Gene and Mario again, and the mayors of Los Angeles and Long Beach, Mayor Garcetti and Mayor Garcia, for their leadership. And I think the private companies that are stepping up, I want to thank them, but I particularly want to thank labor. Willie Adams of the Longshoremen and Warehouses Union, who is here today, the Teamsters, the rail unions from the Brotherhood of Railroad Signalmen, and the International Association of Machinists, to the American Train Dispatchers Association, to Sheet Metal, Air and Rail, and Transportation Workers Union, known as SMART. I want to be clear. This is across-the-board commitment to going to 24/7. This is a big first step in speeding up the movement of materials and goods through our supply chain. But now we need the rest of the private sector chain to step up as well. This is not called a supply chain for nothing. This means that terminal operators, railways, trucking companies, shippers, and other retailers as well. Strengthening our supply chain will continue to be my team's focus. If federal support is needed, I will direct all appropriate action. And if the private sector doesn't step up, we're going to call them out and ask them to act. Because our goal is not only to get through this immediate bottleneck, but to address the long-standing weaknesses in our transportation supply chain that this pandemic has exposed. I might add, parenthetically, one of the reasons why I think it's very important that we get the infrastructure plan passed, my infrastructure plan. And that supply chain system is almost entirely in the hands of private business. The world has changed. Prior to the crisis, we cheered, the focus on lean, efficient supply chains, leaving no buffer or margin for error when it comes to certain parts arriving just in time is needed to make a final product. And our administration, Barack and ours, that's where it was just in time was the focus. We didn't have a pandemic and other things at the time. We need to take a longer view, though, that invest in building greater resilience to withstand the kinds of shocks we've seen over and over, year in and year out, whether it's the pandemic, extreme weather, climate change, cyber attacks, or other disruptions. In fact, research tells us that a company can expect to lose over 40% of 1 year's earnings every 10 years due to supply chain disruptions. A longer-term view means we invest in systems that have more time built in and our ability to produce, innovate, and partner with our allies. It also means companies throughout the supply chain, like maritime, air freight, and trucking companies, reduce their carbon emissions and help to meet our climate change goals. It also means creating and supporting good-paying jobs so folks want to stay in these jobs, so they can build the skills and careers and to make a decent living. It means more opportunities to join a union, especially for truckers. These steps are critical. They allow companies to pivot quickly when a disruption hits because they've invested in their workers' skills, and training up front to be able to adapt. We need to invest in making more of our products right here in the United States. Never again should our country and our economy be unable to make critical products we need because we don't have access to materials to make that product. Never again should we have to rely too heavily on one company or one country or one person in the world, particularly when countries don't share our values when it comes to labor and environmental standards. I've said before, we're in the competition for the 21st century. We are America. We still have the most productive workers and the most innovative minds in the world. But the rest of the world is closing in, and we risk losing our edge if we don't step up. In order to be globally competitive, we need to improve our capacity to make things here in America while also moving finished products across the country and around the world. We need to think big and bold. That's why I'm pushing for a once-in-a-generation investment in our infrastructure and our people with my infrastructure bill and my Build Back Better Act. These bills would transform our ports. There's billions of dollars for ports, highways, rail systems that sorely need upgrading, and would bring products faster and more efficiently from the factories to the store to your house. Let me be clear. We're proposing to make the biggest investment in ports in our history. The bill would also make investments in our supply chains and manufacturing and strengthening our ability to make more goods from the beginning to end right here in America. The bottom line, we've seen the cost of inaction in the pandemic, in the delays, and the congestion that affect every American. But it's fully within our capacity to act to make sure it never happens again. It's going to take a little time, and that we've unlocked the full might and dynamism of our economy and our people. That's what we're going to do. God bless you all, and may God bless the longshoremen, rail workers, truckers, and all the workers who are keeping our economy going. May God protect our troops. Thank you all so very much.
Can you tell parents that? You know what to do to lower gasoline prices? You can talk about worker safety, of course.
Welcome back to Yahoo Finance. I'm Shauna Smith alongside Adam Shapiro, and you were just listening to President Biden. He was speaking from the White House after wrapping up a meeting he had with officials and also business leaders discussing the global supply chain crisis, something that we have been discussing many times at Yahoo Finance over the last several weeks. The Biden administration laying out ways to alleviate those bottlenecks. Now, part of that plan is to keep the Port of Los Angeles open 24 hours a day, 7 days a week. But let's get down to Jessica Smith for more on what we just heard from President Biden. Jess?
Yeah, Shauna, the White House is calling this a 90-day sprint to the end of the year to try and alleviate some of these issues that we're seeing throughout the supply chain. They're hoping that by keeping the Port of Los Angeles open 24/7 and the Port of Long Beach, which has already made that switch in the past few weeks, they are hoping that that will reduce the congestion and the delays that we're seeing. Now, President Biden just said that by being open 24/7, that will mean 60 hours extra per week of work at the port. The unions there have agreed to work those extra shifts, the administration says. The administration has said that they brokered this deal between these private sector companies and the ports in order to try and solve some of these bottlenecks that we've been seeing. FedEx, UPS, Target, Home Depot, Samsung, and Walmart have all agreed to increase their hours during off-peak times, during the nighttime hours, in order to try and move that cargo from the ports out to other destinations faster and free up more space at the ports for ships to come in. They're hoping that by doing this, they're able to get those goods out quickly and, again, relieve some of that congestion. A senior administration official did note, and you kind of heard President Biden there talking about that this won't be solved overnight. This is not a light switch that you can just fix the problem immediately, but they think that this is a good way to open things up in the short term. They acknowledge that a lot of the issues won't go away immediately. And in the meeting that they had earlier today with those companies, with the trade groups, with the unions and the ports, they did come up with some other ways looking forward that they might be able to help solve these problems even more. They said that data sharing at ports, recruiting more truck drivers, and investing in infrastructure. That is a huge part of this that the administration says is needed in the long term, that while these are maybe some short-term solutions through the holidays at this point, they need long-term infrastructure investments in order to accommodate the increasing number of goods that are coming into the U.S. So this is not a conversation that is going to stop anytime soon. The supply chain task force that the White House put together earlier this year was behind this plan, and they say that they'll continue working with other stakeholders throughout the supply chain to try and shift everything to 24/7 operations when it comes to trucking and rail as well. So we'll keep you updated on those developments as we learn more about maybe what next steps the administration decides to take.
All right, Jessica Smith, thanks so much for that update. Let's take a look at where things stand because we have about 45 minutes to go until the closing bell. And you're looking at a mixed picture, although the Dow barely in negative territory. S&P and NASDAQ still holding on to gains. We know that supply chain disruptions is something that investors are watching. And also the reaction to the Fed minutes is something that's really driving the markets today. So for more on that, let's bring in Sean O'Hara. He's Pacer ETF Distributors president. And Sean, just first on the supply chain disruptions, what we just heard from the president, I guess, how worried are investors when they take a look at what's happening, and what is the market anticipating that we'll likely see over the next couple of months?
Well, thanks for having me, Shauna. Well, I think this is the key issue, right? So the inflation fears have been driven, I think, probably more by a lack of goods than an oversupply of money, although there has been an enormous amount of money printed. But without the ability to move these goods and services through the economy, I think that's what's putting pressure on prices. And so it'll be interesting to see how quickly they can fix this piece of it. And then the real longer term view of this will be to try to determine how much of the additional cost of keeping these ports open will be. Will they, will people working the port, for example, be getting time and a half or things like that, which might increase the shippers' costs? And then will this have a negative effect on future earnings? I think this quarter's earnings is probably going to be the last easy comparable we have. And then I think going forward, I think you're going to start to see companies do well this quarter and then start to guide a little bit lower based on, rising costs, rising price of energy, and supply chain disruptions until we can get this worked out.
Sean, it's good to see you. And there are so many questions, such as how do you get the truck drivers who are confined to the number of hours they can drive? All those issues have to be confronted. But what do you make of companies like Walmart saying they're going to step up to the plate? How do they do that if they have a truck driver who can only drive, say, 12 hours and then has to sit for 8?
Well, I mean, that's the key thing, right? I mean, so maybe, they're going to have to hire a whole bunch more people, which would be good. I don't know that there's that many CDL drivers out there. My partner has a CDL license, and he got a note from the state of Pennsylvania here recently. So they're looking for bus drivers. So you might be intending to do the good thing here or the right thing here, but if you can't get people in the trucks to drive them to get the goods from one place to the other, then that's going to create a problem. So I'm hopeful that they can, now that there's so much attention on this, and now that we're sort of, manifesting so much energy and effort to this, that we can finally get things back to closer to normal and bust this open a little bit. Because without that, I think you'd have to start thinking about the overall economy and what its effect is going to be going to the end of this year and then into next year.
And John, speaking of the overall economy and what this means really for the recovery going forward, we just got the Fed minutes. They were released about an hour ago, and they show that the Fed could begin tapering mid-November to mid-December. Just in terms of some of the risks that the economy is facing, what do you make of that timeline? Does that timeline make sense to you?
Well, I mean, it's what they've been sort of forecasting. So in that sense, it probably does make sense. I think you'll have to see what the reaction is. I mean, we've all heard this term taper tantrum, and the stock market has become so dependent on what the Fed is doing and keeping, easy and free money out there that the stock market might react negatively to that. I think without the Fed stepping in and becoming the buyer of last resort for some of these securities that they're supporting, I think that will drive interest rates up because that will force people to want to get paid more. And so that's also a risk here. And so, they're in a really tough spot, the Fed, and that they've sort of boxed themselves in here. And almost nothing that they do to sort of get themselves out of it could potentially be viewed as a negative for both the stock market and the bond market.
We had a guest on yesterday who said that stock valuations right now were in the, quote, okay zone. But you've pointed out that equity valuations are historically high. So for those of us who might prefer ETFs to individual stocks, what do we do with that information? If things are expensive, wouldn't the ETFs also artificially be expensive too?
Yeah, well, I mean, the overall market is expensive. So if you buy an ETF that tracks the overall market, like the S&P 500, it's trading at 24 or 25 times earnings, which is historically a very high number. We have some ETFs, for example, that are large cap in nature here at Pacer ETFs. The ticker is COWZ. It's 100 stocks. It's the 100 stocks picked from a broad index that have the highest free cash flow yield. That portfolio of stocks trades at about 15 times earnings. So if you're concerned about valuations, you can certainly lower your exposure by getting stocks that trade at cheaper valuations. The downside of that might have been you might actually make less money, but in reality, that ETF's up double what the stock market's up this year. So those companies that are generating high free cash flow and have a high free cash flow yield are attractive from a valuation perspective. They grow their earnings faster, they grow their dividends faster, they buy back more stock. And so I think it's time for people to be a little more selective. We've had a nice ride by just simply sitting on top of the ocean, if you will, and just riding the market up. Now I think what we need to start thinking about is below that ocean. It may not continue to ride, but there's going to be a lot of activity under the sea, if you will, for people to find good places to invest money where they can have better than market returns.
Sean O'Hara, always great to speak with you, president of Pacer ETF Distributors. Thanks so much for taking the time to join us. We are going to take a quick break, but when we come back, let's take a look at Delta Airlines because the stock is off just around 5.5% right now, $41.08 a share. The company swinging to a profit in the third quarter, but a dramatic surge in fuel prices that is threatening its outlook. Adam Shapiro, he sat down with CEO Ed Bastian earlier. We're going to hear a bite from that interview when we come back.
All right, we got Delta earnings this morning, and I got to tell you, I'm on the Delta website right now. Just for fun, I thought, okay, how much are ticket prices going to go up? Because we know that they are. We heard them talk about that in the interview, and we're going to hit that in a second. But I'm looking at a fare right now, New York to Miami. Are you sitting down? This would be leaving on a Tuesday, first week of November, coming back on a Friday. Round trip, $97. Now, that's basic economy, so you're sitting on the wing. But $97, that ain't bad. I'm not mad at that. All right, so where am I going with all this? Well, we spoke to Ed Bastian, and the company did report a profit, first major airline since the start of the pandemic to have a quarterly profit. But Bastian says that may be jeopardized in the fourth quarter because of rising fuel prices, which may force Delta to raise ticket prices. Here's more of what he said.
Well, domestic is doing quite well. The quarter guide is really, it's a tale of two parts of the quarter. Month of October, we're seeing very similar to the patterns we saw in September and even August. The variant was causing a fairly significant pause and delay in growth in new bookings. So October is only about 65% recovered relative to 19. But we expect the months of November and December to see a 10-point increase, and those months to be at 75% restored. Part of that is the international I just mentioned. Part of that is business demand is really picking up over these last 4 to 6 weeks. The current week, this past week, we just saw the highest level of domestic business activity and volume that we've seen in 18 months. And that recovery rate approaches 50% in the U.S., and that number we expect to continue to grow as more and more businesses open later this year or into the new year. So I'm seeing a really a meaningful amount of arrows pointed up here that indicate that we should close strong on demand and we need to manage fuel prices the best we can because that's escalated. But I think we're going to get off to a really good start for the new year, given the indications I'm seeing.
Shauna, for investors who might want to take a look at airlines like Delta, because although they have recovered from the lows in the share price during the pandemic, they're nowhere near what they had been going into the pandemic. A couple of good things on the horizon. One, they expect a big surge of international travel because the U.S. is opening up the restrictions for foreigners to come in as long as they can prove vaccination rates. And when I brought that up with Mr. Bastian, he said, look, as soon as they announced that last month, the ticket orders went up by 10x. So we already see that coming. He's very optimistic that business travel is actually coming back. He talked about that. But he also said we're going to have a surge of holiday travel. And although the total revenue recovery won't take place next year, he said by 2023, they're targeting to be better, back and better than 2019. Shauna?
No, Adam, that's such a positive outlook that we got from Ed Bastian. It's interesting to see the stock off just around 5.5% today. But of course, it begs the question, how much of some of this good news is already baked into the stock price at this point? But Adam, what you just said about business travel, because you and I have talked about that so many times. We've talked about it with analysts. You've talked about it with other airline CEOs. And for him to be that positive about that sector, he mentioned the fact that there was a surge in the past 4 to 6 weeks, and he does expect a full recovery over the next, I forget the exact timeline that he did say, but that is something that stuck out to me because I think a lot of people were thinking that maybe the business travel division, maybe that's something that will never recover to the levels that we saw in 2019 and prior.
Yeah, never say never, right? So we had Helene Becker from Cowen was on Yahoo Finance midday and was talking about the fact that business travel is going to come back, not tomorrow, but by the end of next year should be close to 90% of what it had been in 2019. And think of it this way, whether it's you, Shauna, or me, or the people who are watching us right now, yes, our companies may say no travel, but the staff is going to push. People like to travel. People like to get away. Sometimes you like to get away from your family for the 1 or 2 day business meeting. And there's going to be a lot of push to do that. And when you talk to the airline executives, it's not just from the purely business aspect of it. It's that part of it. Business travelers, the people who were flying before the pandemic shut all this down, they want to travel. And they want to travel on their boss's dime.
Yeah, I mean, I could use a night or two away, I guess. I'm always open to go on a fun trip. So if our bosses are listening, I am up for that. But yeah, I mean, very, very encouraging. Again, a little surprising to see the stock off more than 5%, but we'll see what some of the other airliners have over the next couple of weeks.
Yeah. All right, we're going to turn our attention from Delta to other issues because we have to talk about what is going on with crypto when we come back after the break. The surge in Bitcoin, you got to pay attention to it, and we're going to pay attention to it with an analyst from CoinDesk Research.
Taking a look at the price of Bitcoin, now we saw it gain a little bit of momentum over the last week or so. Today, moving higher. You can see it on your screen, just shy of 57,000, but showing some resistance at that 60,000 level. So let's talk more about this with George Kaludis. He's a research analyst at CoinDesk. And George, we've seen Bitcoin really push up against 60,000 over the last couple of trading days. What's it going to take? What do you think the catalyst needs to be in order to push above that level?
Yeah, thanks for having me, Shauna. So it's sort of wild to me that we just closed the third quarter at about $44,000, and we're now flirting with the 57,000 number that you're just talking about, and the $60,000 number. So we're up 30% already in October. It's as if our king of digital assets was waiting for the end of Q3 as a starting gun for October, is what everyone's calling it on crypto Twitter. There's probably a good joke in there about waking us up when September ends, and someone could take that from me later. But I would say the thing that's going to take it to get over the edge is likely more institutional investment in the space. And what we're seeing this time around, and I say this time around because Bitcoin's all-time highs back in April were very much retail driven. And now we're actually seeing a lot of interesting data that suggests that the people that are coming into the space aren't the retail investors. We're seeing a lot of retail brokerages and exchanges like the Coinbases of the world having more sell volume versus the over-the-counter exchanges and these funds that are buying Bitcoin. There's a lot of pressure there for buy pressure on that side.
You just said something that a guest we had on yesterday might pay a great deal of attention to. A lot of people coming in, retail investors, and then I'm going to finish it. You didn't say this, but they may not understand what they're actually getting into. Tobias Adrian from the IMF was with us yesterday talking about central banks and governments throughout the world looking at that kind of issue and using that as their reason to regulate and crack down on crypto assets. How big a threat do investors view that? It seems as if the Bitcoin investors have brushed it aside.
Yeah, in terms of IMF people coming in or whoever it may be coming and saying, okay, people don't understand what they're getting into. It actually begs the question, does anyone really, I say anyone, a lot of people don't actually understand what their money actually is. So the exciting thing about Bitcoin, in my opinion, is that people are coming into the asset because they're asking the question, what is money? Do I care about an inflationary asset? Do I care about deflationary money? So yeah, there's going to be risk. People are going to look at the fact that big regulators coming in and saying, we're going to stamp this down, no one can invest in it. But it is an important conversation that needs to be opened. I think that now that we have a lot of information available at our fingertips, we can ask the questions, what is money? Why is money?
George, how would you describe some of the buying that we've been seeing in crypto over the last several weeks? Is it people just getting in trying to buy the dip, or is there something a little bit more underneath the surface?
Yeah, Sean, a great question, because I really wish I really knew the answer. There's an interesting thing that we saw in the past maybe 6 months is that Bitcoin returned to this level of being non-correlated with pretty much any macro asset. You talk about the S&P, you talk about gold, you talk about the US dollar, and it remained in this band where it just didn't look like it was doing anything and didn't really care about what all the other assets were doing. So is it being driven by the fact that people view Bitcoin as a risk-off asset, as, oh my goodness, our dollar is going to be debased, we need to put all our money into gold and Bitcoin? Or is it, okay, there's no yield to be found, bonds are 3% yielding, I need to get into something that I can actually grow my money with? So not sure. It's an interesting place to be. It's definitely, Bitcoin is now right in the $1 trillion market cap range. So people are starting to pay more attention to it as potentially a new asset that can do, things other assets can't do.
George, when you asked that question about people who are saying, what is money? The majority, I would imagine, correct me when I get this wrong, the majority of people who are buying crypto assets, though, are not looking at this as currency, because what good is a currency if it's dependent upon conversion into a different currency to use it for a transaction? And even with the ease with which you can do that with a digital asset like Bitcoin, it still fluctuates so quickly that you might be better off with the fiat currency. So do these people understand this?
Maybe not, but there are people that do understand that Bitcoin can act as savings technology, and all these other assets could act as a means to save their money. Whether you're going in between assets doesn't really matter. When you go to a European vacation, you're not really thinking about, oh no, I have to make this US dollar that I had in my bank account become euros so that I can purchase something. it really doesn't matter in my opinion. I think the fact that you can go in between the assets as quickly as you'd like is amazing development in technology.
George Kaloudis, great to speak with you again, research analyst with CoinDesk. We look forward to having you back again soon. Well, during the pandemic, millions of Americans, they turned to telehealth when they couldn't visit their doctors in the office. Coming up next, we're going to be speaking with the CEO of Firefly Health. Now, this is a company that's launching a virtual first healthcare plan to replace traditional insurance. We've got that for you right after the break.
All right, we're about 23 minutes to the closing bell. In an era of COVID-19 and other health issues, how does this sound? Half-price healthcare, that's twice as good. That is what Firefly Health bills as one of its offerings, and they have a health plan for small and mid-sized employers that fits that mold. Let's bring into the stream Faye Rottenberg, once again, the CEO of Firefly Health. Good to have you here, along with our health reporter, Angelique Kamlani, to take part in this discussion. Very quickly, Faye, this new health plan offering, how does this work?
Yeah, so pleasure to be here. So Firefly is launching a health plan that is built around our care model. We started as a virtual first care delivery organization providing primary care, behavioral health care, specialty care, and navigation. And we're now adding coverage to that. So everyone that signs up for the Firefly plan, not only do you get health coverage that you'd expect from any traditional insurance provider, but you also get your own personal care team. You get your own personal behavioral health specialist, your own health guide to help support chronic conditions, clinical and behavioral needs.
Faye, I want to ask you about that because I know that really picking up on the telehealth side has been really big, of course, because of the pandemic. But then transitioning into the insurance side, how are you making that work? Because it seems like it's just an add-on and could be an additional expense for businesses versus a replacement for what they currently have.
No, so this really is a true replacement. And not only are you getting more care, but we really are cutting costs throughout. We have been able to demonstrate through our care delivery model about 25 to 30% savings already. And a lot of that is through our continuous engagement. So our members are engaging with us an average of 41 times a year. And as a result, they're not utilizing a lot of unnecessary services. So we're able to keep people out of the ER. We're able to help people avoid unnecessary specialist visits. all the while providing them with a lot of chronic condition support and guidance that you wouldn't traditionally get from a plan. So we're really shaving costs off of unnecessary procedures, keeping people out of the system, helping them remain healthy, and also shaving a lot of admin costs. And we've structured the plan in a way so that the savings are actually going back to smaller employers. Today, when small and medium-sized businesses save money, those savings are going back to large traditional health plans. And with Firefly, we're passing those savings back to the individual companies.
And Faye, I understand right now you're available in 3 states, I believe, in Massachusetts, in Maine, and in Ohio. So what do your expansion plans look like when you look out over the next several months?
Yeah, so we plan to become a national company. And while we're focused on employers headquartered in those 3 states, Maine, Massachusetts, and Ohio, we are able to serve employees across the country. So most companies have employees working remotely elsewhere. And so we can still service employees working outside of those 3 core states, but do plan to continue to expand our coverage through additional states over the coming years.
Faye, I see how, really using the virtual first approach is a cost saver. I think that's been sort of the theme for virtual health over the years. But talk to me about how you plan on incorporating the in-person parts. If something gets serious and does need the attention, how do you sort of avoid the increased costs as you expand, sort of following suit of what larger insurers have done?
Yeah, and I think that this is a big difference between Firefly and other virtual providers in that many approaches to virtual care have just focused on virtual access, which really helps with convenience, but doesn't actually drive value. And if you're dealing with something serious, or for example, a chronic condition, you're still stuck with the same broken health system if you don't have someone navigating you throughout the entire process. And so Firefly has built a network that incorporates traditional physical facility partners. So we're able to navigate you both virtually and in person. And we're able to, in some instances, guide you to partner facilities and be on the screen while you're getting treated with someone else's hands on you. But you can think of Firefly as a virtual layer complemented by the traditional access that you're used to.
Given that you have the experience on the tele side, I was curious, is it 24/7? All of us have had the experience of banker's hours of the traditional insurance companies, and then they keep you on hold for 3 weeks. Or if we were to call in on this as a client or someone working for a mid-sized employer, would we have quick access?
Not only would you have quick access, but you'd have quick access from a team that knows you. So it would not just be a call center, a different person that's picking up from a call center. It would be your personal care team that would be responding within 5 minutes in some instances, 30 minutes in others, depending upon the reason for your call.
It sounds like a very big selling point to potential employers who might be considering this. We appreciate your being here again. Faye Rottenberg, Firefly Health CEO, and also Angelique Hamlani. All the best to both of you. When we come back, we're going to be talking with Kyla Scanlon, a financial content creator, let's just say one of the young influencers who people who want to make investment decisions should be paying attention to.
Let's take a look at where things stand because we have just under 15 minutes to go here until the closing bell. And you're looking at a bit of a mixed picture, although the Dow is not too far from the flat line. S&P and NASDAQ holding onto gains. You had the NASDAQ up just around 0.6%. In terms of the sector action, utilities, materials, consumer discretionary are leading the way. Let's kick things over to Brian Chung, who is joined by a very special guest. Brian.
Crypto world when the CEO of the nation's largest bank, JPMorgan Chase, said he thought Bitcoin was worthless. And he even went further in questioning the limited quantity of Bitcoin. He said, quote, "How do you know it ends at 21 million? You guys all believe that? I don't know. I've always been a skeptic of stuff like that." And the online community was up in arms about this one, making it a perfect topic for our next guest. Kyla Scanlon is an influencer in the TikTok and Twitter sphere who has pointed out that markets aren't driven by fundamentals anymore. They're driven by memes. So Kyla, the prevailing response to that diamond quote that I was seeing on Twitter was basically this: "Okay, boomer. So what say you to regards to all of this?"
Yeah, I mean, I think it was just of all the things to point out about Bitcoin, the fact that 21 million was questionable was kind of, I think maybe not his best line of defense. I think that it's pretty well known that 21 million is written in the code. So a little bit unfortunate of a choice on his part, I think, yeah.
Well, we're showing that response right there from Nick Carter, who was just joking. Yes, the answer is yes. We have read the code before. And the code actually does pretty clearly state it. In fact, there's actually notes in there. This is all open source. People can just go on GitHub and look it up. It says that the cap is clearly 21 million. Now, again, I think maybe there's some technicalities here, which some people in my mentions have kind of been pointing out. All of this really has to do with the Bitcoin nodes. In theory, there could be changes to the Bitcoin open source, but enough nodes would have to agree to any sort of changes. And it seems unlikely, I don't know about you, but it seems unlikely to me that they would want to vote at any point in time to change the 21 million cap because it's such a big selling point for the asset itself. I mean, do you think, though, that there is some ounce of interest, though, in the idea that these hard forks could, in theory, be a thing?
I mean, maybe. I think that Jamie Dimon, his whole point was that Bitcoin is worthless and he's going to allow people who invest with JPMorgan to invest in Bitcoin and they're going to give them avenues to do that. But I think for him, he was like, I don't like this. And so I'm going to make a public statement about it. But I think the crypto universe, there's like so many different things that you can invest in now and put your money in. And Bitcoin is sort of a leading indicator there. But I think that there's Jamie Dimon calling out the 21 million isn't going to make that 21 million number not be true. And I would find it like very hard to believe that one day that 21 million would be changed, even if it is possible.
Yeah, and it's so funny when he said Bitcoin is worthless because actually Bitcoin is worth about $57,000. It's very clear cut based off of what the markets are saying. But can you just explain this to me? I mean, when you make TikToks, when you make Twitters about these topics, you do such a good job of explaining kind of what's going on in not just Bitcoin, but whatever the topic du jour is, be it the Federal Reserve or other types of things. But it seems like to me, at least, being someone who tweets every now and then as well, that whenever you hashtag Bitcoin, whenever you hashtag BTC, people go nuts. I mean, I was shocked at the amount of people with, CryptoPunk avatars that were hopping into my mentions and notifications over the week. Why do you think it is that Bitcoin still, even multiple years into this project, remains such a hot topic within the online community?
Yeah. I mean, it's collective belief driving the value of the asset. And it also has a lot of real world applications too. There's just a lot of people that believe in it. And it's a whole community that's riled around it, has been around since early 2010s. So it's been around for a long time. So I think like the idea that people wouldn't believe in it and that they're not going to have some sort of passion tied to this thing that has gone through so many up and down cycles. People are just very emotional about it. And, they've been along for the ride for a while. So I think it makes sense that they're going to be in your mentions on Twitter if you talk about it.
Now, what about the element of Jamie Dimon being a part of this, right? He's the CEO of the country's largest bank, right? Largely seen to be the establishment that a lot of people who are pro-Bitcoin maybe aren't as big of a fan of. Do you think that there's anything to be said about whether or not banks are really traditional banks, if you will, kind of the antithesis of what Bitcoin is going? Because the other argument would be, well, actually, banks want to be on the side of those in the crypto community when you consider maybe not JPMorgan Chase to many degrees, but a lot of institutions are becoming more warm to the idea of banking their clients to at least, if it's not Bitcoin, other types of crypto adjacent industries.
Yeah, no, I mean, I think the Block released an article about it yesterday. Most of the money that's flown into crypto recently has been institutional dollars. So it's not retail, driving this up movement. And if it's institutional dollars, you can imagine it's going to be companies like JPMorgan, like Bank of America that are getting involved. I think for them, like they just can't ignore it anymore. It's gotten so big, you just can't ignore something that has become such a behemoth and has like little tiny economies growing across its entire platform, whether it be DeFi or DAOs or NFTs, especially. Like banks and institutions have to pay attention to something of this magnitude. So I think even if Jamie Dimon thinks it's worthless, it's like you still have to understand it and know like what makes sense to invest in and to give your clients access to.
And then one last point here is that there were some people in the mentions that were saying, even though they disagree fundamentally with everything that Jamie said with regards to questioning the hard cap for Bitcoin, but that they said maybe this is a good thing that traditional finance people are still fighting against it. That gives us more fuel to the fire here. And when you consider BlackRock CEO Larry Fink today saying, quote, "I see huge opportunities in a digitized crypto, blockchain related currencies," end quote. Digitized crypto. I mean, is this guy kind of new to the game too? Is it okay? Are we okay boomering Larry Fink as well?
Yeah, I mean, that was a little bit of an oxymoron there. So a bit of an unfortunate choice of words because crypto is digital inherently. So I think like everybody's just trying to figure it out. And I think it's good that Larry Fink is like actively thinking about it because BlackRock is like, running the world behind the scenes. So it's good. But I do think that there's such a steep learning curve, both for the institutions, for politicians, for really everybody. And they're going to have to start learning quickly because the space is just growing more massive by the day. Yeah. So I think that it's still early. A lot of people on crypto Twitter would say,
All right. Well, we'll see if that conversation picks up in the days to come. But Kyla Scanlon, again, you can check out her stuff on TikTok. Thanks for hopping on Yahoo Finance this afternoon. And we'll be right back as we get a countdown to the closing bell right here on Yahoo Finance. We'll be right back in 2.5.
All right, we are heading to the closing bell in roughly 5 minutes. Jared Blickery is on the floor of the New York Stock Exchange. Turn it around a little bit. We are still in the green. Will we end there? Jared Blickery, ball's in your court.
5 minutes, I'd say we are. In fact, I'm looking at almost no red on the big board. VIX down a point, 1.3 points. Down volume looks like 200,000, but the up volume, total volume, clocking in about 700 million. So I said 200,000, should have been 200 million. Very low volume that we've seen, really on most days not picking up, especially even on the close. Brent crude oil wow, that's down 15 cents. So really a nice turnaround here. But needs to be proven because we have the 10-year T-note down. Utilities is the leading sector, so we're seeing some outperformance there. Aside from that, materials, real estate, tech, and discretionary and communication services are the outperformers. We were just seeing all of the mega caps in the green except for Apple due to some idiosyncratic issues there. To the downside, looking at financials and energy, the value trade flagging today, all the more telling that we're going to have a lot of attention on the big bank earnings tomorrow. Bank of America, I believe Wells Fargo, saving Goldman Sachs for Friday, but a lot of attention there. Also getting United Health, so a peek at the pharmaceutical sector as well. Well, the other big thing that caught my attention today is the weakening in the Dixie. That would be the US dollar index, and that is coming from a one-year high. So that's going to take pressure off of some of the multinationals, also going to take pressure off of crypto. Bitcoin looking at it like it's posting some gains over the last 24 hours, but still kind of hovering around that 55,000 level. Have to see if we can get any traction from the current area, guys.
Jared Blickery, we are now roughly 3 minutes to the closing bell, which we will ring right after the break. Okay, a minute to the closing bell, and helping us make heads and tails of everything that's happened in the trading session, Jeff Klingelhofer, Thornburg Investment Management Co-Head of Investments. Also, Mark Lucchini, Janney Montgomery Scott President, Chief Investment Strategist and Chief Investment Officer, will be here to help us break it all down. But let's take a look at where it looks as if we're going to settle. And again, it's going to be in the green, although not by much. And look at that, we just went negative on the Dow, so I jinxed it. Dow is possibly going to settle negative today. S&P 500 still up about 12 points, and we've got the NASDAQ up about 101 points. We had a guest on earlier this week who still said end of 2022, S&P 500, 5,000. A couple of things to keep in mind right now is the sector action today, and the sectors have been in the green except for financials, off by about 0.5%. Utilities up over 1%. We've also got consumer discretionary up over 0.5%. But right now, here is the closing bell.
That wraps up today's trading action. As we work out the final trades of the day, the Dow might actually hold on to slight gains, if you want to call it that, but basically ending on the flat line. S&P up just around 0.3%. The NASDAQ was the outperformer today, up over 100 points. That's a gain of just around 0.7%. In terms of the sector action today, Adam mentioned the weakness that we're seeing in financials, some of that driven by the results that we got out from JPMorgan. It was one of the worst performers in the Dow, one of the worst performers in the XLF today. They're better than expected, a profit number, failing to really excite investors there. And you're seeing that that's one of the big reasons why financials is one of the underperformers today. But let's bring in Jeff Klingelhofer and Mark Lucchini to help us break down the action that we are seeing. And Mark, let me kick it over to you first. We have third quarter earnings season kicking off today. Results from JPMorgan. When you take a look at what we got just in terms of the numbers and what we could expect over the next couple of days when we hear from some of the other biggest banks, what are you expecting to see?
Well, a little more of the same. We're hearing first from the big money center banks. And so they tend to derive a substantial portion of their overall business from capital markets, not kind of the traditional lending facilities that we know are what the super regionals down to the small community banks really thrive on. And so I thought once we kind of teased out the numbers from JPMorgan's report, you saw a couple of things. You saw very strong investment banking revenue because of the preponderance of merger and acquisition activity that's running at unprecedented levels at the moment. You're also seeing some loan loss reserves, and that was widely expected, although the amount that continues to be released out into profits continues to recede from the levels that we saw a couple of quarters ago. What was, I thought, a little disappointing, not so much an indictment of JPMorgan, and hopefully we'll see some improvement on this in the coming months and or quarters. And in fact, Jamie Dimon from JPMorgan alluded to this in terms of him saying that he's seeing green shoots in the commercial real estate lending market is commercial and industrial loan activity, while sequentially having improved on a quarter-over-quarter basis, was still negative year over year. And I think that's a little bit of a tell on one, perhaps how flush corporate America is and didn't have a strong demand for lending activity. But also it's something to watch for in terms of all the reports that we've seen from businesses big to small about capital expenditure intentions really rising at a significant pace, hasn't yet translated into borrowing needs. And so I think that's going to be an important signal as we listen to these reports this quarter and subsequent to, in terms of helping to boost overall economic activity on a go forward.
Jeff, I want to bring you in specifically something in the notes that you had shared with us that caught my attention, because everyone's worried about inflation. But you say the question is if labor truly has greater bargaining power over capital. And I'm hearing that an hour ago, we heard the president talking about paying truck drivers and people, obviously time and a half because we're going to have to work extra hours. Help us understand what's really happening with labor right now and its impact on what we're going to be hearing as more companies start reporting.
Sure, and I think that's one of the biggest things that we'll be watching for is exactly those comments. But what we are seeing is an economy that continues to run hot, after numerous rounds of fiscal stimulus, and that will be pulling back, right? Consumers today still have elevated savings, and they'll be drawing that down in the months to come. And so really, while we are absolutely seeing higher wages trickle into the economy, and especially amongst the lower wage employees, the key to watch will be as the economy continues to heal, as vaccinations continue to increase and businesses open, whether that trend continues. Right? There are a lot of folks that have exited the labor market and will be looking to come back. And ultimately, we've been a decades-long shift where the power of labor has shifted to capital. It is to be expected that it will shift back, but we don't expect it to shift back in a dramatic fashion. So we'll be watching those wage numbers exceptionally carefully. They really are the key to trying to figure out where the Fed goes and whether this inflation is transitory in nature. But at this point, we think it'll moderate in the months and quarters to come.
And Joe, speaking of what the Fed's next move will be, we got the FOMC minutes just around 2 o'clock today, and it really signaled what we were expecting from the Fed, and that's the fact that the tapering could begin in the middle of next month to the middle December. Just in terms of the supply chain issues that we're facing, also some of those labor concerns that you were just talking about, any worry that maybe the Fed would be acting too soon if we do start tapering next month?
There's always that concern. But again, we just look at GDP numbers, we look at the inflation numbers coming in, and we think about the extraordinary stimulus that continues to be poured into the economy today, right? And so one of the big challenges for the Fed, of course, they don't want to be embarrassed in the months to come, but where we are today, I think the market needs to draw a very distinct line between tapering in the month to come and ultimately rate rises in the years to come. And those are two very different things, especially as we look forward for Treasury issuance into 2022. And the reality that the Federal Reserve will continue reinvesting the proceeds from maturing securities, a lot of that support is likely to continue. just as that Treasury issuance comes down lower than what we've seen in the previous years, there really isn't that much difference. And so the argument to start tapering today, I think, is exceptionally high, and the accommodation in the years to come will remain high as well.
Mark, I would imagine the position you have as a strategist and a CIO, it doesn't get any easier when we're trying to, one, weigh what these reports are going to tell us. But then when you look at all of the uncertainty in Washington and the need for job growth that you've put out, how do you keep your clients, and what can you share with us, those of us who are investors who are not your clients, as to whether it's stay the course, or what signals do we look for that maybe it's time to either buy or sell?
Great question. And there is a tremendous amount of cross currents at the moment. That is to say, there always is a large number, but it's, I think, exceedingly unusual at the moment because of what we're dealing with in terms of the Fed policy and the transition in its regime from uber accommodation to less accommodative. Obviously, fiscal policy is a huge issue that continues to lurk out there, geopolitics and so on. So I think a couple of things I'd like to focus on. One, for most of our investors anyway, that have a long-term time horizon, I go back to the golden rule of investing, which is that bear markets, those declines from peak to trough of 20% or more and over an extended duration, are exceedingly rare outside of recessions. And therefore, unless you are forecasting in the investable horizon, call it the next 18 months to 24 months or so, a recession, which to us seems exceedingly remote at this juncture, then now is not the time, regardless of the fact that we sort of moved downward or more sideways than directionally, certainly in a positive fashion over the last month and a half or so. Now's not the time to turn more cautious. In fact, use any kind of declines from here in a corrective modality as an opportunity to add to your stock portfolio rather than derail your equity exposure. I think the other thing, though, is that the key to an economic expansion is job creation. And the last couple of months have clearly been disappointing against where expectations were going into both of the Bureau of Labor Statistics reports. But what we fully expect to see is that given the fact we have 10.4 million job openings today, and schools are reopened, child care centers are reopened, the Delta wave has certainly rolled over and is receding rather dramatically. And in addition to that, we've had the expiration of all the pandemic assistance program benefits as recent as Labor Day. That should lead to some inertia back into the labor force, which is going to hopefully sustain this economic expansion through both not only job growth, but also wage growth. And I think that's going to go a long way toward, once again, rebuilding the narrative around a reacceleration of economic activity in the fourth quarter of this year and into the first half of next year, and shelve any concerns around a recession that would once again have somebody today turning more cautious in anticipation of things worsening rather than necessarily staying stasis, if not improving.
Mark Lucchini is Janney Montgomery Scott's president, chief investment strategist and chief investment officer, and Jeff Klingelhofer, Thornburg Investment Management's co-head of investments. We appreciate both of you sharing your insight. I know a lot of people listen to how you guide them, and we've helped some of them today. But let's get some more help from Jared Blickery. I jinxed it, by the way, 10 minutes ago when I asked you about where the markets would settle. What's your final take on all of this?
Well, I'm looking at copper, actually. Didn't get a chance to mention it all day, and I am now because it has broken to the upside. I've outlined a pattern on the Wi-Fi Interactive. It is a months-long pennant formation, finally broke it. After you have a consolidation for a multi-month period, you probably have a multi-month rally, and that's what we're looking at, the potential right now. Also, this is on the back of that hot CPI report that we got this morning, showing all kinds of inflation, not necessarily from the reflation trade, also on the back of a broadly weaker U.S. dollar. If that trend were to continue, that would be an additional tailwind for Dr. Copper here. Adam.
All right, we've heard about the growing economy globally and Dr. Copper, but then getting the supplies where they need to be. We heard from the president, about an hour ago? When we come back, we're going to find out the latest on the supply shortages and what can be done about it.
President Biden, he met with port leaders and industry executives on the supply chain crisis earlier this afternoon, and really about what needs to be done in order to alleviate some of the bottlenecks. Now, part of his plan is to keep the Port of Los Angeles operating 24 hours a day, 7 days a week. We want to bring in someone who was participating in that meeting with President Biden earlier today, and that's Ian Jeffries. He's the CEO and president of the Association of American Railroads. And Ian, it's good to see you. Thanks so much for taking the time to join us. Let's just start with that part of the announcement from what we heard from President Biden, the fact that the LA port is now going to be operating 24 hours a day, 7 days a week. He called it a game changer for the supply chain problems. What do you think about that?
Well, first of all, thanks for having me. It's great to be here. It's certainly a step in the right direction and an encouraging development. Railroads have been, are, and will continue to operate on a 24/7 basis around the country. And our main thesis has been that we need the entire supply chain operating at full capacity around the clock in order to really make a dent in addressing the volumes we're seeing. So the Port of LA, along with the Port of Long Beach, 40% of inbound goods coming through those two ports. So getting LA to 24/7 over the next several months is a great step forward, and one that I think will pay real dividends.
Ian, a lot of us don't truly understand all of the different steps in the supply chain, because once it's off the ship, then the truck has to get it perhaps to the train that then has to get it to the yard somewhere else where another truck has to deliver it somewhere. Did anyone bring that up with the president, that while that might be in play now, the men and women to drive the truck or to offload the train in the Midwest, there's a labor shortage?
Well, you're exactly right. One thing that we've been experiencing over the past several months is in our major intermodal yards, which is where the train comes into the yard, unloads its containers to be picked up and taken out by truck to final destination. That's called outgating, when the truck picks up goods out of the yard and takes it out. And our ingates of containers, the volumes coming in on the trains, were far exceeding the outgates, which again is the trucks taking them out of the yard. And that's due to a number of reasons: a short haul trucker shortage, a warehouse space shortage, chassis shortage. And so those challenges still remain. Railroads have worked really hard to open up additional storage capacity in new locations outside of intermodal yards in order to alleviate some of that congestion, to allow that backfill to be worked down. And we've done a pretty decent job of keeping things fluid. But at the end of the day, we still have work to do when it comes to some of our partners in the logistics chain getting goods to final destination.
And Ian, when you talk about work that needs to be done in order to get some of those goods to the final destination, I guess what exactly would you like to see rolled out over the next couple of weeks or the next month or two that would help alleviate some of the bottlenecks that we are seeing?
Well, it's important to say we're all in this together. And today's announcement was an important announcement. And as I said, rail's operating 24/7. All of our major facilities around the ports of LA and Long Beach are 24/7. And we have capacity right now. We can take on additional freight to get it to the interior of the country. But on the other end, we need serious efforts to address those driver shortages. We need serious efforts to keep goods moving through the warehouse spaces in order to free up that capacity, because intermodal yards aren't meant to store goods and store containers for extended periods of time. They're a stopover, a changeover. And so we need to keep our eye on the ball and look for ways to keep everybody moving 24/7. And a few of the ways that we've tried to do that, and some of our beneficial cargo owners, the major shippers who committed to doing some things today, include incentivizing either after hours or weekend pickups. Normally you have your peak pickups during the workday, Monday through Friday, and pickups drop off hours and during the weekend. And in the meantime, goods keep coming in. So we need to streamline that, to normalize a consistent pickup and drop off of goods in order to keep the system moving overall. So we've got to keep our shoulders into it, all of us in the supply chain, and
sure,
we'll make the headway.
Ian, you're in the room where it happened virtually with the administration. And on one hand, they're asking for the railroads, help us here because this is a national issue. We're all in this together. And on the other hand, the regulatory side of the administration, we've talked about this with Lance Fritz from Union Pacific. We've talked about it with you. They're trying to enact new regulations that would actually impede, we're told, by the railroads the ability to do what they're now asking you to do. Did they address that?
That did not come up today, and that is an unfortunate reality of the disconnect maybe from different parts of the administration. Right now, the last thing we want to be doing is inserting regulations or inserting requirements that will decrease or gum up the fluidity of the network. We need to be doing everything we can to maximize fluidity of the network across the board. And any regulatory efforts that would hamstring the ability of freight to flow is simply wrong-headed right now. And so we're working really hard to educate on that front, and I'm confident we'll be successful in that.
Ian, do you see a chance of this getting worse before it gets better? And I guess how much worse do you think it could potentially get heading into the holiday season?
Well, fortunately, I'm not in the prediction business, and I'm an optimist, a realistic optimist, I'd say. And I think that steps such as those that were taken today, and a recognition that we've got to move things around the clock, we've got to keep everybody on board together. We'll be able to manage through this. Like I said, rail's stepping up, ready to do its part. We've been operating 24/7 for some time. We've got capacity. We want to move freight. And so we're prepared to do our part to keep things moving through the peak season.
Well, Ian, we love your optimistic outlook. Thanks so much for taking the time to join us. We hope to have you back. Ian Jeffries, CEO and President of the Association of American Railroads. We want to continue talking about this, the port congestion, the lack of truck drivers, the supply shortages, and really what that means for consumer prices. For that, we want to bring in our editor-in-chief, Andy Serwin. Andy, I know you wrote about this extensively over the weekend. The big questions I think we face now is, how is this going to get resolved? How much worse could it potentially get? And how significantly could this slow the recovery? What are your big takeaways from what we heard from President Biden, and also what we just heard from Ian, just in terms of what the railroad industry can potentially do to help speed some things along?
Well, to answer all your questions, Shauna, yes, yes, yes. I mean, it could get worse. It's tough to solve. The administration's doing what they can. The railroad industry, you just heard Ian Jeffries talking about that, trying to pitch in here. But you know, the system's only as good as the weakest link. And I think the weakest link right now is shortages, labor shortages. You guys were talking about that. And yes, Adam's right, particularly with truckers. I mean, the railroads are scrambling to hire too. We know that as well. But so too longshoremen in the ports of LA and Long Beach. They're trying to get more longshoremen because we know the president today talked about making those ports open 24/7, which has been talked about for a while. So it's really kind of a perfect storm. On the one hand, you don't have enough people working on the trucks and the railroads and the ports. And on the other hand, demand for goods is off the charts. And people tend to forget that point, you guys. Americans are just buying so much stuff. And that's because, you know, starting back 18, 19 months ago, we've been at home. And instead of going out to spend money at the ballpark or hotels or on trips, we've been buying stuff and fixing stuff up around the house. And that's what's going on right now.
Andy, here's the complexity, though, that might gum all of this up. I'm going to read from the federal government Department of Transportation, the guidelines for how truckers drive, and it's not on a 24-hour basis. They say, quote, you are allowed a period of 14 consecutive hours in which to drive up to 12 hours after being off duty for 10 or more consecutive hours. Double time or not, time and a half. Try to figure out that one. If you're Walmart, for instance, who says they're going to now ship at night, it's not just the labor shortage. You got to comply not only with the federal mandates, but there's also, each state has different trucking regulations.
Oh, yeah. And this is not a new problem, is it, Adam? I mean, these kinds of regulations. And of course, you know, these were put in place, though, because drivers were driving too long and there were accidents. And so these are safety protection rules. And so we don't want to do away with them completely either. And, you know, I think a lot of people are pointing to immigration as a solution here. That we need more workers and drivers coming in from overseas. We're not alone here in the United States. The UK has an even bigger trucker shortage, if you can imagine, than we do. And this at a time when truck drivers are being told, maybe you shouldn't really count on having a future in this business because it's all going to be automated driving anyway soon. And now they're being told, well, wait a minute, that's not coming for a while, so you guys better get back to work. Very confusing picture, isn't it?
It is very confusing, and also be interesting to see how all this plays out over the coming weeks. Andy Serwer, thanks so much for hopping on with us. We are going to take a quick break, but when we come back, Washington Capitals are kicking off their season tonight against the New York Rangers. We're going to talk with Jim Van Stone. He's the president of business operations and chief commercial officer at Monumental Sports and Entertainment about this season. They also have a New Jersey deal with the Caesars Sportsbook and sports betting inside the arena this year. Lots to talk about. He'll join us right after the break.
All right, the world of sports is about to get more engaging for people who not only love sports, but also like to engage in gaming or gambling and betting on the teams and the players that they love. There's new ways to do that. And to discuss all of this, we bring into the stream Jim Van Stone, Monumental Sports and Entertainment, President, Business Operations and Chief Commercial Officer, along with Josh Schaefer, our correspondent and producer here who likes to talk a lot about sports. Let's talk the big picture here. I no longer have to go somewhere else if I live in Washington, D.C., if I want to engage, game, bet on the game. Tell us about the deal that you've got going with Caesars Sportsbook.
Sure. More than happy to, and thank you, Adam. It's an exciting day for us in the nation's capital. We are opening the building for a full capacity for our Capitals game this evening against the New York Rangers, which has been the first time since March of 2020. So having a full crowd in the house tonight is going to be fantastic. But we want people to get here early. And, we were the first U.S. sports arena to open a bricks and mortar retail sportsbook. We did it through a great partnership that we have with the Caesars Entertainment Group. And we've got the Caesars Sportsbook, which is located at the corner of 6th and F Street, connected to Capital One Arena. So it's a beautiful, immersive, 20,000 square foot bricks and mortar sportsbook. And, it's filled with these incredible TVs and televisions from an audiovisual standpoint, a great dining experience, along with 20 betting windows and about a dozen or so kiosks. So it's just a great destination spot for sports fans in the Washington, D.C. area.
And Jim, I'm curious kind of how you think we've got here with sports gambling. I mean, you go back a decade ago and it was taboo for an announcer to even mention a point spread, right? We didn't see those in broadcast and we didn't see it kind of anywhere to do with the official sport itself. How has that kind of shifted over the past 10 years? And is there a point where you think maybe it's too much? Are we getting sports gambling too much involved with the sport itself?
Yeah, I think that's a great question. I think we were very active from a monumental standpoint with, really positioning and communicating from an industry standpoint. And with the overturn of PASPA in May of 2018, really changed the landscape. And I think, the thing for us, and we went into this process doing a ton of research. And, we found that our fans were very engaged when it came to the sports betting opportunity. I do think it is a responsibility, and we get a lot of support both from the NBA and NHL, but, making sure that we have PSAs on responsible gaming, is really, really important to us. And we partner with Caesars from a responsible gaming standpoint with PSA messaging, but we also have a great alignment and partnership with the American Gaming Association that's located a couple blocks away from us at Capital One Arena. So, we think it's something that fans were looking for. We think it's a high fan engagement opportunity, but we also want to balance when it comes to, the responsible gaming side. And I think when you see our games and experience it, both coming to the facility itself and really through the in-game, you're going to see a lot of PSA messaging to really complement, some of the advertising messaging when it comes to sports betting.
Jim, this is certainly a way to get fans more involved. So you have the sportsbook inside the arena, also your jersey deal. I'm curious just to get your take just on how lucrative something like this could potentially be, or how valuable deals like this are to your franchise going forward.
Yeah, that's a great question, Sean. I would give a lot of credit to the NHL and Commissioner Bedman, many of the executives up there. We do think from a financial standpoint, jersey entitlements are a really big revenue opportunity, I think, in our industry. With us in having the bricks and mortar sportsbook here, we thought the home jersey piece for the Washington Capitals was a perfect alignment. Our fans are going to be coming here. We're hopeful that they come 2 or 3 hours before a Caps game, take in the festivities of the sportsbook, and then after the game, stay for a couple hours and enjoy the end of the evening with a nice nightcap and maybe a West Coast hockey game from that standpoint. So, for us in the jersey, it was really about the fan engagement opportunity, and aligning with Caesars on it felt like a really natural fit for us organizationally.
Jim, with the brick and mortar sports book, have you guys seen interest in days that there isn't a game? Has it kind of become a new source of revenue for the arena? Because correct me if I'm wrong, I think it's open 7 days a week, right? People can go there when there's not a game at the arena.
So you know what? It's great. We do about 230 events a year, about 3 million people through the turnstiles at Capital One Arena. We think this is a 365-day destination spot. We're a couple of blocks away from the mall. And, really, if you're a sports fan, there's probably not a better sports bar in the greater Washington region. So it's funny, on the weekends, we almost become a football facility. I mean, it starts with global soccer in the morning in the Premier League, and then it goes into college football on Saturdays, and the NFL on Sundays. So we really think it's really opened up a lot of new and unique opportunities, and really probably some sports fans that traditionally wouldn't come down for either a hockey or a basketball game. So we think there's a really good, compelling opportunity. And one of the things that we're so bullish on from an industry about this is that if we could take advantage of maybe those 100+ dark days a year where we do boxing or MMA pay-per-views inside our building and connect it to the sports book, we think it's certainly a new revenue opportunity, but a new fan engagement opportunity, and help us, really build our core business.
Personally, the revenue opportunity is parking around the arena. Those of us who are familiar with Washington know how awful that can be. But I got to ask you, other teams, they're going to be looking at this as a potential revenue for them. Are you getting phone calls from them about what do we do in our part of the country to maybe create what you've now created?
You know what? I think we've been very fortunate on that, Adam. We've had probably teams in all 4 of the major big leagues, come in on a weekly basis. We actually have our friends from Madison Square Garden coming down tonight, and we're going to show them around the facility. But yeah, I think it's going to become a really unique destination spot. And, for me, as more states come up and running, I hope my peers in the industry have really a unique opportunity of building out their own sports book, and to do it with an operator, because we don't touch any of the sports betting business. That's handled by really the big operators. To partner with Caesars and the Caesars Sportsbook Group is really just a great opportunity for us. They are true experts in the business, and I think there's a really great alignment there.
Well, Jim, over the next several weeks, next several months, there's another big issue that you're going to be facing, and that, of course, is the COVID-19 pandemic. We certainly have made strides just in terms of where we were last season, but there are a number of professional athletes who are still hesitant in getting the vaccine. I'm curious, just from your perspective as a leader in the group, how are you navigating this uncertain and this very difficult time?
Yeah, I think communication is absolutely key in this process. And, we've got incredible team operations executives. We also align with MedStar Health, one of the biggest, health organizations in the greater DC area. I think it's really constant communication from that standpoint. I mean, the safety and health of both our players and our fans coming into the building is paramount. So, we have an obligation to really, promote a lot of PSAs and encourage people to get vaccinated. And, I think we've come a long ways, over the last 18 months, and we still have some ways to go. But, I think constantly using our brands and the notoriety of both our brands and our athletes to promote, people's safety and health, coming out of the COVID situation, I think is critical. So we're going to continue to message that very, very aggressively. And I know every team in both the NBA and NHL have done that respectively in their own markets.
Jim Van Stone is President, Business Operations and Chief Commercial Officer at Monumental Sports and Entertainment. Thank you for joining us. Josh Schaefer, our producer and correspondent when it comes to sports issues on the 3 to 5. We appreciate seeing you here. We're going to keep talking about all of this stuff, though, in a different context, because we want to bring in Alexis Keenan, who understands the legal world and what Shauna was just talking about. I mean, we have Kyrie Irving not going to play practice until eligible under COVID-19 vaccination mandates. What standing does either side in this have on this going forward?
Hi, Adam. Yes. So Kyrie Irving is not only not going to practice, he's not going to games. He is under New York City's local vaccine mandate. He is banned from the Barclays Center. So his general manager, Sean Marks, said that the ban will extend beyond those games. In a statement, he said that Kyrie has made a personal choice and we respect his individual right to choose. Currently, the choice restricts his ability to be a full-time member of the team, and we do not permit any member of our team to participate with part-time availability. Now, just in the last hour, The Athletic published a report saying that Irving is not anti-vaccine. They say, based on sources, that he is just upset about people losing their jobs over these mandates and that he's taking a stand on their behalf. Now, basically, this New York law, it prevents Irving from going to indoor gyms, indoor entertainment venues, as does it prevent every other person who wants to go to those facilities in New York City from doing so. All members of the public, Irving included, they need to have at least one dose in order to enter. So I've been asking employment lawyers as well as constitutional lawyers if there's any path at all that would allow Irving to get stadium access while he remains unvaccinated, if that is the case. They say not likely unless he raises a need to be granted an accommodation from the city or from the franchise. And those are those accommodations that we've been hearing about, where employers in some cases do have to extend an accommodation for those who have a medical disability or a religious exemption that they ask for under Title VII. But still, there's another question that is coming, and that's whether that federal mandate that's coming from OSHA that we're all expecting soon in the next coming weeks, whether that could impact this New York City rule. And again, the lawyers tell me the answer there is probably not, because under the U.S. Constitution, those two laws don't necessarily have a direct conflict. So in other words, anybody could comply with both of those laws. They're not mutually exclusive. So a lot to come in the sporting world. Certainly this could pose a problem for Irving, other players that don't want to get vaccinated, to not be able to participate not only in home games in the case of New York City, but also across the U.S. in those away games as they start traveling. Adam and Shauna?
Alexis, thank you. When we come back, we're going to meet Sonia Gill, Fluen's CEO and founder. And when I say Fluen's, talking about the ability to speak foreign languages. Si quieres, ¿cómo se dice? Si quieres aprender español, you might want to consider this one right after the break.
Learning a language, a new language, is very, very tough. I know I've been there before, but we have the founder and CEO of one startup that's looking to make it a bit easier for its users. And for that, we want to bring in Sonia Gill. She's the CEO and founder of Fluenz, which is a digital language learning platform. And Sonia, it's good to see you. I know this is something that I've struggled with going back to grade school and, of course, through high school. So your platform, you're geared towards English language speakers who are looking to pick up another language. What separates Fluenz from some of the other options out there? Because it is a relatively crowded market.
It is very crowded. And unfortunately, for many years, we've been bombarded with advertising that you can just learn it quickly or easily or playing a game. And that's not true for most of us. It's really hard to learn a language. You have to really work at it. And we provide a platform that allows you to do that. And you touched on that point. The fact that we create every single one of our programs specifically for English speakers is really what sets us apart. We don't teach Mandarin the same way that we teach Spanish or the same way that we teach French. And you think that that's what normally happens, but that is not the case. So English speakers, and we put in a lot of just focus on bringing in relevant content. We want you to find it useful so that every lesson that you do, even if you do only one, you can walk out on the street and you can use what you're learning. And that hopefully keeps you going and builds up a little bit of confidence, and you can continue, because what you said is right. Very common. People start learning a language and then they give up.
Some of us can't roll our R's. I can remember back in junior high, ere con ere. I still can't roll my R's. Do you address
pretty
that?
Close.
Thanks. Real quick, because this is the kind of thing a lot of us want to take on a third or fourth language. Yep. But I'm going to, regarding Spanish, I noticed, and I'm not passing any judgments here, but in the press notes we got about you, they referred at one point as Latinx. And then, of course, if you've learned Spanish, there's the feminine and then the masculine articles that you have to use. How difficult is it with your different language platforms to keep up with the cultural changes which are taking place?
It's difficult. Let's say that. We address cultural changes. We talk about it. But the reality is that the language is what it is. The Spanish language has gender within it. Every single noun has an article attached to it that is either feminine or masculine, and there is no ways around it. So there's always a fun discussion going on with everything that we're living now. But the fact of the matter is that the language is what it is, and to be able to speak it properly, you have to go with it.
So Sonia, you have the classes that people can take online. I know you also have immersion courses, which of course you had to suspend during the pandemic, but I understand that you're starting to reopen some of those now. Talk to us just about what the last year and a half has been like, and also what you're seeing just in terms of demand, how willing people are to travel and really experience some of these immersion courses right now.
Thankfully, very willing. And I'm happy to be coming to you from a hotel room, which means that, we're back in the game. We were closed for an entire year, and that was very tough. We also have to thank the pandemic, which made us really rethink our whole model, and we were able to come up with an online immersion as well. So now we have both things ongoing. But for our in-person immersions, they are targeted to adults mostly. It's a luxury experience. So everything is curated from the moment you arrive to the moment you leave, not just your learning experience, which is very targeted, efficient, and pleasant, but also the hospitality part of it, which is very new in the immersion world. It's not something that usually is taken into account. So everywhere from every meal, every experience that you'll have in the country, museums, talks, we go to the best restaurants that there are. So it's a little bit of both a vacation, but also a learning experience.
I'm hoping you open up in Madrid. I want to go back. I need some fabada asturiana.
We are opening up in Barcelona, Spain in November. So maybe there.
I think my bosses need to, we need to try this, a 6-day immersion in Barcelona, and all volunteer. It seems like, though, your idea is truly unique. And I think those of us who could afford it and have the time to do it would absolutely grab it. So where are other potential areas to grow? I mean, some people want to learn German, you mentioned Mandarin earlier. It seems like your growth trajectory is unstoppable.
Yes, hopefully. For now, we're going to be expanding just in Spanish for the time being. We have opened already Mexico City, Oaxaca. We're opening Barcelona, Spain, and we're hoping to open new locations next year. And then we'll go from there. The next step would naturally be other languages and expanding both the in-person and the online immersions in all those fronts. So there's plenty to do. I can keep busy for a while.
Sonia Gill, we wish you all the best. Thanks for taking the time to join us, CEO and founder of Fluens. We're going to take a quick break. When we come back, LeBron James is making a new bet. This time, it's on at-home fitness brand Tonal. We're going to hear from the company's CEO when we come back.
At-home fitness player Tonal announced earlier on Yahoo Finance that NBA great LeBron James, now an investor and brand partner. So Tonal's founder and CEO joined the team here to give us a deeper look at the partnership. Here's what they told us.
It's something we're extremely excited about. The relationship with him started about 18 months ago when he first joined Tonal as an investor. And how it started isn't all too different from other athletes who've invested. We have about 20 to 30 professional athletes who've invested in our business. And the story is always, they got a Tonal, they used it, they fell in love, and then they wanted to invest. And over time, we've just built that relationship, and being someone who works with equipment basically his entire career, has been around fitness his entire career. When he sees something like Tonal, adaptive digital weights, something that's incredibly efficient, something that's incredibly data driven, he had to use it, and a partnership made perfect sense. He was excited about it. And we were able to make this happen.
Ali, you see the list of athlete investors you have: Steph Curry, Drew Brees, Serena Williams. Is LeBron now the biggest athlete investor in your company?
LeBron is definitely he's without a doubt one of the greatest athletes of all time. We're really, really proud to have him involved in the business. We're excited. He's excited. And you know, the most important thing that I can say about this is, he's been using Tonal to train. He actually believes in the product. It's something that he personally uses. He views strength as a foundation of greatness. And this is something that came up in a lot of our interactions with him. And being able to get stronger with the most advanced piece of equipment ever created is something that he's really, really aligned with. This is something that, of course, we've seen with the likes of Serena Williams and Steph Curry and and dozens of other athletes who use the product for that exact same reason. And he's just adding one of the greatest athletes of all time to our roster, and having him be involved with us in this capacity is just a huge step for us.
Hey, Ali, it's Julie. Obviously, when you get these folks sign on as investors, it's something that can potentially prompt more people to sign up and buy the product. How many people have bought the product? How many of these have you sold? And how has your sales growth been?
Well, we have not been talking explicitly about numbers in terms of dollars sales. But what I can tell you is we did last year announce that we grew 8x year over year, which is massive growth. In January of this year, we raised $250 million at a $1.6 billion valuation, and we've seen significant growth since then. And so when you're looking at those valuation numbers and the multiples that you would assume are behind them, you can extrapolate the rate at which we're growing and how many tonals we're selling. I'm just going to tell you, it's a lot. It's significant.
Ali, do you expect some form of shakeout in this at-home fitness space? I see you guys, very innovative product, Peloton, very innovative product. But I see something like a Mirror, I would say not too innovative, and you see other competing type products out there. Ultimately, over time, is there just two major players in the space?
Well, we are the leaders in connected strength. We're also the leaders in intelligent fitness. One of the things that we did differently from everyone else in the sector is our aim to bring a personal trainer into the home rather than just a group fitness experience. We did that by bringing a lot of data to bear, by building AI and personalization. And we really view that as intelligent fitness, not just connected fitness. So we're forging ahead, and we're leaders in multiple dimensions. We've built all sorts of moats around our business. We filed over 45 patents to date. Of course, there is one business that you mentioned, Peloton, which is significantly larger at this point, but we're growing faster than they historically grew. And then you're right. After that, there's a lot of smaller businesses who are building more point or niche solutions. And I do expect that that's going to shake out over time. I don't believe this is a winner-take-all market, but I also don't believe it's a market where we're going to have room for a dozen different players.
And Ali, news out today that Apple is having trouble just getting components for its iPhones. I mean, how does your supply chain look in this environment?
I'll just tell you, it's a lot of work to secure supply. We've tripled the size of our manufacturing team just in the past 12 months. And the 12 months prior to that, we 10x our manufacturing capacity. We brought a second factory online last year, bringing another factory, a third factory online in the next few months. And a lot of this is just about securing materials, securing capacity, keeping supply chains moving, and logistics, just moving product around the world and across the country. It's hard work, and it's where we're making a lot of investments. The vast majority of our investments are either going to marketing, brand, operations, or content, where you might have heard, but we recently announced live content on our platform as an addition to the many forms of content that are available to our members.
And Ali, I know you've been asked this before, and I'm going to ask it again, what the IPO plans are. And if you're not ready to IPO now, sort of what you're looking for, what would be the trigger? What would be the thing that would mean that you're ready to go there?
Well, we've been building towards it. In the last 6 months alone, we brought in a number of new executives into the C-suite, and operations, product experience, technology. And a lot of that is about readying the company for an IPO. We still have a lot more building to do in terms of operations, finance, infrastructure, and a lot of the compliance things that you need to be public. But it's something we're working towards every single day. We're going to look for that moment in time where being a public company is beneficial to us and is not a distraction. Being public can often take a lot of management energy, and right now we're growing so fast that we just want to focus on supporting that growth rate. And really supporting our member base, which is incredibly passionate about our product. We have a net promoter score that is pretty stable at 85. We have the highest engagement in the sector. And those are metrics we certainly don't want to lose track of just to become public. We'll become public when we can pull off being public, tap those kind of public capital markets, and make sure that our business is solid throughout the entire process.
comforter of blue that we have around us. We think, oh, that's blue sky. And then suddenly you shoot through it all of a sudden, as though you whip off a sheet off you when you're asleep, and you're looking into blackness, into black ugliness. And you look down, and there's the blue down there, and the black up there, and it's just, there is Mother and Earth and comfort, and is there death? I don't know. Is that death? Is that the way death is? Whoop, and it's gone. Jeez.
And that was William Shatner. He's speaking with Jeff Bezos just minutes after he landed. He actually went up to space. Get this, he's 90 years old, Adam. And he was so excited. You could hear it in his voice. You could hear it in the words that he was using to describe his experience. And he went on to say that he hopes everyone in the world, they need to do it. He hopes everyone experiences it. And he really called it life-changing, which I would imagine if you go to space, it would be pretty life-changing.
Yeah, life-changing if you can hold on to your cookie. He's 90 years old. That's the best part. But you know what? And look, some of us are Star Trek geeks, and they missed a great opportunity. The Gorn. Do you know what the Gorn is by any chance, Shauna?
No.
The Gorn is the green lizard guy from like 1968 in the carpet who attacks Kirk, Captain Kirk. They should have had the Gorn waiting for him when they came back. How could they miss that? I'm not sure if our bosses would allow me to screen share, but I've got a picture of the Gorn loaded up. I'm going to try it, and if I get in big trouble, my resume is available. But okay, let's see if I can do the screen share here. I'm in Skype, so wait. Take screen share. Okay, share screen. I don't think it's working. Okay, look, Google Gorn. That is the essence of Star Trek. It's like, it goes after Kirk. and they missed that great opportunity. I'm thrilled for Shatner. I just wanted someone should have done, live long and prosper. But it's wonderful that he was able to do that.
That was another opportunity that they missed. Well, I know what I'm doing right after the show. I'm going to Google that just so we're all on the same page. So I know exactly what you're talking about. But it looks like they need to hire you next time to produce this thing up a little bit to add to some of the excitement. But still very, very exciting. William Shatner going into space at the age of 90. That does it for us today on Yahoo Finance. Thanks so much for tuning in. We'll see you back here again tomorrow. Have a great night.